recent years in the manner to mitigate and control risk in stock market. A derivative is a contract in which its value is derived from the value of something else. And the something else can be anything from an agriculture commodity, interest rate, foreign currency, or financial instrument, and it is called the underlying asset. An option is a type of derivative contract between a buyer and a seller. The buyer is purchasing the right to either buy or sell a certain asset at or before a specific date in the future at a price agreed today. The option buyer is not obligated to buy or sell the shares, but if he is making any profit in the contract, only then he will complete the trade. But the seller of the option is always obligated to buy or sell the underlying asset, whether he is making a profit or loss. For example, I have 100 shares of ABC company and you bought a call option of 100 shares. It means by doing this, you are purchasing the right to buy 100 shares of that company from me at a certain price, say $70. But you are not obligated to buy the shares. If the price of share rises up to $80 on expiration date of contract, you have the right to receive your profit amount from me, that is of $10 per share. And the total amount of profit is $1000 because the number of shares are 100. But if the price falls to $60, you are not obligated to suffer a loss of $1000. And from my side as a seller, if the price rises to $80, I will be obligated to give you $1000. But if stock falls to $60, you will not complete your trade and I will receive the premium amount that you gave me at the time of execution of trade. Also, I am having my shares with me. In this way, there is a great possibility of making big profits in option trading if we buy a contract. But it doesn't mean that we shouldn't sell the option. Selling options is very beneficial when we sell them at right place, and also there are different strategies in which we make a combinations of selling options to make profits. That we will see in the upcoming lectures.
Now let's take practical example. Currently, Facebook is moving in an uptrend and is trading at $164.62. Now, if your view is bullish for the stock and if you want to purchase 100 shares of Facebook, you will have to pay 164 multiply 100 is equal to $16,462. But if we see the options price of 165 call of Facebook Incorporation, see this is the option chain of Facebook. And if we take the expiration of 8th March, the current price of stock is 164.62 and the nearest strike is 165 strike. So if our view is bullish, we will see the price of call options. These are call option in the left side and in the right side these are put options. We will learn about the options chain and all these terms like expiration date and strike price later in the course, but currently just focus on this price. 165 call option price is $2.63 and it is the price for one share. It means if we want to buy call option of Facebook Incorporation, we have to pay only $263 for 100 shares. Now see the difference. When we are buying 100 shares of Facebook, we will pay $16,462, but if we buy one contract of call option, we will pay only $263. Now, if Facebook rises to $170 in the next few days, we will gain $500 because currently the stock is trading near $165. So, by investing $16,462, a profit of $500 will be only 3% return. But by investing $263, a profit of $500 will be 100% return. But in the next few days, if stock price falls to $160 from here, our net loss will be only $263. If we buy the call option of Facebook, that is the cost of call option contract. Whereas if we buy shares at $164.62, our virtual loss will be approximately $500. It means with option trading, when we buy option, if we are in profit, we have the right to realize the profit amount from the seller. But if we are in loss, we are not obligated to suffer that loss and let the options contract lapse. So this was a bullish scenario, but if we are bearish about the price movement of any stock, we can buy the put option of that stock. For example, this is 20th of February and CVS Health Corporation is trading at $64.22. Currently, the stock is moving in a sideways range, but as this was a gap down opening and this candle is trading near the lower band of this Bollinger Band, you can see Bollinger Band is expanding, so my view is bearish about the stock. So in a bearish scenario, we should buy the put option. But as Bollinger Band is moving in a sideways range, if there is a sharp fall in the prices because Bollinger Band is expanding and this was a gap down opening, then we can make good profit in put option. But if there is a sideways movement in the stock, we can lose our money in buying the put option. So we will take the next month expiry. This is 20th of February. We will see the expiration date of 15th March. So this is 15th March. Expiration date is 15th March and currently the stock is trading at $64.22. So the nearest strike are 64.5 and $64. 64 put option strike is trading at $1.46. So if we buy 64 put option, we will pay $146. So if on this expiration date stock closes below $64, then this strike will be in the money and we will make profit in this put option. So with option trading, we can make money in bearish scenario also, and if there is a fall in the prices, we can buy put option to make profit in downtrend also. Thanks for watching. I'll see you in the next lecture. Welcome back everyone. In this lecture, we will learn about features of options. There are 5 key features of an option contract: type of option, underlying share or security, strike or exercise date, expiry date or the expiration date, and premium. Let's understand these features one by one. First is types of option. There are 2 different types of options: call options and put options. A call option gives the buyer the right but not the obligation to buy a given quantity of the underlying asset at a given price on or before a given future date. It means a call option entitles the buyer to either seek delivery of shares from the seller if he so desires or let the call option lapse. The seller receives a sum of money for selling their rights to the buyer. As a buyer of call option, you are hoping for the value of the underlying stock to rise. An increase in the price of the stock will result in an increase in the value of your option. And the seller of the call option receives a premium for taking on the obligation to sell the underlying stock to the buyer of the option if the buyer decides to exercise the option before the expiration date. For example, you have the right to purchase the house before the expiration date, that is the 3 month in this case. But you are not obligated to buy it, whereas the seller is obligated to sell the house even if the house price increase. If the buyer doesn't exercise the option, the seller simply retains the premium and the obligation expires with the option on the expiration date. Same concept applies to put option. A put option gives the buyer the right but not the obligation to sell a given quantity of the underlying asset at a given price on or before a given date. It means a put option buyer is entitled to give delivery of shares to the seller if he is making profit or let the option lapse. The seller receives a sum of money for selling his rights to the buyer of the put option. A person buys a call option when he expects that prices of share will rise, and he buys the put option when he expects that the prices of the share will fall. So if the underlying asset is in downtrend and prices are falling down, in that case you can buy put option. It means you are purchasing the right to sell the stock at a given price, and
If stock price falls, you will make profit.
Options will always have an underlying asset associated with it. It can be anything from an agricultural commodity, interest rate, foreign currency, or shares of a listed company. When the underlying asset is share, then it is called an equity option. Generally, an equity option is linked to 100 shares outside the India. It means when purchasing a call option, you are purchasing the right to buy 100 shares of that company. In India, the quantity of shares for one call option is different for different shares. Now, in this case, the underlying asset was house, and in this example, the underlying asset is a stock of company ABC. Strike price. The strike price is also referred as the exercise price. This is the agreed price at which the option can be exercised. For example, in this case, the strike price is 100K, that is the price at which house can be bought. There are a range of strike price set for each option, and we can trade any strike out of all these strikes. How to choose different strikes for adopting any option strategy, that we will learn later in this course. The current price of the share is known as spot price, and the current price of option is known as strike price. Strike price can be high or low of the spot price. For example, in case 1, the price of house decreased to 90K from 100K, so the spot price is 90K, and in case 2, the spot price changes to 120K, but the strike price is 100K, that is the agreed price at which the option can be exercised. Expiration date. Every option has a limited life that is determined by the option expiry date. Expiration date is the last day on which the option can be traded and is the date on which all exercised options expire. Equity options expires on the Thursday before the last Friday of each month. In this example, the expiration date is 3 months. It means the contract is valid only up to 3 months. Weekly options have gained in popularity, but they are still not quite as actively traded as the traditional monthly options. Option premium is the cost or the price of the option that a buyer pays to the seller to have the right to buy or sell the underlying shares. For example, in the last example, you are buying a call option of ABC share of strike 70. For this, you have to pay a sum of $200 for entering the trade. Now, if stock rises to $80, your profit will be $1,000 because stock rises to 80 from 70 and the lot size is 100. But your net profit in this case will be $800 because you have paid $200 at the time of execution of the trade in the form of premium. So by deducting $200 from this amount, your net profit will be $800. But if stock price falls to $60, you are not obligated to suffer a loss of $1,000. You will let the option lapse and your only loss will be the premium you have paid at the execution of the trade, that you paid to enter the trade as premium amount, and that is also the cost of your call option. Now in this case, the option premium is $3, but to calculate the total premium of a particular option, you need to multiply it by the number of shares covered in one contract. So in this case, the total premium of call option is $300. So these were the 5 option features, and with these 5 features, an option contract can be written as this ABC January 45 call at $3, in which ABC is underlying stock, January is expiration month, 45 is strike price, call is type of option, and 3 is options premium. So this was all about options features. In the next lecture, we will learn about leverage. Thanks for watching. See you in the next lecture.
Leverage is the ability to gain exposure to an asset at a fraction of its value. For example, when you buy a call option, you pay a premium, but it is very small cost compared to the value of the underlying share. In doing so, you gain exposure to the underlying share and subsequent moves of the share price. We will take an example to understand this. Suppose you buy one call option of a stock ABC for a premium of $1 and the lot size of share is 100, so the total value of premium is $100 by multiplying the premium to the lot size. By doing this, you now have exposure to 100 ABC share. If the price of share increases by $10, the price of the option will also increase by $10. As the lot size is 100, multiplying it by the profit amount, we get a total profit of $1,000. But we paid $100 for the premium, so the net profit is $900. So by investing $100, we get a $900 profit and it is a return of 900%. If, however, you had just purchased the share of ABC company at a price of $100 and then sold them at $110 per share, as the lot size is 100, multiplying them to 100, the purchase price of 100 ABC share is $10,000 and selling price is $11,000. So, you get a profit of $1,000 on an investment of $10,000 and it is a return of just 10%. In the risk side, the maximum loss can be the amount of net premium paid if stock price falls instead of rising. Leverage ratio is an important concept used to tell you the amount of exposure you have. This can be calculated by dividing the price of the option contract, that is premium, by the current stock's price. If the premium for a call option is $1 and the current stock price is $100, then the leverage ratio is equal to 100 by 1 is equal to 100:1. This means that if you were to consider investing equal portions of money into purchasing shares, you would gain 100 times more exposure when investing in option contract. This was all about the options features. In the next lecture, we will learn about option pricing. Thanks for watching the lecture.
Now let's understand the other terms. Currently Facebook is trading at 164.62. So this price is the spot price and this is the options chain for Facebook Incorporation. In the options chain, in the left side we have call option strikes and in the right side we have put option strikes. Today is 26th of February and the expiration date is 8th March. It means this option contract is valid up to 8 March. After 8 March, after this expiration date, the option contract will be invalid. So if we are purchasing the call option, it will be valid up to 8 March and in this time period, if we are in profit, we can realize the amount, but after the expiration date, we have no right to realize the profit. So the current stock price is the spot price and these all are the strike price. For this spot price, 165 strike price is the nearest strike price and this is called at the money option. In call option, this 165 strike price will be at the money call option and these are the put options. The nearest put option is 162.50 rupees. So 162.50 rupees put option is referred as near the money option. When we are buying 165 strike call option, because we are buying this call option, we will see the ask price. If we sell this call option, we will see the bid price. When to sell call option or put option, that we will learn later in the course. But currently we are analyzing the options chain and the options feature. So these all are the prices of these strikes. If we buy 170 call option, then its price is 0.83 rupees and it is called the premium. It means if stock rises and closes above $170, we will make profit, otherwise we will lose this premium and we will not realize any gain in this contract. To make profit in this strike, the stock has to close above $170 in the next few days up to 8th of March. That's why the premium of 170 strike is very low as compared to the premium that we are paying for 165 strike. So from the features of options contract, we have two types of options contract, calls and puts. In the left side we have call strikes and in the right side we have put strikes. Second features of option contract is the underlying share. So this is the options chain of Facebook Incorporation. So in this case Facebook is acting as the underlying share. The next feature is the exercise date. Exercise date is the expiration date up to which the options contract is valid. There are different strikes for the current price. The current stock price is $164.62. For this current price, we have different strikes for call options as well as for put options. For example, for this current price, we can buy 165 call option that is trading at $2.63. 167.50 call strike is trading at $1.53. 170 strike is trading at $0.83. So we can buy any strike. Similarly, when we buy put option, for this stock price there are different strike price. We can buy 160 put option that is trading at $1.11. We can buy other strikes and this price for each strike is called the premium. When we buy 165 strike, we are paying $2.63 for one share. It means in this contract, we are paying $263 for purchasing the right to buy 100 shares of Facebook Incorporation and it is called the premium. So this was all about the options feature. Thanks for watching the lecture.
In this lecture, we are going to discuss what is option selling. Many people have more difficulty in understanding the concept because the process involves selling first and then buying later to close the position. In our previous example of house, the concept of buying and selling was very simple because the owner of the house owns the underlying asset, that is the house. But when we sell options, we do not own the underlying asset. Now, when you buy a call option, you are buying the right to buy 100 shares of that stock. But as an option seller, you are paid a premium for granting that right to the buyer. In receiving this premium, you are then obligated to deliver the shares at a strike price if the buyer exercises the option. But an option seller also required to pay margins. Margin is the mechanism by which options gain leverage. Margin is the amount of cash an option seller is required to deposit and maintain to cover his position as collateral. An option writer is required to pay two types of margin: initial margin and maintenance margin. Initial margin is the amount required when a position is opened, and maintenance margin is the amount that must be maintained on deposit after a position is opened if an option writer suffers a loss. A margin call is created from a brokerage firm to bring margin deposits up to initial levels. The minimum initial margin requirement for an equity option varies from broker to broker. As an option seller, you are generally speculating that the price of stock will move in opposite direction that will result in options decreasing in value and ultimately expiring worthless. This will allow you to retain the option premium as profit. But if you are wrong, you may need to close out your position at a loss as option may be exercised. And if market moves strongly against your position, your risk of loss can be significant. Now most people get confused here that if an option writer is suffering a loss in case prices are moving in upward direction, a call option will suffer a loss, and if he is suffering a loss, he is required to continue the position until the expiration date. No, when you enter into a short position, you are not required to continue the position until the expiration date. You can close the position at any time before the expiration date by buying that option at higher price. So, as an option buyer, your loss is limited to the premium, but as an option seller, your loss can be unlimited. That's why I never suggest to sell naked options. For a naked option seller, the risk is unlimited because there is no limitation on how high or low a stock can rise or fall.
But selling options are very beneficial if we use them at right place. How to use option writing, that we will learn later in the course. In the next lecture, we will learn about futures. Welcome back to our next lecture. Derivatives basically consist of two key products, that are futures and options. Both are commonly used trading tool, and trading either of them is little more complicated than simply buying stock. If we use correctly, they both offer plenty of opportunities for making money in stock market. They both are widely used to benefit from leverage. Options and futures are often confused with each other, but they are actually very different from each other. Those who don't fully understand how they differ from each other can make big mistakes in stock trading. So, in this lecture, we will know about some similarities and difference between the two and learn why options trading is better than futures. So, let's have a look at the similarities and difference between the two. A future is a right and obligation to buy or sell an underlying asset at a predetermined price and time. And an option is a right without an obligation to buy or sell an underlying asset. Both futures and options are products that derive their values from the value of underlying asset. They both are the financial contracts that exist between two parties, the buyers and the sellers, and both are the leverage derivatives. Now the fundamental difference between the options and the future is in the obligation of the parties involved. As we know, in option trading, the buyer of an option has the right to buy or sell an asset at a fixed price but not the obligation. And an option seller always have an obligation. But in a future contract, both the parties, whether buyer or seller, are obliged to fulfill the terms of contract. This is the main difference between options and future. Therefore, buying a future is more riskier than buying options, because while buying options, we have the risk of premium only. But with futures, if we buy a future and stock price falls, we are obligated to suffer that loss. Now, in case of selling, when we sell options, the seller of the option receives the money that the buyer pays. But with futures, seller receives no money at the time of initiation of the trade. Both buyer and seller are required to have a certain amount of margin on hand. Unlike an option buyer, in futures, a trader has to pay a required margin amount, approximately 20% of full value, and he may also be required to top up that margin if the underlying security moves against him. But the option buyer owns the contract outright, so no further fund will be required from him. This is the main reason why future trading is generally riskier than option trading. Now let's discuss the advantages of options over futures. When trading futures, you are potentially exposed to big losses whichever side of contract you are on if the security moves against you. But in buying options, you can lose your initial investment only. When you are an option writer, you are exposed to similar risks. Assume that you want to buy a stock ABC that is trading at $30. So if you buy 100 shares of ABC, you need to pay $3,000. But if you want to buy one lot of ABC future, you only have to pay the margin, which is around 20% of full value depending on your broker. It means your profit will be 5 times that of when you are invested in equities, but unlike the case of options, your loss could also be 5-fold. And that is the biggest disadvantage of trading futures. Now in this case, the premium of the call option is only $3. So if stock price falls, the only loss in this case will be $300. The other advantage of options over future is that with options you can adopt a number of strategies and create spreads that can enable you to profit from multi-directional price movement. But with future contracts, you can only make money from the security moving in the right direction for you. So these were some similarities and difference between options and futures. In this course, we will learn about options only, and we will learn about different strategies that we can adopt with options trading. See you in the next lecture. Thanks for watching.
Hello everyone, in this lecture we will learn about the option pricing. Options are totally separate entities to the underlying asset from which they derived. but they have a value that can be split into two parts. First is intrinsic value and second is time value. So the option price is equal to intrinsic value plus time value. Intrinsic value of an option is based on the positive difference between the option strike price and the current price, that is spot price, of the underlying share. A call option has intrinsic value if the spot price is greater than the strike price, and a put option has intrinsic value if the spot price is less than the strike price. An option contract cannot have a negative intrinsic value. If the spot price is less than the strike price of a call option, its value will be 0 instead of negative. In our last example, if the strike price of the call option was $65 and if the spot price is $70, the intrinsic value of the option contract is 70 minus 65 is equal to $5. And the $5 represents the value of the call option, means it is the amount that can be realized if the contract is to be exercised. Time value of an option is the difference between its premium and its intrinsic value. Both call and puts have only time value. As the name suggests, it is based on the amount of time the option contract has left before it expires. The longer the time to expiration, the greater is an option's time value. It decreases the closer a contract gets to expiry. So, on expiration date, there is no time value and the entire premium is made of intrinsic value. So, the call option time value is call premium minus call intrinsic value, and put option time value is equal to put premium minus intrinsic value. We will take an example to understand this. Suppose a call strike price is 50 and the shares price, that is the spot price, is 55 and call premium is $6. The time of expiration is 1 month. Intrinsic value of call will be spot price minus strike price is equal to 55 minus 50 is equal to $5. And the time value of call is equal to call premium minus call intrinsic value. Call premium is $6 and call intrinsic value is $5. So the time value of call will be $1. Similarly, if put strike price is 50, stock's current price is 45 and put premium is $6, put's intrinsic value will be strike price minus spot price is equal to 50 minus 45 is equal to $5. And put's time value will be put's premium minus put's intrinsic value, that is 6 minus 5 is equal to $1. There are three terms associated with options: in the money, out of money, and at the money. An call option is in the money if the contract has intrinsic value and share price is greater than the strike price. An option is at the money if the strike price is equal to the spot price. And an option is out of the money if the share price is less than the strike price of an option. In case of put options, the terms are opposite to that of a call option. This was all about the option pricing. Thanks for watching the lecture. In this lecture, we will understand about the moneyness of the options. Moneyness tells us about the relationship between the underlying asset price and the strike price of the option. It is one of the easiest and important concepts in option trading. There are three main types of options that are used to describe the moneyness of an option contract: in the money options, at the money options, and out of the money options. There is always a gap between the strike price of an option and the spot price of the underlying security. This gap can be zero, in upside or in downside. Based on this gap, we can understand the moneyness of the option. Suppose the spot price of a stock is $50, it means it is currently trading in the market at $50. If the option strike price is equal to the stock's current price, it is called at the money call option. As we know, option has two components: intrinsic value and time value. The intrinsic value for at the money options is 0 and is made up of completely the time value component. If option price is greater than the stock's current price, it is called out of the money option. Out of the money option also have no intrinsic value and have only the time value, but they are the cheapest options to buy. If option strike price is less than the current spot price of the stock, it is called in the money call options. They are typically the most expensive options, and the intrinsic value of these options always have a value that is the difference between spot price and the strike price. Moneyness of put options is just opposite the call options. It means if call option is in the money and the option price is lower than the stock price, the put option of that strike will be out of the money. And if call option is out of the money, the put option of that strike will be in the money. Because the direction of making profits for call and puts are just opposite to each other. There are some more types of moneyness that are deep in the money, deep out of the money, and near the money options. The strikes that are very near to stock's current price are called near the money options, and the option strikes that are very far from stock's current price is known as deep in the money and deep out of the money options. Similarly, for put options, the distance is very far from the stock's current price, and these are the deep out of the money and deep in the money options. Understanding moneyness of the option is very important. Every option strategy that we will understand in this course has these forms and requires the knowledge of moneyness. Whether it is a simple strategy like long call or long put, or it is a complex strategy that involves buying and selling options simultaneously. So, if you don't have an idea of moneyness, it's all too easy to make mistakes in buying and selling options. This is the open chain of Nifty, and you can see the left upper half strikes are of yellow color and the right lower half is of yellow color. Currently Nifty is trading at 10,633 levels, so all call strikes that are lower than 10,063 levels are of yellow color and they are in the money call options. And all strikes that are greater than 10,633 level are of white color and they are out of the money call options. There is no strike of the Nifty's current level, so 10,600 and 10,650 strikes are near the money call options. On the right side, moneyness of put option is just opposite to the call option. The strikes that are greater than Nifty's spot level are in the money and they are shaded in yellow color, and the strikes that are lower than Nifty's current level are of white color and they are out of the money put options. I think now the concept of moneyness is very clear to all of you, as I am going to use these terms in this course many times.
Welcome back. Now this is 7th of March and this was the previous day's closing. The stock has closed at 172.5 rupees. In our previous example, Facebook was trading at 164.62 rupees and the nearest strike of this price was 165 strike. The price of 165 call option was $2.63 and the total cost of this contract was $263. But now Facebook is trading at $172.5 and 165 call option is trading at $7.70. It means by paying $263 now we are getting $7.70. So it is approximately 200% return in 2 weeks, and at that time the stock price was $164.62. The 165 strike was at the money strike and now the stock price is $172.51. So 165 strike price is in the money because now stock price is greater than the call strike price. At that time 170 call strike was trading at $0.83. It means the cost of this call option strike was only $83 for 100 shares, and now 170 call option is trading at $3. It means by paying $83 now we are getting $305. At that time 170 call option was out of the money call option because strike price was above the stock price. But now stock price is 172.5, so 170 call option is in the money call option. So here 165 call option is deep in the money and 170 call option is in the money call option. My view was bullish about the stock because this was the downtrend line of Facebook and now stock was in uptrend, and these three Fibonacci clusters are acting as strong support and resistance zones. So here at this candle there was a consolidation in the prices. Prices are taking support at this zone and now it is a very sharp move in the stock, and currently it is trading at $172.5 from $165. Similarly, it was a gap down opening in CVS and it was trading at $64.22, but now it is trading at $54. So the strike price was $64.22 and the nearest strike was 64 strike. As the view was bearish, so we should buy the put option, and 64 put option was trading at $1.46. But now if we see the current price of CVS, currently the stock is trading at $54, and see this was a sharp fall in the stock, and this is 7th of March. The expiration date of CVS was 15th of March. See, the expiration date is 15th of March, and now in this options chain 64 strike is not present because 64 strike is now deep in the money strike. You can see 62.5 strike is trading at $8.50. So 64 strike is trading at $10.50. So in a bearish scenario, we paid only $146 for buying a put option of 64 strike, and now we are getting $1,050 for this put option strike. So with option trading we can make good profit, but for this we should analyze the chart and we should find the right direction of the prices. So these two are the most basic strategies of options trading, and in the course we will learn about the various options trading strategies by combining these two basic strategies, and this all we will learn later in the course.
Welcome again. In this lecture we will learn how to read options chain. Options chain is a way to quote options prices having different strikes in a list. This long list has all the put and call strikes along with their prices and other informations for a given expiry. Options chain have two sections, the left half for call and the right half for put options. In the center, a list of strike prices of option contract is displayed. This is the options chain of Nifty 50 and the expiration date is 26th of July. We can change the expiration date. We can select the August expiry and the September expiry, but the current month is July, so we will select the July expiry. So these are the calls and these are the put options. These are the various strike prices. As you can see, currently Nifty is trading at 10,960. So 11,000 is the nearest option to 10,960. So it is assumed as at the money option, and the yellow strikes are the in the money option and the white region shows the out of the money options. These are the put options. So yellow portion shows the strikes that are the in the money put options and the white portion is showing the strikes that are out of the money put options. LTP shows the last traded price. All the options are not traded every day. So the price at which it was traded last is listed here. For example, these options are not traded today, so there is no LTP, and for put options, these put options are not traded today. This column is the net change and this is the difference between the closing price of the security and the previous day's closing price. It can be negative or positive. See here, for put options, this net change is negative and here the net change is green and this is positive. It means today change in Nifty is 0.46%, so the put options are active and these put options are in profit, and the column shows the net change in the strike. For example, the net change in 10,900 put strike is 8.20 and this is positive. It means the price of 10,900 put option has increased by 8.20 today. These two columns shows the ask price and bid price. Ask price is the offering price at which the option contract are made available for purchase. It means if we want to buy and call option, we will see ask price, and if we want to sell call option, we will see bid price. Similarly, if we want to buy put option, we will see the ask price of put option in the right side, and if we want to sell a put option, we will see the bid price. Bid quantity is the total quantity of current number of buy orders in the system, and the ask quantity is the current number of sell order quantity. Volume is the total number of contracts traded on the present day. It is always positive and starts from 0 at the start of the day and increments as when new trades occur. A good volume means good liquidity in the market. Open interest lists the number of open positions for a particular strike price that are live in the market. Volume and open interest are two different things, but have similar set of information. Volume data always increases on an intraday basis, but open interest is not discrete like volume. Open interest increases or decreases based on entry and exit of trades. Open interest also gives us idea about the support and resistance level. For example, we can see that 11,000 call option have the greatest open interest for this expiry, and the 10,600 put option is having the greatest open interest. Put options gives us an idea about the support level, and call option gives us an idea about the resistance level. As we know, when a support level is penetrated below, it becomes a new resistance level, and when a resistance level is penetrated, it becomes a new support level. So we should always see the second highest open interest in the strikes, and if we see the second highest open interest in the put option, this 10,800 put option is having the second highest open interest, and 11,100 call option is having the second highest open interest. So we can expect a range between 11,100 and 10,800 for this expiry. We can also see that 10,600 put options open interest is decreased today, but 10,800 put option open interest is increased today. And we can also see that the open interest for the call option, these two call options, has increased today. So if Nifty reaches 10,800 level, we should buy the call options for Nifty. The last column is of implied volatility column, and we will discuss about implied volatility later in this course, but now see here that the implied volatility increases for the out of the money options. This white portion options are the out of the money call options, and implied volatility increases for the out of the money call options and also for out of the money put options. When implied volatility increases, it means premium is also increasing. So we should always sell out of the money options, and we should not sell in the money and at the money option strikes, because the implied volatility for those options is very low. So the implied volatility for these out of the money call options is very high, and the chances for these call options to be in the money are very low. We can sell these call options. And also implied volatility for these put options are very high, so we can sell these put options. So in this way we can read the options chain of any stock or an index, and this is very helpful for us if we trade in options.
Welcome to our next lecture, in which we will learn how to draw your payoff diagrams. Risk profile charts is a useful way to know the expected return from a given asset. Risk profile chart is also known as payoff diagrams. It simply graphs the relationship between a change in the value of an asset
with the resulting expected profit or loss from the change in value. The horizontal x-axis represents the current price or spot price of the stock, and the vertical y-axis represents an investor expected profit or loss from his option contract. The price of an asset is linear, and if its value rises, profit rises by a proportionate amount. This is the risk profile chart of buying an asset. Suppose the spot price is $100. If the spot price rises from $100 to $110, then you will have a profit of $10. And if price falls from $100 to $90, then you will have a loss of $10. In this way, we can easily understand from this chart, as the asset price rises, you start to make profit, and as price falls, you start to lose money. Now that you know what buying an asset looks like, you can move straight on to what shorting an asset looks like. Shorting simply means selling something that you don't already own. Remember that when you short, you can lose an unlimited amount as the asset price rises. To make maximum profit from a short stock position, the asset would have to fall in its price. In this chart, suppose the spot price or current price of the stock is $100. As the asset price falls to $90, you will start to make profit. And as price rises from $100 to $110, you start to lose money. In this way, we can clearly see that the risk profile chart of shorting an asset is just opposite to the risk profile chart of buying an asset. If we buy an asset, when price rises, we make profit, and when price falls, we will lose money. And if we short an asset, when price rises, we will lose money, and when price falls, we will make money as our profit amount. So the risk profile charts are very useful for us to know the profit or loss amount. In the next lecture, we will learn how to draw the risk profile charts for options. Thanks for watching the lecture. Welcome again. Now we will learn the risk profile chart of 4 basic strategies of option trading. The 4 basic strategies of option trading are: buy a call, that is long call; sell a call, that is short call; buy a put, that is long put; and sell a put, that is short put. First of all, we will understand the long call strategy. When we are bullish on the underlying stock price, we use this strategy. Profit increases as the price increases above break-even point. This is the break-even point, and break-even point is the point when share price is equal to the strike price plus the value of the premium paid. The value of premium paid is denoted by A and the strike price is B, then our break-even point is C. Loss is limited to the value of the premium paid to the writer of the option contract, and profit is unlimited. When price rises, we get our maximum profit. We will take an example. Let the stock price is $50 and we paid a call premium of $6 to execute a long call strategy. The strike price is $45. When the stock price remains less than $45, the maximum loss on the trade is $6. If the price is less than 45, our maximum loss is $6. And as the stock price rises above $45, the buyer of the call begins to move into profit. But he also paid a call premium of $6, so the break-even point is 45 plus 6 is equal to $51. And a stock price rises above $51, the buyer of the call will start to get profit. So in this strategy, the loss is capped to $6, and as the stock price rises, we can get an unlimited profit. The second basic strategy is short call. It means we are selling a call option. When you are bearish on the underlying asset, you can sell a call option. Profit is limited to the net premium paid, is denoted by A, and the break-even point is strike price plus premium paid. The break-even point is denoted by C and the strike price is denoted by B. This is the opposite strategy to a long call. You receive a premium from buyer shown by distance A, and this is the maximum profit you can gain. In this strategy, loss can be unlimited when stock price rises, so we should always employ a stop loss above the break-even point to minimize our risk. Suppose the stock price is $50 and we are selling a call option at strike price $45. The call premium is $6 that we received for selling a call option. So our maximum profit in this strategy is $6 and our maximum loss can be unlimited if stock price rises above $51. As the stock price falls below $45, the seller of the call option makes his maximum profit, which is the premium received for selling the option. Since he has already been paid a premium of $6, the break-even point is 45 plus $6. And the loss can be unlimited as price rises above $51, so we will always employ a stop loss above $51. Our third basic strategy is long put strategy, and in this strategy we will buy a put option. When we are bearish about the stock prices, we can buy the put option. If the price rises, the maximum loss is limited to the value of the premium paid denoted by A, and our profit is unlimited in falling price. When price falls below the strike price denoted by B, we can gain a unlimited profit. The break-even point is strike price minus premium paid. Strike price is B and our premium paid is A. So, if we subtract the premium paid to the strike price, we get our break-even point. When buying a put option, we pay a premium represented by A, and this is the maximum loss for this strategy. When price falls beyond point C, we would likely to get profit, and it can be unlimited at price falls. Let the stock price is $50 and we are buying a put option at $55 strike price. The premium paid for this strategy is $6. As stock price falls below $55, the buyer of the put option begins to move into profit from loss. However, he also has to recover the price of the put he paid for $6, so the break-even point is 55 minus $6, that is $49. While the stock price is greater than $55, the maximum loss on the trade is capped to the premium paid, that is $6. And when price starts to fall beyond $49, the buyer of the put option starts getting in profit. So this is a strategy to be adopted in falling prices and in bearish environment. The fourth basic strategy is short put strategy, in which we will sell a put option. When we are slightly bullish on the price, we can sell put option. Profit is limited to the premium received, that is denoted by A, and loss can be unlimited in falling markets. So, we should always employ a stop loss slightly below the break-even point. Break-even point in this strategy is strike price minus premium received. The strike price is denoted by B and the break-even point is denoted by C. When selling put options, the opposite payoff occurs compared with buying a put. We receive the premium A, which is the maximum profit potential for this strategy. When the strike price falls below the break-even point, then we start to make loss. Let the stock price is $50 and the strike price is $55 for the short put option strategy. For this, we are receiving a $6 premium. As the stock price rises to $55, the writer of the put option makes his maximum profit, which is the price received for selling the option. Since he has already been paid $6 for selling the option, so the break-even point is 55 minus $6, that is $49. It means the stock price falls below the break-even point, he starts to make loss instead of profit, which can be unlimited, so we will always employ a stop loss slightly below this break-even point, this $49. Now in the course we will learn how to adopt different option strategies by taking help of technical analysis and how to choose your strategies so that you can maximize the profit amount and minimize your risk. You will learn how to cap your losses by employing stop loss at right level and how to make your own strategies in which you can make different combinations of these four basic strategies. Thanks for watching the lecture. Hello everyone. Till now we have learned about the four basic risk profile charts and you need to remember those for making different strategies. If you just remember these four option risk profile and comfortable with the logic behind them, you will be ready to look at spreads and combinations very easily. Remember your basic math at school. Plus plus is plus, plus minus is minus, minus plus is minus, and minus minus is plus. Now think, buy something as plus sign, selling something as negative sign, call option means positive sign, and put option means negative sign. Now for first strategy, that is buying call. Plus for buying and plus for call. So plus plus is plus and plus means bullish market. It means in a long call strategy we make profit when price rises or market is bullish. Our second strategy is selling a call, minus for sell and plus for call. As minus plus is minus, it means we get profit in this strategy when prices fall or remain stagnant. Third strategy is buying put, plus for buy and minus for put. As plus minus is minus, it means we get profit in this strategy when price fall. Our fourth strategy is selling a put, minus for selling and minus for put. So minus minus is plus, it means we will be in profit when price rises or remains stagnant. Now you are familiar with these four basic strategies. You can combine them to create new strategies that we will learn later in this course. Thanks for watching the lecture.
Now in this lecture we will learn what is trend and understand how market respond with trend. The price chart of a security may appear like a random distribution, but this is not so. Market always moves with the trend unless any external force pushes it in the opposite direction. A simple definition of trend is the general direction of price movements on a specified time. Technical analysis is mainly based on demand and supply. If demand exceeds supply, the price will rise, and if supply exceeds demand, the price will fall. We can see these rise and fall movements on a price chart, and the overall direction of these rise and fall movements makes a trend for the prices. On the chart, these rise and falls are seen in the form of peak and trough. Each high is known as the peak or top of the swing, and each low is known as the trough or bottom of the swing. So these are the various peaks or tops, and these are the troughs or bottoms of the trend. Trends are generally of three types: uptrend, downtrend, and sideways trend. In an uptrend, peaks and troughs are higher and higher. Each top is higher than the previous one, and each bottom is higher than the previous one. Again, this is the next top and it is higher than the previous top, and this is the next bottom and this is higher than this level, this bottom. So, in an uptrend, we get higher tops and higher bottoms. Here demand exceeds supply and makes the prices move higher and higher, and we say that the market is bullish. In the uptrend we should buy because the trend pushes the price higher and higher and we make more and more profit. In a downtrend there are successive lower peaks and troughs. This is the top and this is the bottom. Again this is the top and this is the bottom. But we can see this is the downtrend and each top is lower than the previous one, and each bottom is lower than the previous one. So this top is also lower than this top, so this is also the lower top, and this bottom is lower than this bottom, so this is the lower bottom. So in a downtrend we get lower tops and lower bottoms. Here supply is more than the demand and we say that it is a bear phase. The prices move down lower and lower and we can't make profit by buying stocks in a downtrend. Instead, we should withdraw from our position at the starting of the downtrend and end of the uptrend. In downtrend also we can make money by trading, but this is possible in derivative markets only. We can sell futures and options of this stock or an index and make profit even in declining phase of the market. Besides uptrend and downtrend, there is one more trend, that is the sideways trend, or we can say that market is ranging or trendless. Here demand and supply are in balance and price movement confined between a range. These are horizontal trends and there is little movement up and down. We shouldn't trade when the trend is flat and market is in sideways trend. However, if the confined range is wide, we can take advantage of this range by buying at the bottom of the range and selling at the top of the range. In addition to the direction, trend is also defined in terms of their length. That we will learn in the next lecture. Thanks for watching the lecture.
Welcome back. In the last module, we have learned about the trend concept and understood how market move accordingly to the trend. But do same trend continues all the time? Or if it gets changed, how do we know about it? It is true that market always respond in accordance with trend, and trend keeps on changing after some period of time. It can be for years, months, days or hours, and it can be for minutes also. When the direction changes, the movement in the trend can be analyzed with the help of trend lines. Trend line is the most important tool of technical analysis. On the price chart, while joining all the lows in the uptrend and all the peaks in the downtrend, we get a trend line. If we get 2 points, then we can join with the trend line, and if we get third point on this trend line, this will be the confirmation of the trend. Here you can see we are joining the lows of the trend and it is an example of uptrend. We are getting 1, 2, 3 and 4. We are getting 4 points on this trend line and the third point is the confirmation of the uptrend. In this example, we are joining the peaks because it is the example of downtrend. So we are joining peaks. These are the two peaks. We will join the peaks and we are also getting third point on this trend line. So this is the confirmation of the downtrend. This is the confirmed downtrend line. Trend line tells us a lot about the trend. As we have seen, trend line confirms the trend and we can make maximum profit by trading in that particular direction. It is very risky to trade in opposite direction and we have to suffer loss most of the time. So if we want to trade in counter trend direction, first we should learn complete technical analysis and know about all the tools and indicators. This is an example of uptrend line. This is the uptrend and we are joining 2 points of this uptrend. Then you can see we are getting third, fourth and fifth point on this uptrend line. So this is a confirmed uptrend. As it is an uptrend, we will buy every time when we get a point on the trend line. But we will not sell here because it is very risky. It is a counter trend direction. We will buy only in uptrend and in downtrend we will only sell. Here you can see if we sell here, it is not necessary that this will come to the trend line. So it is very risky to trade in counter trend direction. Trend line tells us where the retracement or profit booking should stop and when the price will run again in its trend. In this chart, prices are rising up hence in uptrend and from this point they start falling down, but we cannot regard it as a reversal because this was just a retracement. They only come down to the extent of trend line and from there go back to the uptrend. This gives us opportunity to buy at the point touching the trend line and sell at the peak point. We will buy here and sell at the peak point. Similarly, we can buy here because it is touching the trend line and exit here. By doing this, the maximum part of profit will be in our portion without keeping our time and money invested in the consolidation phase. This is the consolidation phase. So if we buy here, we can exit here easily. It is only trend line which tells us that trend is changing. Whenever price crosses the trend line, it indicates the beginning of the new trend. But it's not necessary that the new trend is always a reversal. It can be a continuation, can be a reversal, or it can be a sideways trend. As you can see in this chart, this is an uptrend line and this is an example of uptrend. Prices retrace up to the trend line and they crosses down the trend line. Then the new trend, we get a new trend line that is also an uptrend line. We get a breakout here. This is the breakout when price is crossing down the trend line and we can easily see Once a breakout is witnessed, the prices tend to come back to touch the trend line, but fail to go back to its previous trend, and we get a new trend. In this chart, new trend is also an uptrend. In this example, the prices are in uptrend, then they crosses down the trend line and they are coming to touch the trend line, but fails to go in previous trend and new trend. We are getting a new trend, and this is a downtrend. You can see this is a downtrend. This is a downtrend line. And this is another example. This is an uptrend line, and then prices are moving in sideways trend. They are not moving in uptrend or downtrend. They are moving in a confined range between a resistance and support line, and they are in a sideways trend. In this way, trend line gives us a clear picture about the market. This was all about the trend and trend lines. Thanks for watching the lecture. Support and resistance is the basic tool of technical analysis and tells us about the range of the stock within a particular time frame. When particular level is respected many times by price, it becomes a support level. And when price of a stock fails to cross a particular level, many times it becomes a resistance level. By observing carefully on chart, we can easily find out support and resistance level. The more times the level is touched, greater the importance of that level. As we have learned earlier, prices shift with demand and supply. Price rise with demand and fall with supply. When demand is strong enough to prevent the price from declining further, that level becomes the support level. At this point, demand overcomes supply when a stock supports at a level many times, forms a support zone which is not easily broken. This is a support zone because price is touching this support line 3 times. When selling occurs repeatedly at a particular level, resistance forms at that price level. Resistance level also is not easily broken unless market is bullish. When a resistance level is broken, that level becomes a support level. Similarly, when a support level is broken, that becomes a resistance level. Here, this is a resistance line and now prices are moving up. So, this resistance level is now support level for prices. Here, this is a support level for prices coming down, and when we have a breakout here, prices are moving down this support level. Now, for prices, this level is now new resistance level. One thing to consider here is that the longer price trade within our area, greater the opportunity for prices to penetrate the level. It means when a stock touches the resistance or support level many times, then we are getting an opportunity to penetrate that level easily. Support and resistance can either be static or dynamic. Any type of support or resistance line that do not change would be considered static support and resistance level. They are fixed level and do not change over time. For example, Fibonacci levels, trend lines, round number and psychological levels are some static support and resistance level examples. But price level doesn't trade in static world only. Price rise or fall in real time, breaking out the key support level and resistance level. Often times making new highs and lows where there is no history because price has never been there. This is where dynamic support and resistance level comes in, as they evolve in real time and tends to change with the price changes. Moving averages and price channel are the example of dynamic support and resistance level. In this chart, we can see this is a Fibonacci tool and prices are taking support on this 61.8% level. Now this is a support level and again prices take support on this level and tends to go in bullish trend. Now this is a new swing, so we will set Fibonacci tool for this swing. Now this is a support level 61.8%. Now prices are making new highs, so We are not sure about the new resistance level, but Fibonacci is giving a 1.618 level is the resistance level here. So they are the fixed or static resistance and support level. This is an example of rounding figure support and resistance level. You can see prices are going up and they are taking support on 7,000 level. 7,000 is a psychological support level. Now prices are going up and 9,000 level. They are touching now 9,000 level and making a resistance level here. Then they take support on 8,000 level. This is the rounding figure support level. Here prices touch the 9,000 level 2 times. So 9,000 level is acting as a resistance level here. Now we are getting a breakout at this level and prices are going in upward direction in bullish trend. This is the weekly chart of Microsoft Corporation and we can see here $24 is acting as a strong support level and there also prices are taking support on this level because this is now a psychological level. This is a fixed support level. Again prices are here taking resistance at this level. This is $31 and now here it is also acting as a resistance level for the prices. This $31 is now resistance level. You can see after penetrating this resistance level, it is now acting as a support level. This is a psychological support and resistance level. When prices are going higher and higher, they take support on trend line. So trend line is acting as a dynamic support level here. You can see this is a support level and it keeps on changing when prices are going higher and higher, but they also taking support on this line. In downtrend, trend line is acting as a resistance line for the prices. So prices are going lower and lower and trend line is also going lower with the prices. Trend line is acting as a resistance line for prices and after touching the trend line, prices are going again in a bullish trend. Moving average is an example of dynamic support and resistance level. In bull trend, moving average is acting as a support line. You can see every time prices touch this support line and then go back in the bull trend. Here this is a 15-minute chart and you can see 15-period moving average is acting as a support line for prices and in downtrend this moving average is acting as a resistance line. This keeps on changing with a change in price, so it is an example of dynamic support and resistance level. Price channel are one more example of dynamic support and resistance level. We can see this is a bearish trend and prices are going lower and lower and this is the price channel. This is a resistance line and this is a support line. Price channel is also going down with the prices and in this bullish trend price channel is going upward with the change in prices. So they are acting as a dynamic support and resistance level. In this way, support and resistance level is a very useful tool in trading and we can master on this to finding these levels when we carefully observe the chart. I'll see you in the next lecture. Thanks for watching. RSI is a popular and widely used indicator. RSI is a price following oscillator and as the name indicates, it measures the relative strength of the stock. Most analysts use RSI amongst other set of indicators they use and it is one of my favorite indicators. RSI oscillates between 0 and 100 level. Its important level are 70, 60, 50, 40 and 30. 14-day RSI is a popular one. It is mainly used for checking momentum and oversold overbought range. Here one important thing to remember is that use of RSI in ranging market is different and in trending market is different. So before analyzing a chart based on RSI, first we must get clarity on the trend in place or whether the market is in range or not. If we make mistake in doing this, we will make mistake in interpreting that particular indicator. RSI is used to know overbought and oversold levels that emerge in short-term cycle of a long-term trending market. When RSI is above 70 levels, the stock is considered overbought, and when RSI is below 30 levels, the stock is considered as oversold. RSI tells us whether the stock is uptrending or trending down. When RSI remains above 50, the stock shows overall bullish trend, and when RSI remains below 50, the stock is in bearish trend. RSI helps us to take early entry and exit by showing divergence signal that happen between RSI and price. When RSI after going below 30 levels manages to give a positive breakout above 30 level, one can initiate a buy position. And when RSI breaks below 70 after retracing from above 70 levels, one should exit from a trade. RSI is used to know momentum. Though not primarily designed for it, RSI can indicate increase in momentum in trending market by remaining above or below certain levels for longer period. In ranging market, when RSI goes below 30 and takes support at 30, it gives an opportunity to buy. But in trending market, one must not make haste and try to buy the bottoms, and RSI can remain below 30 level for a long period. In this situation, we do not get chance to exit on rise and we can get stuck in a position for long time. We must never buy or sell based on illusion that the stock is available cheap. When RSI remains below 30, bottoms can be established at a lot lower level than our expectation. Now we will take an example and understand how RSI helps us in trading. This is the hourly chart of Nifty, and here are so many uptrends and downtrends. This is uptrend. We are getting a trend line here. Now see, RSI is in oversold range and now it crosses above 30 level. Now it crosses above 50 level. This is a confirmation signal. We will buy here. We will make our buy position here. This is our buying position. Now RSI is going to overbought range. This is the overbought range and this is the oversold range. Below 30 is oversold and below 70 is overbought range. RSI is going in overbought range, and when RSI crosses down this 70 level, then we will exit from our buying position. We will buy here and exit here. Again, when RSI is crossing above 50 level, this is the 50 level, we will buy our position. We will buy here, and RSI now is in overbought range and crosses down this 70 level, so we will exit here. We will buy here and exit here. Similarly, this is the downtrend and RSI is taking support as at 70 level. It is not going in overbought range because now it is a starting of a downtrend, short-term downtrend. At this level, RSI is going below 50 level, so we can make our short sell position here. We can sell here. Now RSI is in oversold range, and after coming in oversold range, RSI is going above 30 level. So we will exit here. We will sell here and exit here. In ranging market, when RSI crosses 70 or faces resistance near 70 or 60, we can sell. And when RSI crosses down 30 or takes support near 30 or 40, we can buy. But in trending markets, when RSI crosses above 70, it's like a car going into the fifth gear. The momentum at this time is strong and one side sharp up move can be seen. As long as RSI doesn't go below 70 and faces resistance of 70 again, we can keep long. It is advised that RSI crosses above 30, you should wait for the confirmation signal that we get when RSI is above 50. Now here market is moving in a range between two lines. This is the resistance line, this is the support line. So we can make use of RSI here when prices are touching 70 level. They are going in overbought range and now facing resistance 70 level many times. We can sell here and Now RSI is going in oversold range and now again facing this level second time, so we can buy here. This will be our buying position. Again RSI is going at 70 level and facing resistance 3 times here. You can see facing resistance 3 times, so we can sell here. So every time when we get a resistance near 70 we can sell, and every time when we get support at 30 we can buy. This was the case when market was in sideways trend, but now market is in trend. This is trending market, bull trend, and RSI is in overbought range. Here RSI is in overbought range for long time because the momentum is high here. So we will not make any short sell position when RSI is in overbought range because this is a bull trend market. RSI is a very useful tool, but like other indicators, RSI is also prone to providing false signals. So price analysis is still needed with the use of RSI. Thanks for watching the lecture.
Welcome back everyone. In this lecture we will learn about divergence, that is a very important concept and observed between price and indicator. With the help of divergence, one can get early signal to exit the trade. Whenever such divergence signals are seen, one can take position combining other indicators. We can find divergence between price and indicator when there is a divergence between price and other indicators such as RSI, MACD, stochastic. We get the signal of trend reversal. Divergence can be positive or negative. A positive divergence is also known as bullish divergence, and a negative divergence is also known as bearish divergence. If we are able to spot such divergence at different stages of bull and bear market, we can make a good percentage gain in short term. But there is some risk involved in this because after a divergence, the trend reversal could take some time. So we must have patience and confirm our position. Only then we should enter or exit in our trade. So let's understand what is divergence and how to spot divergence in an uptrend or downtrend. If prices make lower lows, prices are going in downward direction, but indicator fails to do so, and if indicator goes in upward direction, then it is known as a positive divergence or a bullish divergence. We get the signal from indicator because prices are going down but indicator is going in upward direction. So indicator is giving us a bullish signal and it is known as bullish divergence. So here we get a signal of uptrend. Similarly, if prices make higher highs and go in upward direction but indicator goes in downward direction, then it is known as negative divergence or the bearish divergence. This is a signal of retracement in the prices or a trend reversal in downward direction. Let's understand it on the price chart. See, this is the daily chart of Pidilite Industries and you can see the stock is going in upward direction in this channel. So if our view is for positional trading, we will see the divergence on hourly time frame chart. That is our trading chart. For positional trading perspective, we have discussed in 3D charting lecture. So here you can see prices are moving in this channel and prices are very near to the upper level of this channel. This is the resistance level and near this resistance level you can see prices are making higher highs. But if we see the peaks of RSI, see RSI peaks are going in downward direction. This peak and this peak are going in downward direction. If we join these peaks, the line is going in downward direction. But if we join these peaks in chart, in price chart, then we can see the line is going in upward direction. So this is a divergence because both the lines are going apart from each other, and this is known as bearish divergence because the line in RSI is going in downward direction and it is giving a signal of downtrend, and we can expect that near this resistance level prices will go in downward direction and we can see a retracement in the prices. So with the help of this divergence signal, here we are getting an early signal of this retracement. So with the help of this signal, here we can exit from our long position With the help of divergence, we can also enter in a trade in the opposite direction, and we can also trade this retracement phase, but that is slightly risky, and we should confirm our position that I have explained in Masterclass 2 course. With the help of some techniques, we can also make our short sell position here, and we can make profit in this retracement phase also. But mainly we use the divergence concept to get early signal to exit the position. So in an uptrend, here we are getting an early signal to exit the trade from our long position. Similarly, in a downtrend, we get the signal to exit our short position. You can see this is the chart of Indus Bank and the stock is in downtrend. This was the support level. Prices breached this support level. There was little consolidation near the support level, but prices were not able to go in upside. So it was a signal to go short in this stock, because here we are getting a signal in this chart that prices will go in downward direction. But after making a short position, you can see prices are going in downward direction, but RSI is going in upward direction. In a downtrend, we see the troughs, we see the lows of RSI. In an uptrend, we were analyzing the peaks of RSI, but in downtrend, we will see the lows of RSI, or we can also say the troughs of RSI. So they are going in upward direction, but prices are going in downward direction. So this is a divergence. This is a positive divergence, or we can say this is a bullish divergence, because indicator is giving us a bullish signal. So here, if we short the stock here, then RSI is giving us a signal to exit our short position, because we can expect a pullback in the prices. And after this doji candle, you can see there was an up move in the prices up to this level. The support level is now acting as a strong resistance level, and prices are touching this resistance level. So with the help of divergence, we got an early signal to exit our short position in the stock. Similarly, here you can see prices are again going in downward direction. There was a fall in the downward direction. You can see prices are going in downward direction, but if we see the lows of RSI troughs are going in upward direction. So this is also a positive divergence. Here we are getting an early signal to exit the short position, and you can see after this point prices are going in upward direction. There was a pullback in the prices. So in this way, divergence is very helpful to get early signal to exit the trade. How to enter in a fresh position with the help of divergence, that we will learn in next course, Masterclass 2. But here I'm explaining the concept, what is divergence and how to spot the divergence on price chart and with the help of indicator. Here I'm using the RSI indicator, but we can also get these signals on MACD or the stochastic. For example, you can see this is the chart of Euro USD, and in this chart here prices are going in downward direction, but RSI's troughs are going in upward direction. So this is a case of bullish divergence, and here we are getting a signal of pullback in the prices, and you can see MACD is also giving us a bullish divergence. Stochastic is also giving us a bullish divergence, because all the three indicators are going in upward direction. So we can get the signal from any indicator, but I prefer to use RSI, because with the help of RSI we can also get signal to enter in a fresh position to trade this pullback. And here you can see this is a bearish divergence. Prices are going in upward direction, but RSI's peaks are going in downward direction. MACD is also going in downward direction, and stochastic is also going in downward direction. So indicators are giving us a signal of retracement in the prices, and you can see after this point there was a retracement in the prices. One thing I want to mention here, that we should notice the divergence only when indicator is trading in overbought or the oversold range. Here if prices are giving us a divergence in this area when RSI is trading in this shaded portion, because it is neither in overbought range or oversold range, then we will not consider any signal of divergence, and that is not a valid divergence. So we should see the signal when indicator is trading either in overbought range or the oversold range. In an uptrend, RSI should trade above 70 level in overbought range. See, both the peaks of RSI are trading in overbought range. So, the first peak must trade in overbought range. Then we should find out the divergence signal with the help of RSI. And in a bearish divergence, RSI first trough should trade in oversold range below 30 level. Then we should find out the signal of positive divergence, and that will be a valid divergence. So divergence is a very important concept, and I always use this concept while I trade the stock, and this is my favorite indicator because this is a leading indicator. RSI is an oscillator, but with the help of RSI, here we are getting early signals. That's why it is also called the leading indicator. But there are so many types of divergence also, like failing divergence, multiple divergence, simple divergence, that all we will learn in masterclass 2, and how to find out the trading signals with the help of these concepts. Where should you adopt the stop loss level? What should be your target level when we get a divergence signal on the chart? That all you will learn in the next course. So this was the explanation of divergence, and I hope you are enjoying the course. Thanks for watching. Welcome back everyone. Now in this lecture we'll learn about one more indicator, that is Bollinger Band. Bollinger Band is commonly used indicator discovered by John Bollinger in 1980s. It is a powerful indicator and it can be used for all types of trading. Bollinger Band is a volatility indicator, and the purpose of Bollinger Band is to provide a relative definition of high and low. It consists of three bands. In center, there is a simple moving average, that is 20-period moving average, and on both the sides, there are bands of standard deviation lines. They provide us relative boundaries of highs and lows. The default settings for simple moving average, that is the middle band of Bollinger Band, is 20-period. It means this is a 20-period simple moving average. And the upper band is placed 2 standard deviation above the 20-period moving average, and the lower band is placed 2 standard deviation below the 20-period moving average. Of course, you are allowed to use any inputs that you like, but I suggest default settings. There are so many uses of Bollinger Band, and the first use of Bollinger Band is they indicate high and low volatility. The expansion and contraction on band indicates the volatility of the prices of that particular stock. When bands are expanded, it means there is a huge volatility and we can see a sharp up move or a sharp down move in the prices. And when bands are close together, volatility is lower. In a range-bound market, the bands become very narrow. You can see here the bands are very narrow and the volatility of prices is very low. Prices are sideways and they are range-bound. But when there is an expansion in Bollinger Band after this narrow range, you can see prices are going in uptrend and there is a sharp up move in the prices. So whenever prices move sideways and Bollinger Band goes sideways, we shouldn't trade the stock. You can see here prices are going in upward direction and Bollinger Band is also going in upward direction. All the bands are going in upward direction, so we can trade the stock in upward direction. But here from this point, there is a sideways movement in the Bollinger Band. See, from this point, let me mark this point. See, from this point, Bollinger Bands are coming close to each other. So, it indicates that volatility is going to decrease now, and see, after this point, there is a sideways movement in the prices. So, in this range, when Bollinger Band is going sideways and volatility is low, we shouldn't trade the stock. Second use of Bollinger Band is used to tell the breakout in the prices. When bands contract too much, like here, the probability of a breakout increases. See, after this point, when bands are too much contracted, from this point, see, bands are expanding, and after this contraction, here we are getting an expansion in the Bollinger Band. So here we can expect a breakout in the prices, and we can expect that prices may move in a trend after this sideways range. Here also you can see after this uptrend from this point, Bollinger Bands are coming close to each other. See, the upper band is going down and the lower band is going up. So both the bands are coming closer to each other. It means volatility is decreasing and we can get a sideways movement in the prices. So from this point to this point, you can see prices are sideways. If we want to draw support and resistance lines, then you can see prices are moving between these two lines. And see, they are sideways. So we shouldn't trade the stock if prices are moving in this range. Now some people say when Bollinger Bands move sideways, then we can buy the stock when prices touches the upper band and we can sell the stock when prices touches the lower band. So it is very risky to trade like this because you can see in this case, here prices are touching the upper Bollinger Band. So if we are going to sell the stock here, then you can see prices are not touching the lower band and even we are getting one more candle above our entry point. So in this case, our stop loss would get hit. So I never suggest to trade when Bollinger Band going sideways. We can trade this range only on the lower time frame chart. For example, this is the hourly chart, and if we are getting a sideways range on hourly chart, then we can trade this range on 15-minute chart or 5-minute chart by getting signals with other indicators. But on hourly chart, we shouldn't trade the stock as long as prices are range bound and there is a contraction in the Bollinger Band. But see, after this contraction, here bands are expanding. This was a gap down opening. After a pullback, now prices are going in downward direction, so they are in trend. As long as Bollinger Band is expanding, prices are in a trend. But from this point, you can see upper band is going in downward direction, lower band is going in upward direction. So both the bands are coming close to each other. It means volatility may decrease now and we should exit from our position because we can get a sideways movement in the prices. The third use of Bollinger Band is it signals about the continuation of the trend. When we get a candle outside the Bollinger Band after the contraction, it means that prices can continue in the same direction for some time. See here, this was the contraction in Bollinger Band and this was the starting of the expansion. Both the bands are expanding and here you can see this candle is closing outside the Bollinger Band. And this candle is also closing outside the Bollinger Band. It means the trend can continue, momentum is high and we can ride the trend in the upward direction. The uptrend can continue for some time more. Now see this candle. This candle is totally outside the Bollinger Band. See the length of this candle. Only the low of this candle is touching the upper Bollinger Band and the whole body is trading outside the Bollinger Band. It is a signal of pullback in the prices. So you can see there is a pullback in the prices, there is a red candle and prices are again entering in the range of Bollinger Band. So when we get a candle totally outside the Bollinger Band, that is a signal of pullback in the prices. But it doesn't mean that we will get a reversal in the prices. After a pullback, prices are going in upward direction and it is also a signal of continuation of the trend. So with the help of other indicators, we can get our entry and exit signals, but Bollinger Band tells us about the continuation of trend here. As long as prices are trading near the upper band, this is a signal of continuation of uptrend, and as long as prices are trading near the lower band of Bollinger Band, this is a signal of continuation of the downtrend. See here, this was a range-bound market because Bollinger Band is getting narrower and this is a very narrow range. After the contraction here, you can see both the bands are expanding and they are going apart from each other. So prices are trading above 20 EMA, so we can get a signal of uptrend and we can expect that prices will go in upward direction. But you can see after 3 or 4 candles, there is a sharp downfall in the prices. So this was a fake signal and With the help of support and resistance levels, we can eliminate these fake signals. If we see the previous price action, see, this level was the support level for the prices, and here when we are getting a fake signal, prices were resisting this level, and this is a formation of head and shoulder pattern. This is left shoulder, this is head formation, and these are right shoulders. So it is head and shoulder formation above this line, and this is the neckline of this head and shoulder formation. That's why here prices were resisting this level, and here we got a fake signal. So with the help of support and resistance, we can avoid fake signals, and see, after resisting this line, there was a sharp downfall in the prices. At this candle, bands are going apart. It means volatility is increasing. So we can get an idea here that downtrend may continue, and you can see prices are trading near the lower band. Downtrend can continue for some time more, but here you can see from this point, you can see this band is going in upward direction, this band is going in downward direction. So we can expect that volatility will decrease now, and after this point you can see prices are going in upward direction. There is a retracement in the prices, and this was the end of this downtrend. So with the help of other indicators like RSI, moving average, we can trade in the same direction. See here, when there was a huge volatility, candles were closing outside the Bollinger Band, but there is no candle that is totally outside the Bollinger Band. That's why all the candles are going in downward direction. But see here, prices are not able to touch the Bollinger Band. That is a signal of decreasing volatility. And if we add RSI here, you can see RSI is giving a positive divergence. So it is a signal of decreasing volatility, and momentum is also decreasing. That's why you can see after this down move, there is an up move in the prices. The same is here. Bands are getting close to each other, and there is a contraction in the prices. So we can assume that there will be a breakout in the prices, and see here we are getting an expansion in the Bollinger Band, and prices are going in upward direction. But this is the resistance level. Near this resistance level, prices were not able to cross this level, and suddenly prices are going in downward direction. So here, as prices are trading at the lower band, we can assume that downtrend may continue now, and we can trade in the downward direction. All the candles are closing outside the Bollinger Band, but here prices are not able to ride at the lower band, and RSI is also in oversold range. So this is giving a signal of pullback in the prices. So we can exit from our position here. So there was a slight pullback in the prices, and volatility is very low. You can see prices are approximately sideways, and bands are coming close to each other. But from this point, both the bands are going apart, and there is an expansion in the Bollinger Band, and you can see candles are closing outside the Bollinger Band. So we can expect that downtrend may continue now. But see this long candle, when the candle is closing outside the Bollinger Band, and this was a long candle, so it was a signal of pullback in the prices. After a pullback, there was a slight consolidation in the prices, but again prices are going in downward direction, and prices are moving near the lower band. And when there was a divergence in RSI, so this was a signal of end of this down move. We can assume that prices will go in upward direction, or we can see a sideways movement in the prices. So with the help of other indicators, we can get entry and exit signal, and we can trade the stocks very effectively. Bollinger Band is a very good indicator, and with the help of this indicator, we are getting early signals. That's why it is called a leading indicator. You can see here there is a contraction in the prices. So here we are getting an early signal of the breakout, and here as we are getting a positive divergence, and Bollinger Band is also going sideways. So here we are getting an early signal of the end of this down move. So in this way you can use this indicator on your charts, and you can get very clear signals if you add other indicators with Bollinger Band. Thanks for watching. See you in the next lecture. Welcome back everyone. Now in this lecture we will learn how to use TradingView. A lot of students are asking me about how to select different tools, how to set a chart, how to find different indicators, etc. So in this lecture we will learn about all this, and for this obviously we need a TradingView account. You can also take any other platform that you like, but in the course I have used TradingView because TradingView is a global platform that allow you to access it in almost every country. So first of all, you will have to make an account on TradingView. So for this, go to my website jyotibansalanalysis.com, and here you will see charting. If you click on this tab charting, you will get your chart. This is your chart. So you can use this chart for analysis. You can analyze your chart here. For example, you can draw a trend line and you can use Fibonacci tool. From here you can use indicators and the stock screener. So you can analyze your chart here, but your data will not save on this chart on my website. For example, if you are drawing Fibonacci for any swing or you are drawing trend line, and the next time when you will open your chart, you won't get these drawings on your chart. So you have to draw all the drawings again your charts. So I will suggest you to make your account on TradingView platform. For this, simply click here and click on join now. You will see this page. This is TradingView page, and you have to make your account by giving your details here. And after signing up, you will have your account on TradingView platform. Use your genuine email because they will send you the activation code in your email, and by activating you will get your TradingView account. Now on TradingView you will get 4 choices. When you will log in TradingView, you will be logged in basic plan, that is a free plan. But in basic plan you will face so many problems. There are so many limitations with basic plan. Often my students ask me out of 4 plan which plan is suitable for them. So I will suggest you to go for Pro plan. You can compare all the plans here. In basic plan you won't get customer support and you will get only 3 indicators to be applied on your chart, and so many features are not available in basic plan, and you will also get delayed data in basic plan. In this plan you will get only 3 indicators. For example, if you are analyzing your chart and you have applied 3 moving averages, then you won't be able to apply any other indicator like Bollinger Band, RSI or MACD. But in Pro plan you will get 5 indicators. So out of 4 plans, Pro is sufficient for you in the beginning, and for all these plans you will also get 1 month free trial. So upgrade your plan for Pro, and after 1 month you can subscribe your plan and Pro is sufficient for you. Now let's see how to use TradingView platform and how to use all the tools and indicators to analyze your chart. I have already signed up from my practice account. So this is TradingView. Here in the search box you can search any stock, commodity, currency pair. Let's search Apple Incorporation. And this is Apple Incorporation. The current price of the stock is $284. Then we will click on full featured chart because we want a chart in which we can analyze the stock. So if we click here, we will get our chart, and first of all drag it to left side because we want a sufficient space to analyze the chart, to draw trend line, etc. And this is buy and sell panel. Also drag this buy and sell panel wherever you want. I will place it here. Now this is the chart. Now here this is x-axis and this is y-axis. On x-axis you will get time scale, and on y-axis this is price scale. These are price and this is time period. So Apple Incorporation's current price is $284, and you can see this is the last candle and the closing of this candle is $284. So the current price of the stock is $284.03. You can manage zoom moving this price scale up and down. Similarly,
you can move this time scale right and left. So in this way you can set your chart. For example, if you want to draw support and resistance levels, then you can zoom out your chart and draw support and resistance level here, and also you can move up and down so that you can see the price action very clearly. Here are 3 buttons as well. This is plus, this is minus. Plus is for zoom in and minus is for zoom out. You can also click here to zoom in the chart, and if you click on minus, the chart will be zoom out. And in this way you can set your chart for different purposes. For example, to draw support and resistance level, you want to just zoom out your chart, and if you want to analyze only the current price action to see the current candles, then you can zoom in your chart from here, from plus sign, or you can manage your chart simply from here. Okay, now this was the chart. Let's understand about the tools and indicators. Now here, this is the symbol of the chart. You can change the symbol, so maybe you want to open any other chart. This is AAPL for Apple Incorporation. For example, if you want to open SDFC, then simply type SDFC. You will see so many stocks. So simply this is SDFC from NSE. Simply click on this and you will get your chart for SDFC Bank. You can see currently market is live. So this is 1 minute chart. You can see this is time frame 1 minute. If you click on this time frame, you will get so many options. You can choose 1 minute chart, 5 minute chart, 15 minute and 1 hour, and this is 1 day, 1 week and 1 month. Which chart should be chosen for which perspective, that I have explained in the course. Currently I am choosing 1 hour chart, and see, this is the 1 hour chart. It means this candle is showing the data for 1 hour. Now this is candlestick. These are the candlestick. This is candlestick chart, and if you click on other options, if you click on bars, you will get bars for each 1 hour data, and if you click on line, you will get a line chart. So there are so many options. This is Heikin-Ashi chart. About Heikin-Ashi chart you will learn in the course. So in the course I have used candlestick chart, so we will simply choose candles here, and this is our candlestick chart. Now these are the trading tools. So first of all, let's understand these trading tools. First is for mouse. We can choose cross, dot, arrow, mouse that we want here. You can see this is cross and my cursor is cross. If I choose arrow, then my cursor is showing in the shape of arrow. If I choose dot, then see this is dot, my cursor is in the shape of dot. And this icon is for trading tools. These are lines. This is trend line. This option is to draw trend line. And this is horizontal line. This is horizontal ray, vertical line, cross line, arrow. So many lines are there. So if we want to draw a trend line, we will simply click on this and click here and extend this to anywhere where we want, and then again if we click, then this is our trend line. We can draw our trend line in this way, and then if we want to shift the trend line, simply click on this point and shift. Let's say I want to shift it at the low of this candle because I want to draw a trend line for this trend, and then by clicking on this point, B point, I can change the position of this B point. So in this way we can draw a trend line to the chart. And if we want to delete this trend line, simply click here and you will get this option here. This is remove. You can click here or simply delete from your keyboard. Similarly, you can draw horizontal line. If you click on horizontal line, this is horizontal line and this is horizontal ray. If you want to draw vertical line, simply click on this. This is your vertical ray. And if you want to choose parallel channel, simply click on this. This is your parallel channel, and then click on here. This is your parallel channel. And if you want to remove these tools, simply remove these. And you can also change color of these lines. Simply click on this. You will get so many options here. So this was remove option, and For changing the color of this line, you can change the color from here. Suppose you want to change the color of this line as red colors. Now this is of red color and you can double click on this point. You will see this box in which you can choose the color. This is color, and you can change the thickness of this line. Simply click here on this line and you can change the thickness. For example, this is the thickness, then this is another line. So by choosing these lines, you can set the thickness of the lines. The next icon is pitchfork. In this icon, you will get so many options. These are different trading tools. Now, Fibonacci retracement is the most important tool out of these tools. I have used this tool in the course. So simply click on this if you want to apply Fibonacci tool to any of the swing, and click on here and then drag it to the high of this swing. Now these are the Fibonacci levels. This is our Fibonacci tool. You will learn later in the course about this tool, but here you will learn how to apply this tool. So in this way we can apply this tool, and if you want to change the setting of this tool, simply double click on this point. You will get this box in which you can change your settings. This is style. You can add or delete the levels. Also you can change the color, thickness of lines, etc. But default settings are the best. You do not need to change any of the settings in this tool. Now this is geometric shapes. This is brush. You can use brush here. This is rectangle. If you click on this, you can draw a rectangle on your chart. For example, for drawing support and resistance zone, this tool will be helpful for you. For example, here, if you want to know the support and resistance zone, so this is our resistance zone here, and see, prices are taking support on this resistance zone, and then this was the uptrend. Now these are other geometrical shapes, and this is text. If you want to write something on chart, simply click on text and write something. Now this is the text, and these are other options. And this icon is for patterns. These are 5-point patterns that is used for harmonic patterns. If you want to draw different chart patterns on your chart, this is head and shoulder pattern. You can simply click on this pattern and draw head and shoulder pattern that you will learn in this course. So this is head and shoulder pattern. Similarly, you can choose any other pattern and draw it on your chart. This is ABCD pattern. This pattern is used for drawing different harmonic patterns like bat pattern, crab pattern, and butterfly pattern. And this is cipher pattern. This is also a harmonic pattern that I have explained in my chart pattern course. So these are different chart patterns. And then this option is for measurement tool. Suppose you want to make a long position, you want to buy a stock here because prices are taking support here. So you can use this tool to know your target point and to know your stop loss level. Suppose this is your stop loss level because this is the next support level. So you want to place your stop loss here, and if you want to set your target level at 1:2 risk to reward ratio, this is risk to reward, this is 2.5. So you can set it at 2. Now see, risk and reward ratio is 2. It means if you are buying the stock here at 2,352 rupees, then your target should be here at 2,394 rupees if you want to get a risk to reward ratio 1:2. So in this way, this tool is very helpful for us. And if we want to make a short position, if we want to sell the stock, then simply use this tool. Now this is stop loss level and this is target. We can set our risk to reward ratio by moving this up and down. Okay, then there are some more tools, but we don't need them. Currently, this is the most important tab. This is indicators. So if we want to apply different indicators on your chart, you should simply click here and you will get different indicators here, a list of so many indicators. There are built-in indicators, public library and other one. So if you want to choose any indicator, simply write the name of indicator here. Suppose you want to apply RSI indicator on your chart, type RSI and you will see relative strength index, that is RSI indicator. So simply click on this indicator and indicator will be applied on your chart. If you want to add the indicator in your favorite list, click on this star and this indicator will be added in your favorite list. So this is RSI indicator. You can add some more indicator in your list. Suppose you want to apply moving average set on your chart. This is moving average exponential, that is called EMA, and this is moving average, simple moving average. So if you want to add these two tools in your favorite list, simply click on star and see there are 3 indicators in your favorite list. So in this way you can add different indicators in your list, and if you want to apply any indicator on your chart, click on this and see RSI is automatically applied on your chart. This is price chart and this is indicator panel. You can adjust the width of this panel by dragging it up and down. See, if you want more area for your price chart, then you can simply drag it to down, and if you want more area for your indicator panel, then drag it up. You can also set the interface of your indicator by moving it up and down. For example, if you want to see 50 level, then set your indicator by clicking here. This is 50 and this is 70 level and this is 30 level. So in this way you can apply different indicators on your chart. Simply write here what indicator you want and click on that indicator. The indicator will be applied on your chart automatically. On Pro plan, you can apply 5 indicators on your chart at one time, and I think 5 indicators are sufficient for you to analyze a chart. Now this is price scale. When we draw a trend line, we need to change the settings of this price scale. So simply right click here and you will see this option. Now currently your chart has regular settings. To change the log scale settings, click here logarithmic settings. Now these are log scale settings. We will know about log scale settings later in the course, and if you want regular settings, then you can choose regular settings. Now this is buy and sell panel. If you want to do paper trading, suppose here you want to buy the stock. Let me change. Okay, now this is time frame, and if you want to change the time frame, you can select any of these time frames and see there is a star for every time frame. So if you click on this star, then these time frames will be added in your upper panel. And suppose I want 3 more time frames in my favorite list. I'm choosing 15 minutes and I'm choosing 1 day and 1 week. See, all the time frames have been added in the upper panel in this tab. And suppose I want a 1 minute chart. Market is live, so if I want to buy this stock, then I will click on buy. Now I have to connect to paper trading, and this is my paper trading panel. So if I want to buy 100 shares of this bank, fill the quantity here and click on buy. Now see, 100 shares have been bought here in your paper trading account. How to use paper trading panel, that you will also learn in this course. There is a separate lecture on how to use paper trading account, but in this lecture I'm simply explaining you how to use different indicators and tools and how to set your charts, because so many students are getting confused while using TradingView platform. So in this way you can select different tools from here. You can select indicators here. You can change the time frame of your chart by choosing time frames from here. You can choose candles from here, and you can zoom in your chart and zoom out your chart from here. These are the options. Now here is the stock screener. How to use this screener, that I have also explained in the course. So there are so many options in this platform, and you can use all these options to analyze a chart. Now how to analyze your chart, how to use these tools, which tool should be used for which perspective, which trading perspective, that all we will learn in the course. Thanks for watching. See you in the next lecture.
Hello everyone and welcome to our first option strategy. Our first option strategy is long calls, that is a bullish strategy. The strategy should be used in an established uptrend, and this is one of the most simple and basic strategies of options. If we expect that the price of the underlying stock will go up beyond a certain price before expiry, we can purchase a call option. In this way, strategy appeals in low initial investment and the leverage financial reward because we are purchasing a call option instead of buying shares. We can purchase long calls using charts when the stock is in an uptrend and it starts rising after touching its trend line. The maximum profit is unlimited as the stock price rises, and maximum loss is limited to the net premium paid. For the execution of our strategy, first of all we will draw a trend line of the stock on daily chart. For this, we will join the first two initial points with the trend line and then extend it. This is the daily chart, this is the chart of Apple Incorporation, and now prices are moving in a downtrend. This is the end of the downtrend and stock starts rising. So we will join initial 2 points. These are the 2 points from where the prices are in uptrend. We will take a trend line and we'll join the first 2 points and extend the trend line. Now whenever price starts rising after crossing down this trend line or after touching this trend line, we can buy a call option. These are the points on this trend line where we could have purchased our call option. This was the point, then this was the point, again this was the point, and here and here. These are the points where we could have purchased our call option, and if we see on RSI, at this point RSI should be above the 50 level. We can see here RSI is above 50, also here RSI is above 50, here also RSI is above 50. So we will purchase a call option only when RSI is above 50 level. Then we will set the chart to hourly time frame. This is the hourly chart, and let me zoom in the chart. This was our trend line, and suppose this was our point where we could have purchased our call option. This is the point $161. So we will mark it. This was the point. We will mark it. Now we will join the two initial points and draw a trend line for this short-term trend. We'll join the two initial points. These are the points. This is the first point. This is the second point. We will extend the trend line. This was the first point and this was the second point. This way. Now, as long as the prices are above this trend line, we can hold our call option position, and when prices are falling down this trend line, we will exit from our call option. Now the price of the intrinsic value of the call option here is $173. This is the level $173. We will buy a call option at 161 and exit from it at $173. Let us make some calculations now. Suppose our buying price of call option at current maximum price $161 is $2. And if the lot size is 100, the cost of trade will be 2 into 100 equal to $200. So the maximum profit is 173 minus 161, that is 12 into 100. Because the lot size is 100, the maximum profit will be 1200 minus 200 equal to $1000, because our cost of trade will be $200. and maximum loss is net premium paid, that is $200. If the stock stays at or below $161 on expiry, $200 is the maximum you could lose. But if the stock rises to $173, as in this case, before or at expiry, resulting a profit of $1000. If you buy the 100 shares of Apple at $161, you will require 161 into 100 equal to $16,100. But now you make a $1000 profit on your investment of $200 only, which is an extraordinary return in percentage terms compared to small investment. Now here also the stock start rising after touching this trend line, so we could have purchased a call option here, and we will draw a trend line. This is the early time frame, so we will join the initial 2 points. This is the trend line. As long as the prices are above this trend line, we can hold our call option and we will exit from it when prices will fall down this trend line. We will take one more example. This is the chart of Facebook Incorporation. This is the daily chart, and we can see the stock is moving in a range here. Now the range breaks here. This is the breakdown. So we will draw a trend line for this uptrend. We will join initial 2 points. These are the 2 points, and we will join these 2 points and extend the trend line. This is the trend lines. So we can buy a call option whenever price rises after touching this trend line or crossing down this trend line, they start rising. This was the point where we could have purchased our call option. This was another point. This was another point. Here also we could have purchased a call option. Also here and here. For this, RSI should be above 50 level. Now we will set the chart on early time frame. Suppose this was the point where we could purchase our call option. Now we will draw a trend line. We will join initial 2 points and extend the trend line. This is the trend line. So if we have purchased a call option here, this was the point as $172, and this was the point where we will exit from our call option. This is $179. After purchasing a call option here, if the stock stays at this level or it falls below this level before expiry, the maximum loss is the premium paid. But if we adopt the strategy in an uptrend and at right place using chart analysis, we will surely. Welcome again. Our next strategy is long put strategy. A put option is an option contract giving the owner the right but not the obligation to sell an underlying security at a specified price within a specified time. This is opposite of a call option. Long put strategy is one of the simplest and popular strategies used in a bearish environment that should be adopted to ensure your stock portfolio against a loss. Also, we can make money in a bearish scenario by buying put options when there is a fall in price of stock. Many of us complain about the loss when stock market fall in price, but if we insure our portfolio with long put options, we can feel happy and worry free even in downtrend. In long put option strategy, we just buy the put option, and when stock falls in price, the value of put option increases, and by selling them we can make profit. The maximum profit is unlimited when stock price falls, and the maximum loss is limited to the net premium paid. We can use the strategy when the stock is in a established downtrend or when we get a double top or head and shoulder pattern in uptrend. Suppose stock ABC is trading at $70. You could purchase a $70 put option at price $2. So our cost of trade is $200 and the lot size is 100. If the stock price falls to $65 from $70, then you can make a profit of 5 into 100 equal to $500. But you paid a premium of $200, so your net profit will be $300. And if stock price goes up, then your put option will lose value and the maximum loss will be net premium paid, that is $200. In this way, this is a wonderful strategy to make profit even in downtrend. Now we will analyze the chart. This is the chart of Twitter Incorporation, and the stock was in downtrend for approximately 2 years. So we will join first 2 points and then extend the trend line. This is a trend line for downtrend. Every time whenever we get a point on trend line, when prices break down this trend line, we can buy our put options. These are the 2 initial points. Then this is the third point. So we could buy our put options here. Again, we could buy here. Let me mark the point. This was the point where we could have purchased our put option. Again, this is a pullback rally and prices fall below this trend line, so we could have purchased our put option here. Again, this was the point. Now prices are touching the trend line and falls down, so this was the point. So in this downtrend, we could have 4 opportunity to buy our put options and make money. After this, you can see the stock have a pullback rally and now prices are above this trend line, so we will not buy a put option because prices are now above this trend line. Every time of buying put option, we will make sure that RSI is below the 50 level. Here this was the points, so you can see RSI is below 50 level. So this is a confirmed position. Here also this is the point and RSI is below 50 level. At this point RSI is below 50 level. Also at this point RSI is below 50 level. After purchasing the put option, we will set the chart on hourly time frame. This was our hourly chart. Suppose this was our position where we buy the put options. Now we will join 2 initial points and draw a trend line in downward direction. This is a trend line. Now as long as the prices are below this trend line, we will hold our put option, and when prices are crossing above this trend line, we can exit from our put option position. Again, this is the chart of Sun Pharma and this is the trend line of this downtrend. Every time when prices touch this trend line and retain its downtrend, we can buy a put option. We could have buy a put option here, also here. This was another point, and here and here. Now prices are in short-term uptrend and we can buy a put option when prices will touch this trend line. In this way, by buying puts, we can ensure our portfolio from a fall in prices and also even make money in downtrend. Thanks for watching the lecture.
Sometimes we find it difficult to get many points on trend line. For example, in this chart, we are getting only 5 points on trend line. So, after getting 2 points, we can trade only on these points, these 3 points. But what about the time period between these 2 points? This is the time period from May of 2016 to August of 2017, more than 1 year. So, in this case, when the stock is in high momentum phase, we can use indicators to get our trading signals. Using some indicator settings, we can get entry and exit signal in between these 2 points also. If we want to trade in monthly expiry, we should focus on weekly and daily chart. And if we want to trade weekly options, our charts will be daily chart and hourly chart. Now we will use some indicator settings and see how to get entry and exit signal for monthly and weekly expiry in the next lecture. When buying call and put options, we should always locate points on trend lines. But we can see in this chart that the stock is in high momentum phase for more than 1 year. In this case, we can also find our entry and exit points with the help of indicators. For this, we should focus on 2 charts. Suppose we are trading monthly expiry, then our focus should be weekly and daily chart. First of all, we will set the weekly chart and add RSI indicator to this chart. See, this is the weekly chart and RSI indicator is showing that the stock is in uptrend because RSI is above 50 level for this period. Then we have to locate the position on weekly chart when RSI crosses above 50 level. See, these are the 4 positions where RSI is above 50 level. It is touching 50 level or it is going above 50 level from oversold range. Now we will shift to daily chart and apply moving average set to this chart. For monthly options, our moving average set will be 21 period and 14 periods. So we will apply this moving average set to the chart. Now it was our position on weekly chart. Then we will see 14 period moving average should above the 21 period moving average and RSI should above the 50 level. We can make our entry at this point. As long as this 14 period moving average is above the 21 period moving average, we can hold our call option. Then this is the point where 14 period moving average is going above the 21 period moving average. We can again make our entry here. Now, as long as this 14 period moving average is above the 21 period moving average, we can hold our call option trade and again we can make entry here at this point because this red line is above the black line. This is our entry point and this is our exit point. See, at our entry point, RSI is also going above the 50 level and at exit point, RSI is below the 50 level. When we make our entry, we can also draw the trend line to the current trend and exit when price crosses down this trend line in downside. So, this can be our exit position. Similarly, when stock is in downtrend and we cannot find more than 3 points on the trend line, we can get signals from indicators. This is the weekly chart of RCOM and we will find out the point when RSI is going down from 50 level. This is the point when RSI is crossing down the 50 level, so we will mark this level. Now again here at this point RSI is going down 50 level, so we will mark this level. Here also RSI is going below 50 level, but this point is above the trend line, so we will not mark this level. And these are the 2 points. Now on daily chart, in between this time period, we can make our entry and exit signal based on indicator setting on daily chart. So on daily chart, we will apply RSI and moving average set for monthly options. See here, we are getting a signal of downtrend because 14 period moving average is crossing below the 21 period moving average and this is the bearish signal. So we can buy our put options at this point. As long as this 14 period moving average is below the 21 period moving average, we can hold our put option trade and see RSI is also below the 50 level in this time period. So this is our exit level when this red line is going above the black line. Again here we are getting a selling signal and RSI is also below 50 level. So this is the level where we can buy our put option. This is the level when RCOM is trading at 102.35 level. And here at this point we are getting our exit signal. This is the point when stock is trading at 63.95 level. So if we apply these settings, we can trade in monthly options when we buy, call or put option. In the next lecture, we will see the settings for weekly options.
So let's continue our previous lecture. Some of my students are confused with this strategy. Suppose this was the point where we got the signal to go long or to buy call options. Here RSI should be above 50 level on daily chart. So for monthly options, our 3D charting will be weekly, daily and hourly. So this is daily chart, but we will make our entry on hourly chart. You can see we are getting signal here, but moving average set is giving an exit signal here. So this is 10th of June and this is 12th of October. So from June to October, we cannot hold our call option for monthly expiry. So these are not the points to buy call option here and to exit here. On daily time frame, we will analyze the chart only when moving average set is giving us a hold signal. See, 14 period moving average is above 21 period moving average here, and at this point 14 period moving average is going down the 21 period moving average. So only in this portion we will buy call option. After this line we will not buy call option because moving average set is not giving any buying signal, but we will make our entry on hourly time frame. as I have explained in my basic course that we should make the entry on lower time frame, that is hourly chart for positional trading. So we will shift the chart on hourly time frame. So this is hourly time frame and this was the range in which we should buy call option. We will not buy put option in this range because on daily chart 14 period moving average was above the 21 period moving average. Now on this chart we will make our entry and exit based on moving average set and RSI indicator. Now see here, at this point we are getting a buying signal. We can buy call option at this point because this is a bullish crossover from both the moving averages and RSI is above 50 level. We can buy call option at this point, at this candle, and then we will draw a trend line for this trend, and this is the trend line. Now as long as prices are above this trend line we can hold our call option, but see, this was a gap up opening and prices are very far from this trend line. We should exit from the trade. Again here we are getting a signal to go long to buy a call option. Then we will draw a trend line for this trend and this is the trend line. We can hold our call option as long as prices are above this trend line. Then this is a bearish crossover. We will not make any entry here. We will make entry only when 14 period moving average is above 21 period moving average and RSI is above 50 level. Then this is the point where we can buy the call option and then we will draw a trend line for this up move. This is the trend line. Now as long as prices are above this trend line, see here moving average set is also giving exit signal and prices are going below this moving average, so we can exit here. Again here at this candle we are getting a buying signal. This was a gap up opening, so we will draw a trend line for this up move and this is the trend line. Now this candle is crossing down the trend line, so we will exit here. Similarly, we can buy call option at this candle because at this candle we are getting a buying signal. We will draw a trend line for this up move and see here prices are very far from the trend line, so we can exit here because this is a resistance level. See, this candle is resisting this level and prices are very near to resistance level. We can see a consolidation here, so we should exit here. Now at this candle we are getting a buying signal. This is a bullish crossover. We can buy our call option here. Then we will draw a trend line for this up move. This is the trend line. And here with the moving average set we are getting an exit signal. Now this was the line on daily chart and after this line, after this time period, we will not make any buying position in call option. Similarly in downtrend, this was the chart of RCOM and prices were in downtrend. Here this was a signal to buy put options and this is 7th of July. And this was the signal from moving average set to exit from put options and this is 3rd of November. So for monthly expiry we cannot hold our trade for 5 months. That's why we should enter and exit the trade on hourly chart. Now on hourly chart this is 7th of July and this was the signal from moving average set to buy put options because prices are in downtrend on daily chart. And then we will draw a trend line for this down move. Now as long as prices are below this trend line we can hold our put option, but see here RSI is giving a bullish divergence, so we will exit here. Now here 14 period moving average is above 21 period moving average. We will ignore these signals because we will trade only sell signals. So here we are getting a short sell signal with the moving average set at this candle, this green candle, and We can buy put options here. Then we will draw a trend line for this down move. This is the trend line, and here at this candle prices are very far from this trend line, so we will exit here. So in this way, for monthly expiry, first we should analyze the chart on weekly time frame, then we should analyze the chart on daily time frame, and according to that we should trade in the same direction of the daily chart, but we will make our entry on hourly chart and also exit on hourly chart. Now we will analyze the chart of Reliance Industry. Stock is in uptrend and it was a sharp up move. This is the resistance level and this is also a resistance level. RSI is above 50 level on hourly chart. See, Bollinger Band is going in upward direction but it is contracting. So I'm expecting a bullish move in the prices, but up to only resistance level. I'm moderately bullish in this stock. So if we see the options chain of Reliance Industries, currently stock is trading at 1383 level, so we can buy 1380 strike call option that is trading at 51.60 rupees. But the highest open interest is in 1400 strike, that's why I'm expecting a up move only up to 1400 strike. Welcome back everyone. In the previous lecture we have analyzed the chart of Reliance Industry and bought the call option of 1380 strike. See, this was a sharp up move in the prices of Reliance Industries and currently it is trading at 1413 level. Moving average set was giving us a buy confirmation and it was near the trend line, so I bought the call option of Reliance Industries, and now you can see this is a resistance level and above this level there is one more resistance level, that is a Fibonacci level. So I'm expecting a retracement in the prices. Prices are going very sharply in upward direction, so I'm expecting a sharp reversal. And in options chain, 1380 strike is trading at 69.35 rupees. Our buying price was 51.60 rupees. Now it is trading at 69.35 rupees. So we can close our position here and our profit is more than 25% in just 2 days. Lot size is 500 for Reliance Industries. So in this trade our approximate profit is 8,000 rupees because we are selling our call option at 69.35 rupees. The move is very sharp, so I'm expecting a consolidation here or a little retracement in the prices. Also, the highest open interest is in 1400 strike, so I'm expecting a retracement from this level. Welcome back to our next analysis. In this lecture, we will analyze the chart of Tesla Incorporation. This is the daily chart of Tesla Incorporation and you can see Tesla is in downtrend and moving in this channel. The channel is not parallel but the channel is converging here. So you can see currently prices are taking support on the support line of this channel. So if we see the hourly time frame chart for the perspective of positional trading, you can see here that at the support line of this channel, stock made a double bottom pattern and at this level RSI was giving a positive divergence, that is a signal to go long in the stock because stock is trading at this support line of the channel and I'm expecting an up move in the prices up to this black line. So if we see on daily chart, see the stock is in downtrend and this was the up move. For this up move, this is the retracement phase, so I applied Fibonacci from the lowest point to the highest point of this up move and this level is 61.8% level, this lower level is 78.6% level. Now currently prices are trading in between these two levels and as on hourly chart we are getting a positive divergence on RSI. That's why my view is bullish for the stock and I'm expecting that prices will touch this 61.8% level, and here it will consolidate near this blue line because these two levels will act as resistance level for the prices. But up to these two levels my view is bullish in the stock, so we can buy the call option. And if we see the options chain, today is the 2nd of May, so we will choose the expiration date as 31st of May, and the at the money call option is trading at $13.10. So here we can buy this call option, or as the stock is taking support on this blue line, and at this level the stock made a double bottom pattern and the level is $231, we can sell this strike. And for hedging, we can buy 225 strike, that is trading at $8.40. Welcome back everyone, this is 5th of May. In the previous lecture, we have analyzed the chart of Tesla Incorporation. Tesla was trading in a channel in downside. You can see this is the daily chart and Tesla is moving in this channel, but as prices were trading near the support line of this channel and there was a double bottom pattern on hourly chart. See, on hourly chart there was a double bottom pattern. RSI was also giving a positive divergence, so here RSI is breaching this resistance line in upside. So at this candle there was a buying signal in the stock, and as this was a gap up opening, it means momentum was very high in this stock and I was bullish for the move. That's why I suggested to buy the call option of Tesla Incorporation, and my target was this black line because this is the important level, Fibonacci level. That's why I was bullish up to this black line, but near this black line I'm expecting a consolidation. And you can see today is the 6th of May and I initiated my trade on 2nd of May for the short-term perspective. So within 2 days, stock is trading near this black line at $257.35 and RSI is going in overbought range. So it was a very sharp up move in Tesla Incorporation. And if we see the options chain of Tesla Incorporation, today Tesla is 0.49% up and yesterday it was approximately 5% up. So it was a very sharp up move in the prices. And if we see the 240 strike, expiration date was 31st of May and the strike was 240. So the price of 240 call option was $13.10 and now it is trading at $22.75. Now we will sell the call option. So we will see the bid price and it is $22.75. So here, as the trend is downtrend in the stock, so in downtrend we should buy the put option, but as the stock was trading at the support level of the channel, there was a double bottom pattern, that is a bullish reversal pattern, and there was a bullish divergence in RSI, and with the divergence strategy it was a buying signal in the stock at the gap up opening. That's why my view was bullish for the move and I bought the call option of Tesla Incorporation. Now currently prices are very near to this black line, that is an important level. That's why I'm expecting a consolidation near this line, and if prices will able to breach this black level in upside, then the next target will be this blue resistance line of this channel and prices can touch this blue resistance line. But currently I'm expecting a consolidation at this black level or a little retracement in the prices. Welcome back everyone, this is 20th of May. On 13th of May we have analyzed the chart of Bharti Airtel and conclude that the stock is in uptrend, and see this is the uptrend line for the stock RSI was also above 50 level, so view was bullish for the stock because the stock is in uptrend, and currently stock is trading at 337.75 rupees. So if we see the options chain of Bharti Airtel, in Bharti Airtel I have bought the call option of 330 strike that was trading at 10 rupees, and now 330 strike is trading at 15.65 rupees. So in this trade our approximate profit is more than 50%, and here we are getting 5.65 rupees per share. The lot size for Bharti Airtel is 1851. So we will calculate our profit. So if we multiply the profit from the lot size, here we are getting 10,458 rupees. That is more than 50% return in just 1 week. So here I am closing my trade because in Bharti Airtel this level is the resistance level for the prices, and you can see prices are taking support here and prices are taking support here. So this level is an important level. That's why we can see a consolidation here. So as I'm getting a more than 50% return in this stock, so I'm closing my trade here. But if prices breach this level in upside, I'm still bullish for the stock, and after the breakout of this level, we can go long in the stock. Hello everyone, now we will analyze the chart of Vedanta Limited. See, Vedanta is in downtrend, and you can see here we are getting a head and shoulder pattern in Vedanta, that is a bearish pattern, and after the breakout Vedanta is going in downward direction. So my view is bearish about the stock because momentum is very high in Vedanta. See, this is the support level and RSI was giving a positive divergence. So RSI is breaching the support line and candle is also breaching this support line. That's why momentum is very high. Here we are getting a failing divergence. It means very high momentum. And see, on daily chart in Vedanta Limited we are getting a head and shoulder pattern. That's why my view is bearish about the stock. On hourly chart also moving average set is giving a bearish signal. That's why we can buy the put option of Vedanta Limited. So if we see the options chain of Vedanta, we will take the next month expiry. We can buy the put option of 170 strike, that is trading at 9.80 rupees because currently Vedanta is trading at 167 rupees. So it is slightly in the money put option. We will buy this put option that is trading at 9.80 rupees. Welcome back everyone, this is 8th of May, and in the previous lecture we have analyzed the chart of Vedanta Limited in which Vedanta was in downtrend, and I bought the put option of Vedanta of 170 strike because there was a head and shoulder pattern, that is a bearish pattern, and on daily chart we are also getting a head and shoulder pattern. So my view was bearish about the stock, and moving average set was also giving a bearish signal. So I bought the put option of 170 strike, and you can see today there is a sharp down move in the prices, and this is the moving average set. The candle is trading very far from both the moving averages, so I am expecting a bounce in the prices. If we see the options chain, the expiration date is 30th of May and 170 strike is trading at 15.70 rupees. So in this trade our profit is 5.8 rupees per share. And if we see the lot size of Vedanta, the lot size is 2300. So in this trade our profit is 13,340 rupees. Our total investment was approximately 22,500 rupees, and now our profit is 13,340 rupees. So it is approximately more than 50% profit in just 1 week. The expiration date is 30th of May, but as we are getting more than 50% profit in just 1 week and prices are trading very far from both the moving averages, so I'm expecting a bounce in the prices. That's why we should close our trade here, and in the bounce we can lose the premium. So in this trade, I got more than 50% return in just 1 week. Here I'm expecting a bounce, and if we get another opportunity to trade this stock, then we can again buy the put option in Vedanta, because on daily chart we are getting a head and shoulder pattern and my view is bearish about the move because Vedanta is in downtrend. But here, as prices are very far from both the moving averages and I'm expecting a bounce, that's why we should close our trade here.
Hello everyone, let's analyze the chart of Yes Bank. Today it is a very bad day for Yes Bank. The stock is 30% down and trading at 170 rupees. After the statement given by Yes Bank that it incurred net loss of 216 million. So it is really a very bad news, and now I'm expecting a further down move in Yes Bank due to this bad news. You can see this is a very long candle, and here we should buy the put option of 170 strike. So let's analyze the options chain of Yes Bank. 170 strike is trading at 16.90 rupees. So we can buy this put option, and I'm expecting a sharp down move in the stock. We can see a consolidation here, but still my view is bearish about the move. That's why we should buy the put option of at the money strike, and that is 170 strike, that is trading at 16.90 rupees. Welcome back everyone, this is 16th of May. On 30th of April, in Yes Bank there was a gap down opening and there was a sharp fall in the prices because of some bad news, and my view was bearish about the price movements because this was a gap down opening and the candle was long bearish candle. That's why I was expecting a sharp fall in the prices, and you can see prices are trading at 141 rupees. So on that day I suggested to buy the put option of Yes Bank of 170 strike, that was trading at 16.90 rupees. I suggested to buy the put option in Yes Bank because you can see on daily chart the stock is already in downtrend, and this was the Fibonacci cluster. When prices breached this Fibonacci cluster in downside, there was a gap down opening below this Fibonacci cluster and prices breached the second Fibonacci cluster. You can see this candle was taking support at this line, and the momentum was so high that this candle is closing exactly at Fibonacci cluster line. That's why my view was bearish about the move. Now if we see the options chain of Yes Bank, the expiration date was 30th of May and 170 strike is trading at 32.70 rupees. So our buying price of this put option was 16.90 and now it is trading at 32.70 rupees. So in this trade our profit is 15.80 rupees per share. And if we see the lot size of Yes Bank, the lot size of Yes Bank is 1750. So we will multiply our profit with the lot size, that is 1750. So in this trade our net profit is 27,650 rupees. Now if we analyze the chart of Yes Bank, you can see on daily chart Yes Bank is trading in this parallel channel, and this is the lower line of this parallel channel, but near this line there is a support level and this is 126.70 level. So I am expecting that prices will take support on this level, as this was a very sharp fall. So I am expecting a bounce from this level. So we should not buy the put option of Yes Bank now, because RSI is also giving a positive divergence. You can see on hourly chart RSI is giving a positive divergence. So if prices take support on this black line, that is the support level, then we can sell the put option of Yes Bank and also hedge our position, because I never suggest to sell naked options. So in this trade our net profit is 27,650 rupees, and that is approximately 50% return in just 15 days. Thanks for watching. I'll see you in the next lecture.
Hello everyone, welcome back to our next lecture. In this lecture, we will analyze the chart of Apple Incorporation. This is the daily chart of Apple Incorporation, and you can see after a sharp down move, now Apple is in uptrend, but currently Apple is trading in this parallel channel and it is very near to the resistance line, the upper line of this channel. Here RSI is giving a negative divergence, so I'm expecting that prices will touch this resistance line again, but prices will not breach this line in upside, so we can sell the call option here. And if we shift the early time frame chart, see here, this was a doji candle. After this up move near the resistance line, prices are going in downward direction. We can see a consolidation near this resistance line, but I'm expecting that prices will not breach this line in upside. And after a consolidation here, we can see a down move. So here we will see the options chain of Apple Incorporation. Today is 2nd of May, so we will take the expiry of 31st of May. And this blue line, the upper line, is the level 217.5 level. This is at 217.5 level, so we will see the strike 217.5 strike is trading at $1.98, so we can sell this call option here and we can buy 222.5 strike that is trading at $0.98. We can also do one thing here, that we can buy the put option here because I'm expecting a down move in the stock. Stock is trading at 212.45, so we will see the out of the money put option, and 210 strike is trading at $4.40, so we can buy this put option trading at $4.40. Welcome back everyone, this is 7th of May. In the previous lecture, we have analyzed the chart of Apple Incorporation. The stock is moving in this channel on daily chart. See, this was the upper line of the channel. So near the upper line of this channel, near this blue line, there was a shooting star candle, and the shooting star candle near a resistance level is the signal to go short. So the next candle was the red candle. That's why my view was bearish about the stock, and I was bearish about the move up to this black line, up to this Fibonacci cluster. So prices are trading very near to this black line. On daily chart, there was also a negative divergence in the stock. See here, RSI is going in downward direction, but these two peaks were going in upward direction. And near this blue line there was a shooting star candle, so it was a bearish signal. And also on early chart we were getting a negative divergence, that's why my view was bearish about the stock. So I bought the put option of Apple Incorporation because I was bearish about the move, and currently prices are trading near this black line and near this Fibonacci cluster. I bought the put option of Apple Incorporation of strike 210, and if we see the current price of 210 put option of Apple Incorporation, see the expiration date is 31st of May and 200 strike is trading at $9.20. So when we bought this put option, it was trading at $4.10. and now it is trading at $9.20. So it is more than 100% profit in just 4 days. If we draw the trend line for this down move, see, this is the trend line. On hourly chart, this is the trend line for the move, and currently if we draw the parallel channel, currently prices are very near to this support line. Therefore, I'm expecting a bounce in the prices and I'm closing my trade here. So in this trade, our buying price was $4.10, and now we will sell the put option. So we will see the bid price. It is trading at $9.05. So in this trade, our profit is $5.05 per share and the lot size is 100. So our net profit is $505. And this is the profit in just 5 days, more than 100% return. So it's not necessary that we should buy the put option only in downtrend. We can also buy the put option when prices are trading near the upper resistance line of the channel, if prices are moving in a channel and there was a shooting star candle, that was the reversal candle on daily chart, and we were getting negative divergence on daily chart and on hourly chart. We were getting a negative divergence on both the charts. That's why my view was bearish about the move, and I bought the put option of Apple Incorporation because I was expecting a down move in the prices. So welcome back to our next analysis. You can see this is the hourly chart of Wipro, and Wipro has made a very sharp up move from this point. This is the point on trend line. If we see this trend line on daily time frame chart, see the stock is moving in an uptrend and this is the trend line for the stock. But on hourly chart, this was a very sharp move in Wipro, so I'm expecting a retracement in this stock. And on hourly chart, you can see this is the trend line for the up move on hourly chart, and for these two peaks RSI is giving a negative divergence, and if we apply the moving average set, it is also giving a sell signal here and RSI is below 50 level. If we apply Bollinger Band, you can see Bollinger Band is going in downward direction. It means we can expect a down move in the stock. And see, this is the today's first hourly candle, and stock is trading at 292 rupees. I'm expecting a down move in the stock, so we can buy the put options of Wipro here. Though the stock is in uptrend, but as it was a very sharp up move, that's why we can expect a sharp retracement in the stock, and we can buy the put options of Wipro here at this point. So if we see the options chain of stock, this is the options chain of Wipro, and the expiration date is 30th May. Today is the 3rd of May. So we will see the put option price. The stock is trading at 292 rupees. So here we can buy the 290 put option, and that is trading at 4.35 rupees. The lot size of Wipro is 3200. So it will be an investment of approximately 14,000 rupees. So here we can buy the 2 lots of put option of 290 strike at 4.35 rupees. Welcome back everyone. This is 22nd of May, and in Wipro I have bought the put option of 290 strike at 4.35 rupees. Now if we analyze the chart of Wipro, see, after the negative divergence, Wipro broke the trend line. This is the uptrend line for the stock on hourly chart, but on daily chart, the stock is in uptrend and currently in retracement phase. So I'm expecting that stock can touch the trend line of this uptrend, but on hourly chart, the stock was in retracement phase. That's why after the negative divergence, my view was bearish in Wipro, and when it was a breakout of this trend line, I bought the put option of Wipro of 290 strike that was trading at 4.35 rupees. Now if we see the options chain of Wipro, the expiration date is 30th of May and today is 22nd of May. So if we see the price of our 290 put option is trading at 8.60 rupees. Now we will sell our put option. So we will see the bid price, and it is 8.60 rupees. The lot size of Wipro is 3200. So in this trade our profit will be 8.60 minus 4.35 is equal to 4.25 rupees per share. The lot size is 3200. So we will multiply this amount to 3200. So our profit is 13,600 rupees in this trade. So in this trade, our total investment was 14,000 rupees, and now we are getting 13,600 rupees. So it is approximately 100% return in this trade. That's why we should close our trade here, because today it was a very long candle in Wipro and it is trading at 282.55 rupees. And tomorrow is the results of elections. That's why I'm closing my trade here with a profit of 100%, but I'm expecting that prices can touch this trend line, uptrend line that I have drawn on daily chart, and RSI is still above 20 level. That's why I am expecting a further down move in the stock. Let's take one more live trade. See, this is the weekly chart of Punjab National Bank and the stock is in consolidation phase, now going in downward direction. And if we draw the support line for this down move, the stock is moving in this channel. So on daily chart, the stock is in downtrend and touching the upper resistance line. Moving average set is giving us a sell confirmation, and on hourly chart we are getting a head and shoulder pattern formation. That's why my view is bearish about the stock, and you can see the current candle is a long red candle. So here I can expect a bounce in the prices, but still my view is bearish about the move because stock is trading in a downtrend. That's why I'm expecting a down move in the prices, and we can buy in the money put option for the stock for next month's expiry. So if we see the options chain, the expiration date is 31st of May. So here we can buy the in the money put option of 90 strike, and this put option is trading at 7.85 rupees. So we can buy this put option. The lot size is 7,000. So in this trade, total investment is approximately 50,000 rupees. Welcome back everyone. This is 13th of May. In the previous lecture, we have analyzed the chart of Punjab National Bank. On daily chart, see Punjab National Bank is in retracement phase and it is in downtrend. The stock is moving in this bearish channel, and you can see when it was a pullback rally, prices were touching the trend line here, and when prices were touching the trend line on hourly chart, it was a head and shoulder pattern formation, that is a bearish reversal pattern. So at the breakout of this pattern, see the candle, this candle was very long candle, and when we get a long candle at the breakout and volume is also high at this candle, so the sentiments were bearish about the prices because the head and shoulder pattern is a bearish reversal pattern, and at the breakout candle there was a high volume. That's why I bought the put option of Punjab National Bank because my view was bearish about the stock. The target of this head and shoulder pattern was this at 81.10 rupees, and currently the stock is trading at 80.35 rupees. It is below the target level of this head and shoulder pattern because today it is a very sharp down move in the Punjab National Bank stock, and I have bought the put option of 90 strike that was trading at 7.85 rupees. Now if we see the options chain of Punjab National Bank, 90 strike is trading at 10.70 rupees. We have bought the put option, but now we will sell it. So we will see the bid price. Our buying price was 7.85 rupees, and now we want to sell our put option. So we will see the bid price. It is trading at 10.70 rupees. So in this trade, our approximate profit is 2.85 rupees per share. And if we see the lot size of Punjab National Bank, the lot size is 7,000. So in this trade, our net profit is 2.85 multiplied 7,000. It is approximately 20,000 rupees in just 2 weeks. So we bought the put option at 7.85 rupees. So our approximate investment in this trade was 50,000 rupees, and now we are getting 20,000 rupees in this trade. So here I am closing my trade with a profit of approximately 20,000 rupees. Welcome back to our next lecture. Now in this lecture we will analyze the chart of Wokhard, and we will analyze the chart for short-term perspective. First of all, we will see the daily chart of Wokhard. You can see the stock is in downtrend, and this is the downtrend line for the stock. When stock was going in upward direction to touch the trend line, then it was a head and shoulder formation on hourly chart. You can see on hourly chart, stock was making a head and shoulder formation, that is a bearish pattern. So when prices break this pattern with heavy volume, you can see the breakout candle is long red candle, it means there was a very high volume at this candle. See, the volume was very high at this candle, at the breakout candle. So I was bearish about the move and I entered in my short position in the stock when it was trading at 405.80 rupees. So I entered in my short position on 2nd of May and I bought the put option of Vocard because when we get a head and shoulder pattern, that is a bearish pattern in a downtrend, then it is a very strong signal to make a sell position in the stock. That's why I bought the put option of Vocard, and when it was trading at 405 rupees on 2nd of May, the put option was trading 410 strike put option was trading 22 rupees and I bought the put option of that strike. Now it is trading at 48 rupees because after the breakout of this head and shoulder pattern, it was a very sharp fall in the prices. That's why this put option is trading at 48 rupees. But now we have to sell the put option, so we will see the bid price, that is 42 rupees. So there is a spread, wide spread between buying and selling price. But as I am getting approximately 100% profit in this put options, so I can sell the put option at 42 rupees here at this price. So it was a head and shoulder pattern in the downtrend. Stock was in downtrend and we could wait for the prices to touch the trend line, but when it was a head and shoulder pattern before the touch of this trend line, that was giving us a sell signal, and this was the pullback rally. So if we draw the trend line for this pullback rally, this was the trend line and stock broke the trend line here. After this breakout, there was a breakout of neckline of head and shoulder pattern, and RSI was also giving a negative divergence. So all the signals were giving the confirmation to go short in the stock. That's why I entered in my short position. I bought the put option of Vocard and it was a very sharp fall in the prices and I am getting 100% profit in this put option. Hello everyone, let's take one more example in which we will analyze the chart of Oracle Corporation. You can see this is the daily chart of Oracle and here the stock made a double bottom pattern. Then you can see it is a very sharp up move in the stock, and now at the end of this up move the stock is making a rising wedge pattern. And for this pattern, this is a reversal pattern in which we get a negative divergence in RSI. You can see here that stock is going in upward direction, but now momentum is slowing here because this was the sharp up move, and now stock is moving in short swings between this rising wedge pattern, but RSI is giving a negative divergence and you can see RSI is breaching the support line, and here also this red candle is breaching the support line of this rising wedge pattern. That's why my view is bearish for the stock. If we shift the early time frame chart, we can see moving average set is also giving us a sell signal, and this candle is trading below the support line of this rising wedge pattern. That's why I'm expecting a retracement in this stock, and the retracement can be very sharp because it was a very sharp up move in the prices. And if we apply Fibonacci to this swing for the retracement phase, see the 23.6% level, the first level is this, and this is $52.38. So here we can buy the put option of this stock. And if we see the options chain of Oracle, now today is 2nd of May, so we can buy the put option for this expiry, and currently the stock is trading at $54.56 and I'm expecting a down move in the stock up to $52.54. So the first target will be 23.6% level. So here we can buy the put option of 54 strike, that is trading at $0.89. The first target level will be 23.6% level, that is at $52.44. So here we will buy the put option that is trading at $0.89. Welcome back everyone. Now we will analyze the chart of Oracle, and In this chart, my view was bearish because Oracle was in uptrend, and at the end of this uptrend, there was a bearish chart pattern that was a rising wedge pattern. Rising wedge chart pattern is a bearish reversal pattern, and this pattern is found in an uptrend at the end of uptrend, and RSI should give a negative divergence. So you can see this was the rising wedge pattern and RSI was giving a negative divergence. The breakout was in downside. This was the breakout candle and my view was bearish because this is a bearish reversal pattern. So I bought the put option of Oracle on 2nd of May of strike 54 that was trading at $0.89. And now if we see the prices, there is a sharp downfall in the prices. You can see this candle is breaching this 23.6% level. I was expecting that prices will take support on this level, and now prices are breaching this level and this candle is closed below this 23.6% level. So the next target will be 38.2% level. Currently prices are going in downtrend and this is the downtrend line for the stock, but you can see there is a sharp downfall in the prices. And if we see the options chain of Oracle, this is 29th of May and the expiration date was 31st of May. So I have bought the put option of 54 strike at $0.89 and now it is trading at $2.45. Now we have to sell the put option. So we will see the bid price and it is $2.45. So if we calculate our profit in this trade, our profit is $1.56 per share and the lot size is 100. So in this trade, our profit is $156. Our investment in this trade was only $89. So here we are getting 175% return in this trade. That is a very good return. I was expecting a sharp downfall in the prices because this was the rising wedge pattern, that is a bearish pattern, and also we were getting one more pattern in this stock, that was head and shoulder pattern. You can see here this was the neckline of head and shoulder pattern and prices were forming head and shoulder pattern and this is the breakout candle. So I was expecting a sharp downfall in the prices and that's why I hold my trade till the expiration date. Now it is 29th of May and the expiration date is 31st of May. If we see the highest open interest, it is in 53 strike in put side and in call side it is in 53.5 strike. So I'm expecting a bounce in the prices here up to 53 level. 53 level will act as the important resistance level here. So I'm expecting a bounce in the prices. That's why I'm closing my trade here, and in this trade I got 175% return in 1 month by investing $89 in a single lot. Thanks for watching. I'll see you in the next lecture. Hello everyone, let's take one more example. This is the daily chart of ONGC and ONGC is in downtrend. You can see this is the downtrend line, but this is the third point, so this is not a confirmed downtrend and RSI is touching the 70 level. Prices are above the downtrend line, so we will analyze the hourly chart to know the position of our trade. On hourly chart, the stock is moving in an uptrend in a parallel channel. Let me draw the trend line. So this is the trend line for the stock and currently stock is trading near the upper line of this channel and RSI is giving a negative divergence. So my view is bearish about the move and we can buy the put option of ONGC because I'm expecting a retracement in the prices. See here, I'm expecting that prices will at least retrace up to this trend line. Then we will see the price action near this trend line. If prices will able to hold this trend line in upside, then we can see a fresh uptrend in the stock. And if prices breach this downtrend line in downside, then we can see a further down move in the stock. But currently my view is bearish. So we will see the options chain of ONGC. Currently prices are trading at 168.40 rupees. So we can buy the put option of 165 strike, that is out of the money strike. So we can buy the put option of 165 strike that is trading at 3.90 rupees. Hello everyone, welcome back. Let's analyze our previous chart. In the previous lecture, we have analyzed the chart of ONGC, and now this is 16th of May. ONGC was in downtrend on daily chart, and on hourly chart, the stock was trading in this parallel channel, and it was a very sharp up move in the prices, and it was trading near the upper level of this channel, and it was the level near the trend line. That's why I was expecting a very sharp down move in this stock, and I suggested to buy the put option of ONGC. Now, as this is 16th of May, let's see the options chain of ONGC. The expiry is 30th of May. On 29th of April, I bought the call option of 165 strike, and it was trading at 3.90 rupees. And now ONGC is trading at this trend line. This is the trend line. I was expecting a down move at least up to this trend line, and as now it is trading at trend line and taking support on this trend line, so I will cover my position here. My put option was trading at 3.90 rupees, and now I have to sell my put option that is trading at 5.70 rupees. So in this trade, our profit is 5.70 minus 3.90 is equal to 1.80 rupees per share. And if we see the lot size of ONGC, the lot size of ONGC is 3750. So our net profit in this trade is 3750 multiplied 1.80 is equal to 6750 rupees. So it is a profit of approximately 75%. And now if we analyze the chart of ONGC, see on daily chart, this is the trend line for the stock. ONGC was trading above the trend lines as it was a very sharp up move in the stock, and on hourly chart I was getting a negative divergence. That's why I was expecting that it will take support on this trend line. Now if prices breach this trend line in downside, then we can again buy the put option of ONGC as the stock is already in downtrend. But currently, as prices are taking support on this downtrend line, if prices are not able to breach this downtrend line in downside and move in upward direction, then it may be a starting of new uptrend. So here you can see on hourly chart, prices are taking support on this trend line, so we should wait for the confirmed signal. On hourly chart, moving average set was also giving a sell signal, and now as moving average set is going sideways, so we should wait for the confirmed signal. If prices breach this trend line in downside and moving average set is already giving a sell signal, then we can sell a put option up to this zone, this Fibonacci cluster. And if prices go in upside and moving average set will give a confirmed signal to go long, then we can go long in this stock because it can be a starting of fresh uptrend.
Covered call strategy is one of the most basic and widely used option strategies. This strategy is executed by going long in an underlying asset and selling call option. It means that covered call writing is the simultaneous purchase of stock and the sale of a call option. Though the covered call can be used in any market condition, it is generally used by investors when they are bullish on an underlying stock but feel that stock won't rise much over the lifespan of the call contract. Covered calls are a way to earn additional income on your stock portfolio. For conservative investors, selling calls against a long stock position can be an excellent way to generate income. By doing this, the writer receives cash for selling the call, but will be obligated to sell the stock at call strike price. It means an investor is paid for agreement to sell his holdings at a certain level, thereby capping further upside stock price participation. On the downside, limited stock price protection is provided by the premium received from call writing. Maximum gain is limited and maximum loss is substantial. The upside profit at expiration is limited to premium received from the call sale plus the difference between its strike price and the stock purchase price, and the loss can become substantial if the stock price continues to decline in price. However, any loss acquired from a decline in stock price is offset by the premium you received from the initial sale of the call option. Now we will take an example to understand the strategy. Suppose a trader purchases 100 shares of ABC company trading at $67 and he writes a January 2018 77 call for $1. So he pays $6,700 for 100 shares of ABC company and receives $100 for writing the call option. By selling the $77 call, he is agreeing to sell the stock at $77. If on expiry the stock had rallied to $77, since the stock price of the call option is $77, it expires worthless and his net profit will be 77 minus 67 multiply 100, that is 1000 plus $100 is equal to $1100, which is the maximum profit. If stock rallies to price above the strike price of the option call, say $87, then call is assigned and he sells the 100 shares to call buyer at $77 for a profit of $1000. And considering the premium of $100 received while writing the call, his total profit amount will be $1100, which is the maximum profit. But if stock price falls, he will incur a paper loss of $300 for holding the 100 share. However, this loss is offset by the $100 premium received, so the total loss is $200 instead of $300. The advantage of this strategy is to make profit even if stock stays stagnant. And disadvantage of this strategy is that the upside profit is capped. Now we will analyze the chart and see how to take advantage of this strategy. This is the daily chart of Apple Incorporation and we just draw the trend line by joining two initial points. This is the trend line. This is the upper trend line and this is the range of this stock. Now we will zoom in the chart. Now see here, this is the retracement phase and see this candle. After touching the trend line, now prices are in uptrend. And the point was $166. This is the point, $166. Suppose you have purchased 100 shares of Apple at price $168 when prices started to rise after testing its trend line. Instead of selling a call at that point, you should wait for the up move in prices. Now the stock is trading at $175. This is the range of this stock, so it can go to test the upper trend line, that is the level $183. But as we are getting a negative divergence in the stock, we are expecting a moderate bullish market. Now the stock is trading at $175 and you are getting a profit of $7 per share, overall $700. But still you are expecting a up move in the stock and you want to sell them at $177.5. So you can sell a January 177.5 call of Apple at price $1.05. By doing this, you are paid $105 for agreement to sell your holding at $177.5. Now, if on expiry, the stock rises to this level or above $177.5, your net profit will be 177.5 minus 175 multiply 100 is equal to 250 plus the premium received, that is 105. So your net profit will be $355 from here, from this position. And if stock falls below $175, then you will acquire the whole premium of $100 that you will get from the sale of the call option. In this way, we can make use of covered call strategy in the moderate bullish environment. Thanks for watching the lecture.
So this is 22nd of January 2018 and in our last lecture we were here on 22nd of December 2017 in which I adopted the covered call strategy and this was the level 177.5 level So I suggested to sell the call option of $177.5. The price was $1.05. The lot size is 100. So by selling the call option we received $105. And now after 1 month this red candle is below this line. So our call option expired worthless and it was a successful trade. Currently this is a range bound movement because this level is the strong support level and this pink line is acting as a strong resistance level. On daily chart, prices are responding the 100-day moving average. You can see here every time when prices test this moving average, this is the trade initiation zone and we get an opportunity to buy the call option of the stock. So now as this is a strong resistance level and candles are below this level, we can expect a range bound movement in this range. Thanks for watching the lecture.
A protective put strategy can be executed by buying stock and buying put options with the same strike price that of stock price. In this way, if the stock price declines, the purchased put provides protection below the strike price, and if price rises, we can make unlimited profit. The strategy can also be employed when we are still bullish on a stock we already have but worried about the uncertainties in the near term. In this way, we can protect our unrealized gains on share from a previous purchase. By employing this strategy, the risk of falling prices is limited during the lifespan of the put, and it also different than using a stop loss order on a stock because a stop loss order is sensitive and can be triggered by a sharp fluctuation in the prices. We pay some premium for buying the put for ensuring our portfolio and we are protected from a fall in prices. Maximum profit can be unlimited and achieved when stock price rises, and maximum loss is limited to the premium paid for buying the put option. We should use the strategy at the starting of the short-term uptrend or at the end of the short-term downtrend. Suppose stock ABC is trading at $90 in February and you expect a rise in price, so you can execute the protective put strategy by purchasing 100 shares of ABC at $90 and by purchasing March 2018 ABC put at $3. Lot size is 100, so the net premium paid for the trade is $300. Cost of share will be 90 multiply 100 is equal to $9,000. So the total cost of trade will be cost of shares plus premium paid, that is 9,000 plus 300 is equal to $9,300. If on expiry stock rises to $110, the long stock position will gain $2,000 since you paid a premium of $300 at the time of execution of trade. Your net profit will be $1,700. And if stock price falls to $70, the long stock position will decline to $2,000. However, the bought put will also have an intrinsic value of $2,000, so the total loss will be capped only the premium paid, that is of $300 instead of $2,000. Let's analyze the strategy on chart. This is the chart of Facebook Incorporation. We just draw the trend line for this stock. The stock is in uptrend and we just draw the trend line by joining two initial points, and we also draw the resistance line for the stock. This is the support line and this is the resistance line. The stock is moving in this range. Currently stock is trading at $183.29 and it is trying to cross above its trend line. Also, it is above its 50 and 100 DMA, so we expect a rise in the stock price. If it crosses this line, then we expect a rise in the prices up to the level of this resistance line. So the approximate level of this resistance line is 197.61 level. So we expect a rise up to the level of $195. But as it is trading near its trend line, one can also fear about the fall in prices. So we can adopt a protective put strategy here by purchasing 100 shares of Facebook at $183.29 and buying a put option of 182.5 level of next month expiry. If we see the option prices, 182.5 put ask price is $4.10. We are buying the put, so we will see ask price, and this is $4.10. The expiration date is 23 of March 2018. So the cost of 100 shares of Facebook will be 183.29 multiply 100 is equal to $18,329. And the net premium paid for put option is $4.10 per share. The lot size is 100, so the net premium paid for put option is $410. So the total cost of trade is 18,329 plus $410 is equal to $18,739. Maximum gain can be unlimited and maximum loss is capped to $410. If on expiry the stock rises to $195, the 100 shares of Facebook will gain a profit of 195 minus 183.29 multiply 100 is equal to $1,171, and the net profit will be $761 after deducting the net premium that we paid for buying the put option. And if stock falls to $170 instead of rise, the 100 shares of Facebook will have a loss of $1,329, but the 182.5 put will have an intrinsic value of $12.5 per share, the net value of $1,250. So the total loss will be $489 after deducting $1,250 from $1,329. So our total loss will be $489 instead of $1,329. In this way, our maximum gain can be $761 if stock rises, and our maximum loss is capped up to $489 if stock declines instead of rise. So this is a very good strategy to be adopted in a bullish environment, and if we also ensure our portfolio from a sharp decline. Thanks for watching the lecture.
Welcome back. In our lecture, we adopted a protective put strategy and see the results. We were here on 23rd of February and the price was $183.2. So at that time, this candle was below the trend line and we adopted a protective put strategy in which the cost of put option was $4. Then prices were range bound for 14 or 15 days and now see the fall in prices. The prices are trading at $160 and this is 26th of March. So without a put option, it would be a loss of from 183 to 160, a loss of $2,300. But as we adopted a protective put strategy, our maximum loss in this trade is $489 instead of $2,300. So this is an excellent strategy when we want to buy a share but also fear about the fall in prices. So this trade was also successful. Now in the next lecture we will learn how to sell a put option, and this is called writing put strategy.
Welcome to our next strategy. Writing put strategy is executed by writing or selling put options without underlying stocks. If the stock price rises or remains steady, we can make profit, but the potential loss can be substantial if stock price falls sharply. Writing put strategy is one of the riskiest option strategies and should be adopted only when we have a knowledge of technical analysis. After analyzing the stock's chart carefully and applying a stop loss, we can surely make money in the strategy. Maximum gain is limited to the premium received because we will be paid in the form of premium received for selling the puts in return for accepting the obligation to buy underlying shares if assigned. And maximum loss can be unlimited as the stock falls. The strategy can be used when stock is in an established uptrend and at the end of its retracement phase, or when we get a double bottom pattern in an uptrend, or when last stop of the downtrend is breached upside and also we are getting a positive divergence. Now we will understand the strategy with an example. Suppose stock A is trading at $200 and you decide to write $200 put option at price $2. The lot size is 100, so you receive $200 for writing the put option. In situation first, on the expiration date, if the stock trades at or above $200, then the put expires worthless and you keep the full premium of $200. This is the maximum profit. In second situation, if the stock price drops marginally below $200, say $199, you can still realize a profit. since the striking price of $200 is higher than the current price. The put is assigned and you buy 100 shares of that company from the put holder and sell it at $199 per share, resulting a loss of 1 into 100 equal to $100. But you had received $200 for writing the put earlier. Your profit for the trade is $100. In third situation, if on expiry the stock price drops sharply, say to $195, the put is assigned and you buy 100 shares from the put holder and sell it at $195 in the market, resulting a loss of $500. As you had received $200 for writing the put earlier, so your net loss would be 500 minus 200 equal to $300. But using chart analysis, we can apply a stop loss and exit the trade if the stock price falls down that level. Now we will analyze the chart to know our put writing option position. This is the chart of Intel Corporation and this is the daily chart. First of all, we will draw a trend line. We just take two initial points and join them and extend the trend line. This is our trend line. Now whenever stock rises again after touching the trend line or after crossing down the trend line, we can write a put option. We could write a put option here, then here. Again we could write a put option here. This is the point because this time prices falls down to the trend line and then they rises again in upward direction above the trend line. So this was the point where we could write a put option. But here a strict stop loss must be triggered. Suppose we are writing a put option at $37. In this case, our stop loss would be at $34. As this is an uptrend, after crossing above the trend line, prices will move in upward direction. But if they again fall down to the trend line, we will exit from the trade as they fall down from $34 level. Now see, this is also a 100% retracement level. This is the same level. If we draw a horizontal line here, this is the horizontal line. So you can see this retracement is 100% level. So we can write a put option here at the stop loss slightly below it, $1 or $2. We can write a put option here. We can also write a put option at the end of the downtrend. This is the downtrend and when last stop, this is the last stop. When the last stop of the downtrend is breached in upward direction. Now we can see this is the last top level and this is breached in upward direction. Prices are crossing above this level and also we are getting a positive divergence here. So if we get positive divergence and our last stop of the downtrend is breached in upside direction, then we can write a put option here because this is the starting of the uptrend. In this case, our stop loss will be the last bottom of the downtrend. This is the last bottom, so our stop loss will be at this level. The big advantage of writing put option is that it is a versatile option strategy which can be transformed into other option strategies in order to accommodate changing market outlooks prior to expiration. And the big disadvantage of the strategy is we can lose a lot of money if the underlying stock falls drastically. But with the help of technical analysis, by analyzing the chart at different points, we can execute the strategy and surely make good profit. Thanks for watching the lecture.
Welcome to our next lecture. When we buy options, we pay some premium. But when we sell options, we get money in the form of premium. It means selling options is always better than buying options. Not exactly, because an option seller always has an unlimited risk. But in some conditions, with some disciplined settings, we can sell options. When we sell a call option, it is called call writing, and when we sell a put option, it is called put writing. Without any disciplined approach or settings, we shouldn't sell options premiums because we never know the exact level at which the pullback rally stops. When a stock is in uptrend and retraces up to a level, we should sell put options. And when a stock is in a downtrend and goes into a pullback rally, we should sell call options. In this lecture, I will tell you some settings for call and put writing. For put writing, the stock must be in an uptrend and we should follow the daily chart. Also, we will apply a moving average set to this daily chart. The moving average set will be 100 period, 50 period and 200 period EMA. In an uptrend, 50 period moving average should be above the 100 period moving average and
and both should be above the 200 period moving average with a considerable distance between them. And RSI should be below 40 level and the stock should be in retracement phase. Now see, at this point RSI is going below 40 level, so we can sell our put options because the stock is in retracement phase, but we will not sell put options as long as RSI is below 50 level. This red line is the 50 level, so at this point RSI is crossing above 50 level, we can sell our put options, and this is the candle. Our strike will be the low of this retracement phase, and low of this candle, this last candle, is 178.35. So we can sell here a put option of 178 level. Then we will draw a trend line on RSI, and as long as RSI is above this trend line, we will hold our trade and we will exit at this point. See, this is the point. At this point, our put option will be worthless and we will keep the whole premium by selling put options. Now see, this is the chart of Facebook Incorporation. At this point, RSI is below 40 level. So when RSI crosses above the 50 level, we can sell our put option. At this candle, we can sell put option and the strike will be the low of this candle. And this is the price 162.70. So at this candle, we can sell the put option of 162 strike. And then we will draw the trend line on RSI. As long as prices are above this trend line, we can hold our trade. And at this point, we will exit from our trade, and this is far beyond the point of our short selling. Again, at this point, RSI is below 40 level. So when RSI is above 50 level, we will sell the put option. At this candle, we will sell the put option and the strike will be low of this green candle. This is the level 168.84. Then we will draw a trend line on RSI, and at this point we will exit from our trade. Here we will take the 1 month expiry. So if we count the days between entry and exit position, our entry point is this and the date is 7th of December, and our exit point is this at this green candle and the date is 12th of January. Again, at this candle, RSI is below 40 level. So we will sell the put option when RSI is above 50 level. At this candle, we can sell the put option and the strike will be low of this red candle, and we will hold our trade as long as RSI is above this trend line. At this point, we can exit from our put writing trade. When a stock is in downtrend, 50 period moving average should be below the 100 period moving average, and 50 and 100 period moving average should be below the 200 period moving average. RSI should above the 60 level. At this point, see, RSI is above 60 level and the stock is in pullback rally. The stock is in downtrend and this is a pullback rally. So here we will sell the call options. And at this point, RSI is below 50 levels. So at this candle, we can sell the call option of strike at the high of this candle. We will draw a trend line on RSI. As long as prices are below the trend line, we can hold our trade, and at this point, prices are breaking above the trend line, so we will exit from our trade at this candle. And this is the point 283. Now see here again, RSI is above 60 level and the stock is in pullback rally. So at this point, RSI is below 50 level. So at this point, we can sell call options of strike 247 levels and the candle is at 228 level. And then we will draw our trend line. At this point, we are getting an exit signal. So at this point, this is the level 212. We will exit from our trade. Again, RSI is above 60 level and we will sell the call option when RSI will break down the 50 level. This is the level 50 level and RSI is below 50 level. At this point, this red candle is the signal candle. So we will sell the call option when prices are here at 238 level and our strike will be 260 level. And then we will draw a trend line.
As long as the prices are below this trend line, we can hold our trade. At this point, we are getting an exit signal. So we will exit from our trade at this candle. Now see moving averages. This 50 period moving average above the 100 and 200 period moving average. So stock is in uptrend, and at this point stock is below 50 level. So this is the retracement phase. The stock is in uptrend, and when RSI is above 50 level, at this point we can sell the put option. At this candle we can sell the put option of strike, that is the low of this candle, and we will exit when RSI will break down this trend line. At this candle we are getting the exit signal. So if we adopt these disciplined settings, we can sell options premiums. But we should always keep in mind that the stock should be in uptrend when we are making a put writing trade, and the stock should be in downtrend when we are making a call writing trade. Thanks for watching. I'll see you in the next lecture.
Similarly, for weekly options, our 3D charting is hourly, 15 minute and 5 minute. So on hourly time frame, first we should analyze the chart and see if prices are in downtrend or they are in uptrend. So here prices on daily chart, prices are in downtrend. So on weekly chart, we will find out the downtrend. See, this is the downtrend, and moving average set for weekly expiry will be 10 period and 20 period. First of all, on hourly chart, we will find out the signal. Here 10 period moving average is below 20 period moving average, and RSI is below 50 level. Now in this region, moving average set is giving us a hold signal, and RSI is below 50. At this level, RSI is going above 50. So after this line, we will not buy any put option because prices are in downtrend. We will buy put option. We will not buy call options. Then we will go to 5 minute chart and see this was the signal on hourly chart. So on 5 minute chart, our moving average set will be 10 period and 20 period. Here at this line, this was the signal on hourly time frame. So on 5 minute time frame, here we are getting signal for buying put option. We can buy put option here. RSI is below 50 level. Then we will draw a trend line for the current down move. This is the trend line, and see this candle is very far from this trend line, so we can exit from our trade here. Then for weekly expiry, we will add Bollinger Band to the chart because we want volatility in the prices. And when Bollinger Band is going sideways and it is contracting, we will not make any position, either buying position or sell position. Moving average set is giving a sell signal, and Bollinger Band is expanding. It means there will be a volatility in the prices. Then we will draw a trend line for the current move, and this is the trend line. As long as prices are below this trend line, we can hold our trade, but we will also see RSI, and see RSI is giving us a bullish divergence here. So this is the signal to exit the trade, and at this candle, at this green candle, we will exit from our position. You can see here that Bollinger Band is going in downward direction, but the range of Bollinger Band is very narrow. It means there is very low volatility, but at this candle, Bollinger Band is expanding and moving average set is already giving a sell signal. We can buy put option here, and then we will draw a trend line for the current down move. As long as prices are below this trend line, we can hold our trade, and see here RSI is giving a bullish divergence. So we will exit at this candle. So for weekly option, our 3D charting will be hourly, 15 minute and 5 minute, and moving average set will be 10 period and 20 period. First of all, we will analyze the hourly chart. Also, we will analyze the 15 minute chart and see the current trend. Then we will make a position on 5 minute chart according to these two charts and according to our moving average set. Similarly, for weekly options, our 3D charting is hourly, 15 minute and 5 minute. So on hourly time frame, first we should analyze the chart and see if prices are in downtrend or they are in uptrend. So here prices on daily chart, prices are in downtrend. So on weekly chart, we will find out the downtrend. See, this is the downtrend and moving average set for weekly expiry will be 10 period and 20 period. First of all, on hourly chart, we will find out the signal. Here 10 period moving average is below 20 period moving average and RSI is below 50 level. Now in this region, moving average set is giving us a hold signal and RSI is below 50. At this level, RSI is going above 50. So after this line, we will not buy any put option because prices are in downtrend. We will buy put option. We will not buy call options. Then we will go to 5-minute chart and see this was the signal on hourly chart. So on 5-minute chart, our moving average set will be 10 period and 20 period. Here at this line, this was the signal on hourly time frame. So on 5-minute time frame, here we are getting signal for buying put option. We can buy put option here. RSI is below 50 level. Then we will draw a trend line for the current down move. This is the trend line and see this candle is very far from this trend line, so we can exit from our trade here. Then for weekly expiry, we will add Bollinger Band to the chart because we want volatility in the prices. And when Bollinger Band is going sideways and it is contracting, we will not make any position, either buying position or sell position. Moving average set is giving a sell signal and Bollinger Band is expanding. It means there will be a volatility in the prices. Then we will draw a trend line for the current move and this is the trend line. As long as prices are below this trend line, we can hold our trade, but we will also see RSI and see RSI is giving us a bullish divergence here. So this is the signal to exit the trade, and at this candle, at this green candle, we will exit from our position. You can see here that Bollinger Band is going in downward direction, but the range of Bollinger Band is very narrow. It means there is very low volatility, but at this candle, Bollinger Band is expanding and moving average set is already giving a sell signal. We can buy put option here and then we will draw a trend line for the current down move. As long as prices are below this trend line, we can hold our trade. And see here, RSI is giving a bullish divergence. So we will exit at this candle. So for weekly option, our 3D charting will be hourly, 15-minute and 5-minute. And moving average set will be 10 period and 20 period. First of all, we will analyze the hourly chart. Also, we will analyze the 15-minute chart and see the current trend. Then we will make a position on 5-minute chart according to these two charts and according to our moving average set. Now let's take an intraday example. This is the hourly chart of Reliance Infra and you can see the stock is in downtrend and this is the downtrend line for the stock. Currently prices are taking support on a support level. You can see this level is acting as a support level because prices are taking support here, and this level is also a support level. So on 5-minute chart, this was a gap down opening, and if we apply Bollinger Band here, you can see this candle was outside the Bollinger Band. So after the consolidation, now prices are falling down and I'm expecting that they will fall down up to support level, so we can sell the stock. And if we see the options chain, the current price is 109.40, so we will buy the at the money put option, that is 110 strike, and it is trading at 12.45 rupees. So we can buy this put option and our stop loss will be here on the chart. We will apply our stop loss at the recent peak, that is 111.75 level. So it is 2 rupees up. It means we will apply our stop loss at 1 rupee, that is 11.45 rupees. Welcome back. Now it is 12:45 a.m. in Reliance Infra. It is $28 profit. See, prices are taking support on this support level, and now I'm expecting a bounce. If we see the prices of our put option, 110 strike is now trading at 15.70 rupees. But now we have to sell this put option, so we will see the bid price and it is 15.40 rupees. If we see the chart, prices are taking support on the support level, that is an important level, and I'm expecting a bounce from here because RSI is giving a positive divergence, so we can lose our premium. So we should close our trade here with a profit of 2.95 rupees in this trade. Our total investment was 16,185 rupees and the lot size of Reliance Infra is 1300. So in this trade, our total profit is 2.95 rupees per share and it is approximately 25% return in just 2 hours. So here I'm closing my trade with a profit of 25% in just 2 hours.
So this is 2nd of January 2019 and tomorrow is the Bank Nifty's weekly expiry. So in this lecture, we will see how to trade Bank Nifty's option for intraday. In the morning, this red candle gave me a selling signal. The moving average set was 5 period and 10 period, and also the range of Bollinger Band was very narrow here. At this candle, Bollinger Band was expanding, so it gave me a selling signal. And at this point, the level was 27,330. And I just bought the put option of 27,000 that was out of the money put option. The price was 22 rupees and I was bearish about the trade. So at this point, moving average set gave me the exit signal and I exited from my position. The level is 27,133. At this time, 27,000 put option is 70 rupees. And I exited from my position at 75 rupees. So my put option bought price was 22 rupees and I exited from my put option at 75 rupees. At this candle, RSI was also giving us a selling signal because it was below 50 level at this candle. We will also analyze the chart, the daily chart, why these two levels are important levels. See, these candles are very near to this level. And now Bollinger Band is going sideways. I am expecting a sideways movement within this range. If we see the open interest of Bank Nifty, see this is Bank Nifty's open interest and the open interest is highest for 27,000 strike. So this level is the strong support level. Also on chart, 27,055 level is acting as a strong support level. We will see on daily chart which level is this. And in upside, the open interest is highest for 27,500 strike and the second highest open interest is for 27,300 level. And in the morning, Bank Nifty was moving at this level. So it was a move from 27,300 level to 27,055 level. On daily time frame, Nifty is moving in an uptrend. And this is the swing. I just applied Fibonacci to this swing and this level. This level is the 78.6% level. This is the accurate level. Let me correct it. The level is 27,375 and this level is the strong support level because these three peaks are resisting this level. So these two levels are the strong levels and see the second highest open interest is at 27,300 and the highest open interest is 27,500 level. So that's why these levels are the important level. Now in next few days, if Nifty break this level in upside, the next level is 28,400 level and in downside, the next level is 26,550 level. So in this way we can trade Bank Nifty near the expiration and our chart will be 5-minute chart for intraday trading. The moving average set will be 5 period and 10 period EMA and we will see the Bollinger Band range. If we get a breakout at Bollinger Band and RSI gives us confirmation, then we can make our position. So in this trade, It was a more than 250% profit because the buying price of put option was 22 rupees and the exiting price was 75 rupees.
Hello everyone, this is 3rd of April and today is Wednesday. Tomorrow is Nifty 50 weekly's expiry. So let's analyze the chart and see the options chain and try to find out today's move. It is 9:20 am and market has opened. See the doji candles. Bollinger Band is going in upside but RSI is giving a negative divergence. It means there is a bearish sign, and if we change hourly chart we can see Nifty is moving in this parallel channel and currently it is touching the resistance line very near to the resistance line of this channel, and see this candle is very near to the upper band of Bollinger Band. That's why my view is bearish for the Nifty. But let's see the options chain. See, this is 3rd of April and tomorrow is the Nifty 50 weekly expiry. So if we see the highest open interest in call side, the highest open interest in call side is at 11,800 strike, and currently Nifty is trading 11,750 level. So this is very close to the resistance level. 11,800 level will act as resistance level for Nifty. So my view is bearish about the Nifty for this expiry for today's move, and we can buy the put options of Nifty if we get a signal from moving average set. One thing we can also do is that we can sell Nifty 50 future and buy 11,800 call option. And if we see the price of 11,800 call option, it is trading at 26 rupees. So we can buy this call option and we can sell Nifty future. As RSI is also giving a negative divergence, on hourly chart also you can see RSI is going downward. So my view is bearish for today's move. We can sell Nifty future and buy call option. Nifty can touch this level in downside, and see highest open interest is in 11,600 and 500 strike. So my view is bearish about the Nifty. Welcome back everyone, this is 4th of April and this is the expiration day. The time is 3 p.m, the last half an hour of the expiry, and if we see the movement of Nifty, it is a very sharp fall in Nifty 50. See, yesterday Nifty was trading here at 11,750 level and my view was bearish about the Nifty. 11,800 call was trading at 26 rupees. And from this point, now it is a fall of approximately 150 points. So if we see the options chain, 11,800 call is trading at 0.05 rupees. It means in call there is a loss, but if we see our profit in selling the Nifty future, it was trading at 11,750 level. So from that level, we made a profit of 150 points in Nifty 50. If we subtract 26 rupees, then our profit is 125 points. Lot size is 75, so our net profit in this trade is approximately 10,000 rupees. And this is a profit only with single lot. Here I sold 4 Nifty future and for hedging I bought 4 lots of 11,800 calls. Out of 4 trades, I covered 2 trades here yesterday, but still my view was bearish about the Nifty's move because today highest open interest was in the strike 11,600 and 11,500. My view was bearish about the Nifty and I hold my 2 trades. See, Nifty was moving in this channel and currently it is taking support on this zone. If Nifty breaks this zone in downside, then it may take support on this zone, but if Nifty holds this zone, we can see an up move in the prices. So on daily chart, there were 3 doji candles, and if we get doji candle after an up move, it is a signal to go short, and there were 3 doji candles. That's why my view was bearish about the Nifty. Also, RSI was giving a negative divergence. In this lecture, we will see options trading on expiration date. Today is 22nd of March and it is Friday, so it is the expiration day. If we see the options chain of Apple Incorporation, the highest open interest in call side is in 195 strike, and in put side, if we see the highest open interest, it is in 185 strike, and the second highest open interest is in 192.5 strike. So today the stock opened at 197.65 and the highest open interest in call side was in these two strikes. So overall the sentiments were bearish about today's move, and I made a short position in the stock with my day trading strategies when I got a signal here with 10 and 5 period moving average set. The range of Bollinger Band was big, so it was a good opportunity to trade the stock. The stop loss was the high of the candle that we got before the moving average crossover. So currently it is $100 profit in the stock. On expiration day, I don't suggest to trade in options. On expiration day, if volatility will be low, then we will not make any profit in options. So on expiration day, you can trade in futures or in physical shares. So it is $105 profit. I'm exiting from my half position and prices are near 194.5 strike. If we see the open interest, second highest open interest is in the strike 192.5, so I'm expecting a down move up to this level. Now I'm moving my stop loss at the break-even level and I'm setting my profit target at 193 level because it is acting as a support level here. If we see here, this level is acting as a support level. You can see these two candles are taking support here. So I'm expecting a down move up to this level. Now let's take one more example. This is the intraday chart of Alibaba Group, and if we see the options chain of this stock, currently stock is trading at 177.55. So this is 22nd of March. If we see the highest open interest in call side, the highest open interest is in 185 strike and 182.5 strike, and the highest open interest in put side is at 170 strike. The high of first candle was up to 180 strike. So the opening of the stock was near these two strikes, therefore the sentiments were bearish for this stock also. Now see, this was the opening candle and the opening candle was outside the Bollinger Band. As per my day trading strategies, we should wait for the open in the Bollinger Band range. So this candle was opening in the Bollinger Band range, so I entered in my trade for day trading. Moving average set was already giving a sell signal and Bollinger Band was going in downward direction, so it was my confirmed short sell position. The stop loss was the high of this opening candle because this was the gap down opening, and currently it is $96 profit in this stock, so I'm exiting from my half position. Also, I'm shifting my stop loss level at the break-even point. We can also take one more example. This is the intraday chart of Facebook Incorporation, and see, this was the opening candle. The high of the opening candle was $167.40. So if we see the options chain, the highest open interest in call side is this, and this is the strike 167.5. So Facebook opened exactly at this strike, and the highest open interest in put side is at this strike, and this is 160 strike. So here we got a sell signal in the stock, and stock is down up to $165.83, but still the sentiments are bearish for the stock. So it was a sell signal in the stock at the open of this candle. Now these candles are near the lower level of Bollinger Band, and see the candles are losing momentum because this was the longest candle and the next candle is the short candle. Again, these are the short candles. So if we get a reversal candle at lower level of Bollinger Band, then we can expect a bounce in the stock from this level. But if we get a long candle, Marubozu candle at this level, then we can expect a further down move in the stock as sentiments are bearish for this stock also. Okay, so now prices are very close to this support level in this stock in Apple Incorporation, and it is $71 profit in the stock. So I'm exiting from my short position because I'm expecting a bounce from this level in upside. In our second stock, Alibaba Group, it is $66 profit with my rest position, and if we see on hourly chart, it is a support level at this level. See, this was a gap down opening, so these candles are resisting this level. So it is a support level at $175 and prices are trading at $177. But you can see that on hourly chart, this candle is totally outside the range of Bollinger Band. So I'm expecting a bounce in the stock from this level. That's why I'm closing my position here with a profit of $70. Same is here in Microsoft Corporation. If we see the options chain of Microsoft Corporation, the highest open interest is in strike 120 and 119. So these are the resistance level for the stock, and the highest open interest in put side is in 116 strike, so it is acting as a support level. Now currently stock is trading at 118.68. So this was the opening candle and the high of this candle was 119.56. So this was the resistance level and 116 is acting as a support level, and see, this is the trend line of the stock. So I am expecting a down move up to this support line, this trend line. Okay, now in Microsoft Corporation, it is $77 profit, and this was my stop loss level. Here I entered at this candle when moving average set was giving a sell signal. So it was a pullback rally. I placed my stop loss at the high of this up move, and now it is $71 profit, and now it is $80 profit. So I'm exiting from my half position and moving stop loss level at the break even point. And see, in Apple Incorporation, this was the support level. So prices are struggling at this level. But if prices break this level in downside, we can see a further down move in the prices. Let's see our second stock. In this stock, this was my exiting candle, and it was a pullback rally from this candle because this was the hammer candle. And then again, there is a sharp fall in the prices, and currently prices are very near to this level. This is a support level on this chart. So the highest open interest gives us an idea about the move of the stock, but it's not necessary that prices will touch the highest open interest strike. We should always watch the chart and see the support and resistance level on chart also. The highest open interest in call side give us an idea of resistance level, and if prices are trading near that level, we can expect a down move in the prices. And if prices are trading near the support level, that is the highest open interest in put side, then we can expect a up move in the prices and we can buy the stock from that level. And in Microsoft Corporation, now this candle is very close to the trend line, and if we see, this level is acting as a support level because these candles, let me mark this level. See, these candles are resisting this level. So it is also a level of trend line. You can see this is the trend line for the current move, and this candle is touching the trend line. It is also a support level on this chart. So I'm exiting from my rest position here. because I am expecting a consolidation in the prices at this level. And today my fourth stock is LRCX. In LRCX it is $70 profit, but we see on RSI it is giving a positive divergence here because prices are going in downward direction, but RSI is going in upward direction. So here I'm closing my trade. Let's analyze the chart of previous three stocks. The first stock was Apple Incorporation. And see, in Apple Incorporation, prices were struggling here, but this candle was a long red candle, a Marubozu candle. So the selling pressure was high at this candle, and then it was a down move in the stock. Now this level will act as a resistance level for the prices. Our next stock was Alibaba, and in this stock, see, this was the resistance level, and at this level it was a bounce, and moving average set is giving an exit signal here, and then Bollinger Band is going sideways, so we can expect a sideways movement here at this level. Let's analyze the third stock, that was Microsoft Corporation, and see, the stock is struggling at this level because this was the support level and this is also a trend line, but selling pressure is high in this stock and we can see a further down move in the stock. So these were the 4 live trades on expiration date, and it was a sharp fall in the prices in all these 4 stocks. Thanks for watching. I'll see you in the next lecture. Hello everyone, this is 25th of April and this is expiration day. Today we will analyze the chart of Reliance Industry and we will see how to trade the expiration day for a stock. So it was a very sharp up move in the Reliance Industry yesterday. Then it was a very sharp up move in the stock today also. So I'm expecting a retracement in the price, and currently the stock is trading at 1403 rupees above R1 level. But as I'm expecting a down move in the stock, so we can sell the future of Reliance Industry, and for hedging we can buy a call option. So this is the options chain of Reliance Industry. You can see the highest open interest is in 1400 strike and the second highest open interest is in 1420 strike. So we can buy the call option of 1400 strike, that is trading at 11 rupees, and we can sell the future of Reliance Industry because there is a resistance zone at 1425 strike and this is a very strong resistance zone. RSI is also giving a negative divergence. As the stock is trading at 1403 rupees, our risk in this trade will be only 11 minus 3, it will be 8 rupees. But I'm expecting a sharp fall in the prices because there was a sharp up move in the prices yesterday and also today. Welcome back everyone, this is 3 p.m. the last half an hour of expiry. Today in the morning session, I sold the future of Reliance Industry because I was bearish about the movement of the stock, and for hedging I bought the call option of 1400 strike that was trading at 11 rupees. So now stock is trading at 1372 rupees. It is a profit of approximately 15,000 rupees in this trade. This was a very sharp fall in the prices in this 10 minutes. So at that time the stock was trading at 1403 rupees and now it is trading at 1372 rupees. The lot size is 500, so it is a profit of 15,000 rupees in this trade today. Today's prices took support on pivot level, then there was a touch of R2 level, there was a reversal candle at R2 level, and then you can see a very sharp fall in the prices up to S1 level.
Welcome to our next lecture. Today we will analyze the chart of Nifty, in which Nifty has broken down the consolidation pattern of 4 months. This is the trend line of Nifty, and on 2nd February Nifty broke down this trend line, and since then Nifty is moving in a consolidation pattern that is a symmetrical triangle pattern. But today Nifty has broken down this pattern in downside. Generally this pattern is a continuation pattern, but Nifty has broken down this pattern in downside. Yesterday Nifty closed above the 50 EMA and below the downtrend line of this symmetrical triangle pattern. And today Nifty opened below this line and touched the 100 EMA and recovered slightly from that level. But if we see on volumes, this was the breakdown, but volumes are average here. So I am not very positive at this signal, because on a breakdown of any consolidation pattern, volumes must be high. But there is no spike in volume, so I am not very much sure about the downtrend of the Nifty. If we apply Fibonacci tool to the top and bottom of the last swing, we can see today Nifty took support on the 50% Fibonacci level, that is a strong support level, and also on 100 period moving average. The next level is 10,410 and RSI is also below 50 level, so my view is bearish but not very much bearish because of two reasons. First is there is no volume spike on the breakdown of consolidation pattern, and second is on 5-minute chart we are getting a positive divergence on RSI. You can see on 5-minute chart prices are moving in this descending parallel channel, but RSI is giving us a positive divergence. So if we draw the resistance line on RSI, here we are getting a buying signal because RSI is crossing above this resistance line, and at this candle we are getting a buying signal. But still RSI is below 50 level. As we can see, prices take support on this 50% Fibonacci level, and now prices are touching the upper resistance line of this channel. So for tomorrow I am bullish for the prices. If RSI cross this 50 level and also prices cross this upper trend line in upward direction, we can go long for the target of 10,700 level, that is the Fibonacci level. And tomorrow in the morning hours, if Nifty holds this level, this support level, then we can buy Nifty ATM call options for the target of 10,700 level, because I am expecting that prices will go to touch this lower trend line of symmetrical triangle pattern. The stop loss will be the low of this red candle below this 50% Fibonacci level, that is 10,565 level, and our target will be 10,700 level. So let's analyze our last chart. We were here, Nifty was moving in a descending parallel channel and RSI was giving us a bullish signal here at this candle. So the next day on 29th of June, we had a gap up opening, and it was a bullish signal because prices were outside this parallel channel and also RSI was above 50 level. Moving averages were also giving us a bullish signal, so it was a very good opportunity to buy our call option. Our stop loss level was the low of this candle, slightly below this black line, and our target level was 10,700 level. As it was a intraday trade, so our chart should be 5-minute and our moving average combination should be 5, 10 and 20 period EMA, and this we have learnt in our basic course. So Nifty just touched 10,700 level, and you can see 5 period moving average is below 10 period moving average at this point, so this was our exit signal. So it was a very good trade from 10,605 to 10,690 level. Now today on 2nd of July, we get a gap up opening above this black line, but in just 5 minutes Nifty made a down move below this level, and also if we see on RSI, we were getting a negative divergence because prices were moving up but RSI was going down, so it was a sign of negative divergence. And also you can see at the next candle moving averages were giving us a bearish signal because both 5 and 10 period moving averages were below the 20 period moving average.
So to get a confirmed signal, we just draw a support line on RSI, and here at this candle we were getting a breakdown on this support line. This was a bearish signal because moving averages were giving us a bearish signal. Also RSI was below 50 level, and below this support line it was a very good opportunity to buy put option. Now at this point both the moving averages are above the 20 period moving average, so it was our exit signal. It was a trade from 10,691 level to 10,630 level. At this point you can see RSI is also above 50 level, and again we were getting a positive divergence on RSI. So divergence is the best tool for intraday trading and also to trade call and put options. Thanks for watching. I'll see you in the next lecture. So let's analyze our last chart. We were here, Nifty was moving in a descending parallel channel and RSI was giving us a bullish signal here at this candle. So the next day on 29th of June, we had a gap up opening and it was a bullish signal because prices were outside this parallel channel and also RSI was above 50 level. Moving averages were also giving us a bullish signal, so it was a very good opportunity to buy our call option. Our stop loss level was the low of this candle, slightly below this black line, and our target level was 10,700 level. As it was a intraday trade, so our chart should be 5-minute and our moving average combination should be 5, 10 and 20 period EMA, and this we have learnt in our basic course. So Nifty just touched 10,700 level and you can see 5 period moving average is below 10 period moving average at this point, so this was our exit signal. So it was a very good trade from 10,605 to 10,690 level. Now today on 2nd of July, we get a gap up opening above this black line, but in just 5 minutes Nifty made a down move below this level, and also if we see on RSI we were getting a negative divergence because prices were moving up but RSI was going down, so it was a sign of negative divergence. And also you can see at the next candle moving averages were giving us a bearish signal because both 5 and 10 period moving averages were below the 20 period moving average. So to get a confirmed signal, we just draw a support line on RSI, and here at this candle we were getting a breakdown on this support line. This was a bearish signal because moving averages were giving us a bearish signal. Also RSI was below 50 level and below this support line it was a very good opportunity to buy put option. Now at this point both the moving averages are above the 20 period moving average, so it was our exit signal. It was a trade from 10,691 level to 10,630 level. At this point you can see RSI is also above 50 level, and again we were getting a positive divergence on RSI. So divergence is the best tool for intraday trading and also to trade call and put options. Thanks for watching. I'll see you in the next lecture. Hello everyone. Now we will discuss about various factors that determine the option price. Have you ever noticed that on expiration a Nifty 9000 at the money call option increased only by 10%, but a Nifty 9100 that was the out of the money call option increased by 90%. Sounds surprising, but it is true. This is because of option Greeks. Let's discuss the factors that determine the option price. Most retail option traders do not know about the option Greeks, but one must have the knowledge of Greeks if he trades in options. Option Greeks are of 5 types, that are delta, gamma, theta, vega and rho. First of all, we will discuss about delta in the next lecture. In this lecture, we will understand about the delta. Just look at the two situations. In first situation, suppose Nifty is trading at 9500 and the price of 95 call option is 140 rupees. The next day Nifty is 9600 and the price of call option is now 190 rupees. In second situation, Nifty is trading at 9500 and the price of 95 call option is 140 rupees, and the next day Nifty falls to 9400 but the price of call option falls to 90 rupees. It means when the spot price of underlying security changes, the option price also changes respectively. Now there is a question, if Nifty is 9500 and we are expecting a move up to 9900. We know that the value of call option will also increase, but how much? Now this is where delta comes into the play. The delta is the amount an option price will move with every 1 point move in the respecting underlying security. In other words, delta is the probability of option expiring in the money. For example, a delta of 0.5 means the option has a 50% chance to expiring in the money. Delta varies between 0 to 1 for call options and between -1 to 0 for put options. All the at-the-money call options have deltas of 0.5. It means for every $1 the stock price moves, the call option will move 0.50. All the at-the-money puts have a delta of -0.5. It means for every 1 point the stock falls, the option price will increase by 0.5 points. If you are selling an at-the-money call, the delta will be -0.5 instead of +0.5 because we are selling an asset. And if you are selling an at-the-money put, the delta will be 0.5 instead of -0.5. It means all the bought calls have positive delta, all the sold calls have negative delta, all the bought put have negative delta, and all the sold puts have positive delta. As expiry reaches near, delta of all the in-the-money options move closely with the stock price, as there is no time value left when expiry is very close. Now in our first example, when Nifty was 9500 and the premium of call option of strike price 9500 was 140 rupees. As the call is at the money, so the delta will be 0.5. Now the second day, when Nifty was 9600, a 100-point rise in price, and for every 1 point change in price, the premium of call will change to 0.5 points as the delta is 0.5. So the premium of option will increase to 100 multiplied 0.5 is equal to 50 points, and the new premium is 190 rupees from 140 rupees. In the second case, when Nifty drops to 9400, a 100-point fall in the price. So the change in premium will be 100 multiplied 0.5 as the delta is 0.5 will be 50 points, and new premium will be 90 rupees from 140 rupees, a decrease of 50 rupees. In this way, we can calculate the change in premium of option with a change in stocks or index price. These are the approximate delta values for option price. All the deep in the money call options have deltas between 0.8 to 1, and all in the money call options have deltas between 0.6 to 1. All at the money call options have delta between 0.45 to 0.55. All out of the money call options have deltas between 0.45 to 0.3. And all deep out of the money call options have deltas between 0.3 to 0. All the put options have same delta values, but the deltas are negative instead of positive because we are making position in downside by buying the put options. Now can you answer the previous question? If Nifty is 9500 and we expect a move up to 9900, what will be the change in call option premium? Let's find out the answer. If we buy at the money call having delta of 0.5, the change in Nifty's price is 9900 minus 9500 is equal to 400 points. So the change in option premium will be 400 multiplied 0.5 is equal to 200 points. If we buy out of the money call option having delta of 0.2, the change in Nifty price is 400
So the change in option premium will be 400 multiplied 0.2 is equal to 80 points. It means the more is delta, the more is change in option price, because delta measures the speed of the option price movement. But why does speed matter? Why should we care about delta? Let's understand that in the next lecture. In this lecture, we will understand what is the use of delta. Suppose you buy 100 shares of ABC company at $50. Your total investment is $5,000. Delta for individual stock is always 1. So, each $1 the stock rises, you make $100 profit, and each $1 the stock falls, you lose $100. Now, if stock rises to $55, the profit is $500, a 10% profit. But if stock drops to $45, your loss will be $500, and that is also a loss of 10% of your investment. In second case, if you buy one lot of ABC call at $7, your total investment is $700 because the lot size is 100. If stock rises to $55, your profit will be $500. So, this $500 is a profit of more than 70% of your investment. But look at the situation if stock falls to $45. Your loss will be $500, and it is a loss of more than 70% of your investment. And you have only $200 left from your $700 investment. If we are talking about 70% profit, that sounds very good, but if we are talking about a 70% loss, it is a big loss. That's why we should hedge the delta. It means we should slow down the speed of percentage movement of our position. In a hedged position, the risk is reduced because the positional speed is slowed down. We will take an example here and see how we can hedge our position. Suppose a stock is trading at $100. You buy a 100 strike call and sell a 120 strike call having same expiration date. Then delta of 100 call will be 0.5 because the call is at the money, and the delta of 120 call is minus 0.2 because the call is out of the money and we are selling the out of the money. So the delta will be negative instead of positive. So the total delta of our position will be 0.5 plus negative of 0.2 is equal to 0.3. So our hedge ratio will be 0.3 from 0.5, where we will buy a call option. It means we have slowed down the percentage speed of price movement. In hedged positions, our profit is limited, but our risk is also limited. In the next sections, we will discuss various spreads that are hedge strategies. And now, in the next lecture, we will learn about the second Greek, that is gamma. Thanks for watching the lecture. Now we will understand what is gamma. Assume Nifty is 9500, then 9600 call will be out of the money and delta will be 0.4. If Nifty move to 9600, then it is a 100-point change in price, and then at 9600 level, 9600 call will be at the money and delta will be 0.5. In second case, if Nifty rises to 9800 from 9500, then 9600 call will be in the money and delta will be 0.7. In third case, if Nifty falls from 9800 to 9600, then 9600 call will be at the money and delta will be 0.5 again. It means when spot price changes, delta also changes. Hence, delta is a variable term, and this change in delta is because of gamma. Gamma controls delta. Gamma is the rate of change of delta against the rate of change in the underlying asset price. In simple words, delta is the speed of option price movement and gamma is the speed of delta. And speed of the speed is known as acceleration in option price movement. Now take our previous example. When Nifty is 9500, 9600 call is out of the money and its premium is 60 rupees. Delta is 0.4 and let gamma is 0.001.
Here we are taking the formulas to calculate change in option premium and change in delta. Change in premium is equal to change in underlying asset price multiply old delta, and change in delta is equal to change in underlying asset price multiply gamma. In first case, when Nifty rises to 100 points from 9500 to 9600, change in premium is equal to 100 multiply 0.4, that is delta, is equal to 40 points. So the new premium will be old premium plus change in premium is equal to 100 points, and that is the 66% change. Change in delta will be 100 multiply gamma is equal to 0.1. So our new delta will be 0.4 plus change in delta, that is 0.1. So our new delta will be 0.5. It means now 9600 call will be at the money. In second case, when Nifty rises to 9800 from 9500, change in premium will be 120, and our new premium will be old premium plus change in premium. Old premium was 60 rupees, so our new premium will be 180 rupees, that is a 200% change. Change in delta will be 0.3 because the appreciation is 300 from 9500 to 9800. So our new delta will be 0.4 plus 0.3 is equal to 0.7, and this is the delta values for in the money calls. So our out of the money calls is in the money now. It means when moneyness changes from out of the money to at the money, the percentage change is 66%, but when moneyness of option changes from out of the money to in the money, the percentage change is 200. And this is the reason when a trader profits more than 200% or 300% in a big move in a single day. This is a graph of delta versus spot price. You can see that the acceleration is high when out of the money call changes to in the money. This is the portion when acceleration is high. It means when you expect a big move in the price over a short time, you should buy slightly out of the money options. But if you want to play safe, you should buy at the money or in the money options. Delta is high for them, so they are more sensitive to the change in price. But in the money options are generally very expensive, so at the money options are preferred to in the money options. In third case, when Nifty drops to 9600 from 9800, our change in premium is minus 140 because now the premium is decreasing, and our new premium is 40 rupees from 180 rupees. This is approximately 78% change. And new delta is 0.5 from 0.7. So this is a delta for at the money call. Our 9600 call is now at the money. Now in this case, our buying price of option was 60 and now the option price is 40. Nifty was 9500 when our buying price was 60. Now Nifty is 9600, still a 100-point gain in Nifty, but option price is now 40 from 60. It is a loss for option buyer. This is the reason why sometimes we are in the right direction but still our option premium is losing its value. This is the graph for gamma versus spot price. Gamma is high for at the money options, so they are more sensitive to change in price. Delta is the probability that option will expire in the money, and gamma is the change in probability that option will expire in the money. It is high for at the money options because even for 1 point change in asset price up or down, the change in probability of at the money option expiring in the money is also very high. So we should not short at the money options. Gamma increases exponentially for at the money options as option approaches expiry. This red line shows the long expiry and this blue line shows the short expiry. This is the 5 days expiry. So at the money options are highly sensitive close to expiry. That's why we should exit from at the money options a few days before expiry. This was all about gamma. In the next lecture, we will discuss about the third Greek, that is theta. Welcome to our next lecture. Theta is the most important sensitivity factor and is known by most traders.
Theta is the time factor in the option premium. This time factor moves towards 0 as expiration approaches. Theta is the amount the premium will decrease every next day till the time of expiration. It also behaves differently for different strike price. Theta is nearly always negative for bought options and positive for sold options because time decay erodes the option value as time to expiration diminishes. Assume the price of a call option is $10 and its theta is minus 0.05. Then the next day option price will lose 0.05 of time value. It means 10 multiply minus of 0.05 is equal to minus $0.5. So the next day option price will decrease to $9.5 from $10. So the buyer of option lose $0.5 every day and seller of option will profit of $0.5 every next day. The negative value of theta indicates that as time gets closer to expiration, time decay increases. Assuming 1 month expiry, theta for deep out of the money and out of the money options decreases faster in the first half of the expiry and almost nothing left for the last 10 days. So we shouldn't buy deep out of the money options. However, at the money options behave exactly opposite. Theta decreases faster for at the money options in the second half of expiry because speed increases exponentially for at the money options as expiration approaches. So we should exit from a long position a few days before expiration if we have at the money options. Option sellers are the one who want to see the theta of options decreasing because this is what makes money for them. Most sellers sell out of the money options at the starting of the expiration and buy back a few days before expiration. As we know, option premium is made up of two components that are intrinsic value and time value. Look at these three call options. Suppose the stock ABC is trading at $96. As the stock is currently trading at $96, so the 99 call is out of the money, 96 call is at the money and 93 call is in the money. The premium of 96 call is $2. The intrinsic value is 0 because the strike price and spot price are same. So the $2 is the only time value and its intrinsic value is 0. The premium of 93 call is $4.1. Intrinsic value is the difference between the strike and spot price, that is 96 minus 93 is equal to $3. So the time value will be $1.1. The premium of 99 call is $0.6. As the call is out of the money, intrinsic value is 0, so 0.6 is only the time value. Out of the money and at the money options do not have any intrinsic value and only have time value. So we should buy these options for a long expiry and exit the long position from these options before 1/4 of expiry as time decay accelerates at its fastest during the last days of expiry. It doesn't mean that we should sell options because of factor time decay. Many people successfully sell out of the money options every month and collect a decent premium. But that is a part of strategies that we will study in our next sections. Selling naked options means exposing yourself to an unlimited risk profile. So, we should sell out of the money options only for hedging our trade. What about in the money options? Deep in the money options have very low time value and theta's negative effect for these options is automatically low. So, we should buy short-term deep in the money options. These are the Greeks for Microsoft Corporation. Currently, the stock is trading at $97.6. So, 98 call is the at the money call and you can see here the delta is 0.51. 97 call is the in the money call and 96 call is the deep in the money call. Here 98.5 call is the out of the money call. You can see these are the gamma values and the gamma is high for these at the money options.
If we see theta are negative for calls and these are the puts. Theta is also negative for put because there is a time decay for both the call and put options. Here also theta is highest for at the money options. You can see here also theta is highest for at the money put options. As at the money call becomes out of the money, delta decreases and this is gamma. Gamma also decreases. Theta also decreases. You can see that theta for in the money options is very low. So in the money options should never be sold because they have very low time value. And when we sell options, we sell only the time value. This was the discussion about theta. Thanks for watching the lecture. Vega is the volatility factor. Volatility is a measure of how a security's price is moving up and down. If a stock price fluctuates all over the place in wild swings, then a high volatility is predicted. The greater the volatility, the greater the risk, the more expensive option premium become. Volatility are of two types, historical volatility and implied volatility. Historical volatility is the annualized standard deviation of past price movements of the stock. It is based on underlying asset volatility over a period of time. For example, the past 20 or 30 trading days. We use historical volatility as reference for calculating the fair value of option. But in real world, option premium frequently trade away from their fair values and driven more by demand and supply. So the implied volatility is more important than historical volatility. The implied volatility is derived from the market price of the option itself. And vega is the amount option price will change for 1 point change in implied volatility. It is a measure of uncertainty in the markets. When a big news is expected, there is uncertainty in the market about the news. So the volatility also increases. And with the increase in volatility, option premium also increases. After the impact of news, volatility decreases and option price also decreases. This is where most traders lose money after the impact of news. It is only vega that has such a big effect on options that sometimes even the direction is right and option buyer loses money because vega decreases. Long strangles and long straddles are very useful strategies in this scenario. Vega is approximately identical for both call and puts. You can see this is the value of vega for call and this is the value for vega for put option. Vega is high for at the money option and near the money options, and vega reduces when option approaches to the expiration because there is less time for increased volatility to make an impact on the time value of the component. When volatility is at peak, we should sell options because both the vega and theta helps the option sellers. The conclusion is increasing vega increases the option price and a low vega have a low option price for the same theta and delta. This was a brief discussion about vega. Thanks for watching the lecture. Rho is the least important factor of 5 main Greeks. It is the amount an option value will change with 1% change in interest rates. Mostly interest rates are same for a long period, so rho does not have a big impact on option premiums. Rho is the option price sensitivity to interest rates. It is positive for calls, means increasing interest rates are helping the position, and rho is negative for puts, means increasing interest rates are hurting the position. But as the interest rates are fixed for 1 year, it has the least impact on the option pricing. This was a brief discussion of Greeks, and now in the next sections, we will discuss various option strategies.
Welcome back everyone. In this section, we have discussed about all the options Greeks. Now you must be wondering how to calculate all the Greeks for an option. Actually, we need not to calculate options Greeks because many of today's trading platforms provide all the Greeks values for different strikes. But you can also calculate these values yourself by using options calculator, which uses Black-Scholes options formula. The Black-Scholes options pricing calculator is based on Black-Scholes options pricing model, which was first published by Fisher Black, Meron-Scholes and Robert Merton. We will not go through the maths involved in Black-Scholes formula because it's very complicated and you need not to know about it. But we will briefly understand it. Just think of Black-Scholes calculator as a box which takes in some input and generate some outputs. The inputs required are market data for an option and outputs will be the options premium and options Greeks. We need 6 inputs variable for this calculator, that is spot price, that is the current market price of the stock, strike price, that is the price of your options that you are buying or selling, time to expiration date, that is the current expiry for which you are trading the option, dividend, this is the dividend payout that the company is paying till the expiration date, but if company is not paying any dividend then you can keep the input as 0. Risk-free interest rate that you can find below the options chain and implied volatility that is different for different option and you can see the value from options chain. Then if we fill all the values in Black-Scholes calculator then we will get all these outputs in which we will get call and put premium value, delta, gamma, theta, vega and rho. Let's take an example to understand it.
This is the 5-minute chart of Siemens and you can see the stock is trading at 1419 level. So this is the options chain of Siemens. The current expiry is 27th of February. And if we want to calculate the options Greeks for 1420 put strike, then we will see this data. This is puts data. So you can use Black-Scholes formula and you can find online any Black-Scholes calculator, but I'm using Zerodha calculator. So in this calculator, we will fill the spot price of the stock, that is the current price, and the current price of the stock is 1420. We will fill this value here. And suppose we want to know about the Greeks of 1420 put strike. So our strike will be 1420. Thus we are trading the ATM strike, same strike, and the expiration date is 27th of February and volatility is for this strike. See, this is implied volatility and 1420 put strike have IV as 37.44. So we will fill this value here. Interest rate is 10, that you can see below the options chain. See, this is 10% interest rate and this is the risk-free interest rate. So this is 10%, and if we calculate the options Greeks for this put options, so these are the options Greek. This is delta, this is gamma, this is theta and rho and vega. So these are the options Greek and these are call and put premium for this current strike. Suppose if we want to trade this stock for options trading, the stock was in my momentum scanner and we are trading the stock for day trading perspective. So you can see the stock is trading near the support level and it was a sharp down move in the stock, and you can see RSI is trading in oversold range. So here we can sell the put option of this stock. See, this is the sideways movement in the stock on hourly chart and this was the support level. That's why we can sell the put option of this stock for intraday perspective, and the level is 1399. So we can sell the put option of 1400 strike. So 1400 strike is trading at 28.10 rupees. This is the bid price of put option because we are selling this put option. And I always suggest not to sell the naked options. That's why we will employ a stop loss order slightly below this support level. So if we want to employ our stop loss level at 1386 level, so this is our stop loss on price chart. But we can also calculate our options price with respect to this stop loss level on price chart with the help of Black-Scholes formula. For this, we will simply change the spot price to 1386 in this calculator, and we are selling the put option of 1420, so we will fill 1400 as our strike price, and the IV for 1400 put strike is 35.81. We will change this value. So our stop loss level should be 44.51. So if we are selling the put option of Siemens, we will employ our stop loss level at 44.51. But this value is with respect to this IV. In options chain, currently IV is this. It changes regularly. That's why this stop loss level will be valid for intraday trading only. And in this way, we can also calculate our target level with respect to price chart. Suppose our target level is the upper band of this Bollinger Band. We are expecting that prices will consolidate here near this level within the range of Bollinger Band. So our target level is 1445 rupees. And this is the level on price chart. So we will calculate our options value with respect to this level. So we will simply fill the value in spot price 1445, and our target is 20.62. So this is our target price for our options. We are selling the put option. So if our price will reach at 20.62 or near this level, then our position will be squared out here. In this way, we can calculate our stop loss level and target level with respect to these price levels. Welcome back everyone. Now you can see Siemens is trading very near to our target level, and it is $29 profit in this stock, but we have sold the put option of 1400 strike. So if we see the current price of 1400 strike, see this is the current options chain, and the 1400 put strike is trading at 22 rupees. Our target level was 20.62 rupees. So we will wait for some time, because if we see a consolidation within this Bollinger Band, still our premium will decrease for our put options, though prices are very near to our target level. Now see, the put option premium is 20.70 and it is very close to our target level. So here we can close our position. So in this way, we can adopt our stop loss level and target level with respect to our price chart. For example, these are the levels on price chart, but with the help of these levels, we have calculated the levels for our options in which we have sold the put option of Siemens, and this was the live trade. So in this trade, we have sold the put option of 1400 strike at 28 rupees. And now we will buy the put option. So we will see the ask price of 1400 strike, and the current price of this put option is 20.70. So this was a very good profit in this stock. The lot size for Siemens is 550. So the profit from options chain is 8 rupees, and if we multiply with this quantity, so it is approximately 4000 rupees profit in this stock within 1 hour. So in this way, we can calculate our stop loss and target level for our option. But those levels will be applicable for intraday only, because implied volatility regularly changes and those levels are according to that IV. So next day, if we are trading for positional trading, we have to calculate the levels regularly based on different IVs of that strike, and we have to change the stop loss and target level regularly if we are trading for positional trading. But for intraday trading, obviously we can calculate these levels with the help of Black-Scholes calculator. Thanks for watching. See you in the next lecture.
Hello everyone and welcome to our next strategy. Bull call spread strategy is executed by buying one call option with a lower strike price and selling one call option with a higher strike price. When we are bullish about the prices, we can employ this strategy and we will make profit when stock price increases. The call with the lower strike price will always be purchased at a price greater than the offsetting premium received from writing the call with the higher strike price. Our maximum loss is limited to the net debit paid if the stock price declines below the lower strike price, and our maximum gain is limited to the difference between the strike prices minus net premium paid. The maximum profit for this spread will generally occur as the stock's price increases above the high strike price. No matter how high the stock has risen in price, we can exercise the long call. It means we just buy stock at the lower strike price and sell at the return call strike price. If the stock price is in between the strike prices on expiration date, the long call will have its intrinsic value and the return call will have no value. So, our net profit will be the intrinsic value of the long call plus premium received from the sale of the call with higher strike price. Let's take an example. Suppose we believe that ABC stock is trading at $52 and is going to rally soon. We can make a bull call spread by buying a January 50 call for $200 and writing a January 55 call for $50. The cost of trade will be 200 minus 50 is equal to $150. The maximum profit will be difference between the strike price minus premium paid, that is 500 minus 150 is equal to $350, and the maximum loss will be the cost of the trade, that is $150. If on expiration date the stock closes above $55, say $56, both options expire in the money, with the long call having an intrinsic value of $600 and short call having an intrinsic value of $100. This means that the spread is now worth $500 at expiration. Since we had a debit of $150 when we bought this spread, our net profit is 500 minus 150 is equal to $350, which is the maximum profit. On the other hand, if the price had declined below $50, both options expire worthless and we will lose the entire investment of $150, which is the maximum loss. But if we adopt this strategy by using technical analysis and when the stock is in uptrend, then definitely we will be in situation first and make profit. Now let's analyze the chart and try to find out the entry points for this spread. We will take two charts and make a comparison between the spreads. This is the chart of Vedanta Limited NSE. We can easily see that the chart is in uptrend, prices are in uptrend, and this is the trend line for the stock. We just draw the trend line by joining two initial points and by extending the trend line, and also we draw a resistance line for the prices. Now the stock is moving in this range. Now the stock is trading at 322 rupees. After this retracement, now prices are above the trend line and try to reach here. This 310 level is the strong support level. So we will buy a call of 310 rupees, and this is the 350 level. Suppose we are taking a 350 level near this resistance line. So we will sell a 350 call here. These are the prices of the call option. This is Vedanta January 310 call and this is Vedanta January 350 call. This is bid rate and this is ask rate. When we buy a call, we will see ask rate, and when we sell a call, we will see bid rate. We are buying a 310 call, so we will see the ask rate, that is 21.85 rupees, and we are selling 350 call, so the price is 4.35. We will take two prices, 21.80 and 4.35. So our cost of trade will be 21.80 minus 4.35, that is 17.45 rupees per share. So our maximum loss will be 17.45 rupees per share if stock declines 310 level, and our maximum profit will be 350 minus 310 is equal to 40 minus the premium paid, that is 17.45 is equal to 22.50 rupees per share if the stock rises above 350 level. It means by taking a risk of 17.45 rupees, we are expecting to make a profit of 22.5 rupees per share. That is not a very good risk reward ratio, so we will not adopt this strategy here. We will take another chart. This is the chart of Yes Bank NSE. This is also in uptrend, so we just draw the trend line for this stock. We join initial 2 points and extend the trend line. This is a trend line, a lower trend line for the stock. We will also draw the upper trend line for this stock. This is the resistance line. Now this is the range of this stock. Now we can easily see that the stock in retracement phase and below this trend line. If we see the RSI, now RSI is above 50 level and giving us a positive divergence. It means the stock will rise now and it can reach to the extent of this upper trend line. Now we will analyze the current position of the chart. Let me zoom in the chart. This is the current position of the chart. The stock is trading at 316 rupees. This is the 310 level and it is a support level here. If we set the Fibonacci here, we can easily see that the stock is above 0.36% range and 350 level is the 0.61% range. So, we will make a spread here by buying a call of 310 level and by selling a call at 350 level. This is 0.61% Fibonacci level. Now we will see the prices of the call options. Yes Bank January 310 call is at price 16.75. Because we are buying 310 call, we will see the ask rate, that is 16.75, and we are selling a 350 call, so we will see bid rate. This is 3 rupees. So we will take two prices, 16.75 and 3 rupees. Our cost of trade will be 16.75 minus 3 rupees is equal to 13.75 rupees per share. So our maximum loss will be 13.75 rupees if stock price decline below 310 level, and our maximum profit will be difference between the strike prices minus net premium paid, that is 350 minus 310 is equal to 40 rupees minus net premium paid, that is 13.75. So our maximum profit will be 26.25 rupees per share if stock rises above 350 level. If stock rises above this level, we will gain our maximum profit. If on expiry stock goes below 310 level, then our maximum loss will be 13.75, and if on expiry stock goes above 350 level, then our maximum profit will be 26.25 rupees per share. The lot size is 1750. This is lot quantity, so we will multiply the prices with 1750. 13.75 multiplies 750 is equal to 24,000. 26.25 multiplies 1750 is equal to 46,000 rupees. It means by taking a risk of 24,000, we are expecting to make profit of 46,000 rupees, which is a very good risk reward ratio. Thanks for watching the lecture. I'll see you in the next strategy.
So now we will analyze the current position of the two stocks of our last lecture, in which there was a comparison between the positions of two stocks, and the two stocks were Vedanta Limited and Yes Bank. Now this is 19th of January and Vedanta is currently trading at 331 rupees. So in that comparison, I didn't recommend that trade because the risk to reward ratio was not very good. It was 1.29. And in the second stock, Yes Bank, see the stock is trading at 350 level. The strategy was bull call spread, in which I bought the call option of 310 strike of Yes Bank and I sold the call option of 350 strike. Now at this time this candle is trading below this pink line and the level is 350 level. So it was a very good trade and the profit in this trade is 45,937 rupees. It is approximately 46,000. In the comparison, I recommended that trade, so it is our successful trade. Though in Vedanta, the stock is above the 310 strike and it's better than Vedanta.
Now let's analyze the chart of Facebook Incorporation. Facebook is in uptrend, and see I have applied Fibonacci to the last swing and this is 2.618 level. So on 5-minute chart, Facebook is going in upward direction and I'm expecting that it will move up to resistance line, but near this resistance level I am expecting a consolidation in the prices, so my view is moderately bullish for the stock. And on hourly chart you can see this was a gap up opening. Bollinger Band is going in upward direction, but RSI is showing the less momentum, so I'm expecting a up move up to this black line, this resistance level, and then I'm expecting that prices will consolidate near this resistance level. So here we can enter in a bull call spread. We can buy the call option of Facebook Incorporation. So this is 29th of April. We will see the current expiration, that is 3rd of May. We can sell 195 strike, that is trading at $1.62, and we can buy 192.50 strike, that is trading at $2.95. Now let's analyze the chart of Facebook Incorporation. Facebook is in uptrend, and see, I have applied Fibonacci to the last swing, and this is 2.618 level. So on 5-minute chart, Facebook is going in upward direction, and I'm expecting that it will move up to resistance line, but near this resistance level I am expecting a consolidation in the prices, so my view is moderately bullish for the stock. And on hourly chart, you can see this was a gap up opening. Bollinger Band is going in upward direction, but RSI is showing the less momentum, so I'm expecting a up move up to this black line, this resistance level, and then I'm expecting that prices will consolidate near this resistance level. So here we can enter in a bull call spread. We can buy the call option of Facebook Incorporation. So this is 29th of April. We will see the current expiration, that is 3rd of May. We can sell 195 strike, that is trading at $1.62, and we can buy 192.50 strike, that is trading at $2.95. Hello everyone, welcome back. This is 3rd of May and this is the expiration day today. On 29th of April, I entered in a bull call spread here when stock was trading at $194.30. And now today is the expiration day. The stock is trading at $196.03. See, this black line is the strong resistance level for the prices. You can see there was a tap on this level, on this black line, that was acting as the resistance line. Again, prices are going to touch this line in upside, but as this line is the 2.618 level of Fibonacci extension tool that I have applied to the previous swing, that's why this level will act as important resistance level for the prices. That's why I was moderately bullish for the prices, so I entered in a bull call spread. I bought the call option here for the current expiry, and I sold one call option of 195 strike, and the prices were 192.50 strike was trading at $2.95, and I sold 195 strike call option that was trading at $1.62. Here we are selling the call option, so we will see the bid price, and we are buying 192.5 strike, so we will see the ask price, and that is $2.95. So here the cost of trade was $1.33 for one lot, as the lot size is 100. So our total investment for this trade was $133. So approximately it is 95% return in this trade. The maximum return was 95%. And if we see the prices of these call option, today the stock is trading at $195.78, and we will see the options chain of Facebook Incorporation for this expiry. $192.50 strike is trading at $3.10. Here we bought this call option. Now we will sell this call option, so we will see the bid price, that is $3.10, and we have sold 195 strike that is trading at $1.04. So in this trade our total investment was $133 in a single lot, and now we are getting $73. So it is approximately 54% return in this trade in a single lot. So when our view is moderately bullish, we should enter in a bull call spread, and I was moderately bullish in this stock because it was a gap up opening and above this red candle there was a strong resistance level. That's why I was expecting that prices will go in upside because momentum was very high. This was the gap up opening, but as above this candle there was a resistance level, so I was moderately bullish up to this level only. That's why I entered in a bull call spread and trade is successful. We got a 50% return in just 3 days. Welcome back everyone. Let's analyze the chart of Kotak Mahindra Bank. On weekly chart, the Kotak Bank is in uptrend and trading above the peak of the previous swing. So if we apply Fibonacci tool to know the extension level, the resistance level, we will apply from high to low of the previous swing, and you can see this is an important Fibonacci extension level. So I'm expecting that prices will go in upside up to this level and we can enter in a bull call spread. So if we see the options chain of Kotak Mahindra Bank, the expiration date is 30th of May and we can buy the ATM call option as the resistance level is 1451. So we can sell 1460 strike, that is trading at 21.20 rupees, and we can buy ATM call option that is 1380 strike and it is trading at 53.40 rupees. So here we can enter in a bull call spread because my view is moderately bullish for the stock up to only resistance level. That's why here we are not buying the call option. Instead we are entering in a bull call spread. So here we can sell 1460 strike, that is slightly above the resistance level, and we can buy 1380 strike. Welcome back everyone. This is 21st of May. You can see there is a sharp move in the Kotak Bank and currently it is trading at 1501 rupee. So in Kotak Bank, I have entered in a bull call spread because my view was moderately bullish about the stock, but now as you can see this was the strong resistance level and the stock has breached this resistance level in upside, and RSI has also breached the resistance level in upside. It means this is the case of failing divergence, and when we have a failing divergence it means momentum is very high. So if we see the prices of our call options, I have bought 1380 strike at 53.40 rupees and now it is trading at 122.20 rupees. And I have sold 1460 strike that was trading at 21.20 rupees. Now it is trading at 61.80 rupees. So here from the board call my profit is 68.8 rupees per share, and from the sold call my loss is 40.8 rupees per share. So in this trade my profit is 28 rupees per share and the lot size of Kotak Bank is 400. So in this trade my net profit is 11,200 rupees. My total investment in this trade was 12,880 rupees. So it is approximately 87% return in this trade. So here I am closing my trade because Kotak Bank is moving in this parallel channel and currently it is trading near the upper level of this resistance line, this parallel channel. So here we can expect a retracement in the prices, but as this black level is the important resistance level for the prices and now prices are above this level, so this level will act as strong support level for the prices. That's why I am expecting a consolidation up to this black level. That's why I'm closing my trade here. When prices are trading near the resistance level, near the upper line, we can enter in a bear call spread, but as this was the case of failing divergence in which momentum is very high and after 2 days the results of elections will be declared, so we should not make any position here because we don't know where it will move in upside or downside. But as prices are trading near the resistance level, so I'm closing my trade here with a profit of 87%. Now let's take one more example. This is the hourly chart of L&T and L&T is in consolidation phase. It is in sideways phase between these two levels. Now L&T is in retracement phase and this is the retracement line for the current swing. Now prices are taking support on this line. RSI is taking support on 50 level. That's why my view is bullish up to this resistance level. So if we see the options chain, here we can enter in a bull call spread. We can buy 1380 strike, that is trading at 44.55 rupees, and the resistance level is 1448. So we can sell 1460 strike at 17.20 rupees. Welcome back everyone. This is 21st of May. In the previous lecture, I have analyzed the chart of L&T, and you can see on daily chart, L&T is in consolidation phase between these two levels. So this was the last swing and this was the retracement phase for this swing. It was a retracement up to 61.8% level. You can see this was the retracement up to 61.8% level, and when prices breached this downtrend line in upside, on hourly chart prices were taking support on this downtrend line and RSI was above 50 level. Moving average set was already giving a buying signal. That's why my view was bullish for the move up to this resistance zone, because this upper line is the all-time high for L&T and this lower line is one more resistance level. So by joining these two levels, this is a resistance zone for L&T and this will act as important resistance zone for L&T. So currently, as you can see, prices are trading in this zone. So I have entered in a bull call spread in which I bought the call option of 1380 strike here, and I sold the call option of 1460 strike, that is the resistance level in between this resistance zone. So if we see the prices of our call options, 1380 strike is trading at 80.10 rupees and 1460 strike is trading at 33.15 rupees. So in this trade, our profit from the bought call is 35.55 rupees per share and our loss from the sold call is 15.95 rupees per share. So our total profit is 19.6 rupees per share and the lot size is 375. So our net profit in this trade is 7,350 rupees. So as prices are trading in this resistance zone and this was a very sharp up move in the prices, that's why I'm expecting a consolidation here. That's why I'm closing my trade with a profit of 7,350 rupees. Welcome back everyone. Now we will take an example of bull call spread in this stock, and the stock is India Bulls Housing. This is a daily chart of India Bulls Housing. You can see the stock is in retracement phase. See, stock is in uptrend, but this was the retracement phase, and at the end of this retracement phase, the stock is forming an inverted head and shoulder pattern. Though the pattern is not complete, but stock is trading above this downtrend line, outside this downtrend line. That's why I am bullish for the movement. But as this blue line is the neckline for this pattern, so we can see a consolidation at this blue line. So here we can enter in a bull call spread. We can buy the call option of the current strike and we can sell the call option of this blue line, this strike. If we see the hourly chart, see on hourly chart, RSI is giving a positive divergence. That's why my view is bullish for the stock. We will see the options chain of this stock. Here the stock is trading at 697.60 rupees. So we will see the in the money call option strike. 640 strike is trading at 79.85 rupees and we will sell the call option of, here we can sell the call option of 933, but that strike is very far from this strike and this black line is the resistance level in between these two strikes. So we can sell the call option of this black line and it is 820 strike. So we will sell the call option of 820 strike, that is trading at 12 rupees. So here we are making a bull call spread by buying 640 strike at 79.85 rupees and we are selling 820 strike at 12.05 rupees. Welcome back everyone. This is 21st of May. On 6th of May, I have analyzed the chart of India Bulls Housing, and in that stock, my view was bullish because in India Bulls Housing on daily chart, the prices are making an inverted head and shoulder pattern. This is a neckline for the pattern and the pattern is incomplete yet, but as the prices are trading above the trend line, that's why my view was bullish for the stock and I entered in a bull call spread here. On hourly chart, RSI was giving a positive divergence. That's why I bought the call option of 640 strike that was trading at 79.85 rupees and I sold 820 strike that was trading at 12.05 rupees. Because 820 level was this black line and this black line was the resistance level for the prices and this was very far from the prices, but currently prices are taking support on this level. So we will see the price action near this level. If prices hold this level in upside, then our next target will be this blue line, neckline of the pattern. But if prices will unable to hold this level in upside, then we can see a retracement in the prices. That's why I am closing my trade here. And if we see the prices of our call option, our bull call spread, 640 strike is trading at 179.25 rupees. Now we will see the bid price and it is 179.25 rupees. And 820 strike is trading at 48.65 rupees. So here in this trade, my profit from the bought call is 99.4 rupees per share and my loss from the sold call is 36.6 rupees per share. So my profit is 62.8 rupees per share as the lot size is 500. So my net profit in this trade is 31,400 rupees. So now as prices are trading at this level and prices are trading very far from both the moving averages, momentum is very high, but RSI is going in overbought range. That's why I'm closing my trade here because it is approximately 93% return in this trade. That's why I'm closing my trade here. Hello everyone, this is 21st of May and tomorrow is the announcement of Lok Sabha 2019 election results. As everybody knows that there are high chances of NDA majority and market has already discounted the news and currently it is trading at 11,730 level. So as we know that there are high chances that tomorrow Nifty can touch 12,000 level because as you can see in options chain, the highest open interest is in 12,000 strike and in put side the highest open interest is in 11,500 strike. So here currently Nifty is trading near 11,700 level, but chances are there that tomorrow is the expiration day, so Nifty can touch 12,000 level or 11,500 level. But as we know the chances are high of NDA majority, that's why Nifty will move in upside. But as volatility is very high, so premiums of options are very high. You can see the current strike is trading at 253 rupees and premiums are very high, so we cannot buy the call option of this strike as after the news, after the event, volatility will decrease. And as we know, when volatility decreases, premium also decreases. So we cannot buy here the call option of 11,700 strike. So what should be our strategy for tomorrow, for 23rd of May? Here we can buy Nifty future and we can sell 12,000 strike that is trading at 126.60 rupees because we know that after the event volatility will decrease and premium will also decrease. That's why we will gain with 12,000 strike, and if Nifty increase and touch 12,000 level, then we will make money in Nifty future also. But how to hedge our position, how to minimize our risk? We cannot buy the call option of 11,650 or 600 strike because they are trading at very high premium. So here we can buy 11,500 strike that is trading at 120.45 rupees because here we are getting 126 rupees by selling 12,000 strike, and with this money we can buy 11,500 strike. So in this strategy our maximum risk will be of 200 points if Nifty falls below 11,500 strike or Nifty closed at this level. But as we already know that there will be NDA government and Nifty will touch 12,000 strike, That's why we can buy here Nifty future and sell 12,000 strike at 126.60 rupees, and we will also buy 11,500 put option at 120.45 rupees. Welcome back everyone, this is 23rd of May, the election result day. Today Nifty touched the 12,000 level and traded off record high. Based on that, NDA is coming back. But now Nifty is trading near yesterday's close due to profit booking. So in Nifty 50, yesterday I have suggested to buy Nifty and sell the call option of 12,000 strike because the highest open interest was in 12,000 strike. Today it was trading at 126 rupees and now 12,000 strike is trading at 1 rupees because today is the expiration day. You can clearly see that it was an up move in the Nifty 50 up to 12,040 level, and when it was trading near all-time high there was a signal from the moving average set, and also RSI was giving an exit signal at this candle. Here I sold the Nifty future and at that time call option was trading at 88 rupees. So I covered my both the positions here at 11,980 level, and today it was a very good opportunity to trade in both the directions because moving average set was giving a buying signal here when Nifty opened gapped up and it was a hammer candle. This was the previous day's high, so this candle was closed above this high, so it was clearly a buy signal in Nifty. And when moving average set was giving an exit signal, Bollinger Band was going sideways, but at the next candle Bollinger Band was going in downward direction and RSI was also giving a negative divergence. So at this candle it was a clear signal to make a short position in Nifty, and currently you can see it is trading at 11,694 level. So yesterday there was highest open interest in 12,000 strike in call side, and in put side it was in 11,500 strike, and you can see 12,000 strike is trading at 1 rupee and 11,500 strike is also trading at 0.90 rupees. So both the options are trading worthless, and Nifty traded between these two levels today. Even the direction of Nifty was in upside, but premium of 12,000 strike decreased up to 50% due to decrease in volatility. So it was a very good strategy, and today I made approximately 30,000 rupees in this trade.
Welcome to our next strategy. Bull put spread strategy is executed by selling one put at higher strike price and buying one put option of lower strike price. The strategy is employed when the option trader thinks that the price of the stock will go up moderately in the near term. Bull put spread strategy is also known as bull put credit spread because we receive a credit upon entering the trade. We can make profit in a bull put spread if the underlying stock's price increases. The put with the higher stock price is sold at a price greater than the offsetting premium paid for buying the lower strike price put. So, the maximum gain is net premium received. When price rises, both options expire worthless with no value, then we gain the net premium received for entering the trade. And maximum loss for this spread will generally occur as the underlying stock price falls below the lower strike price, and it is limited to difference between the strike price minus net premium received. Let's take an example. Suppose stock XYZ is trading at $53 and we believe the price is going to rally soon and enter a bull put spread by buying a January 50 put for $1 and writing a January 55 put for $4. So the net premium received in executing the spread is 4 minus 1 is equal to $3 per share. If the lot size is 100, our maximum profit will be 3 into 100, that is $300. And the maximum loss for the trade is the difference between the strike prices minus premium received, that is 55 minus 50 minus $3 is equal to $2 per share. If the stock price begins to rise and goes above $55, both the options expire worthless and we will keep the entire premium received. This is also the maximum possible gain. And if the stock price begins to fall and close below $50, say $48 on expiration date. Both options expire in the money with January XYZ 50 put having intrinsic value of $2 and January XYZ 55 put having intrinsic value of $7. So, to square off the position on both puts, we have to pay 7 minus 2 is equal to $5 per share. Since we have received a net premium of $3, our maximum loss is 5 minus 3 is equal to $2 per share. That is $200. The big advantage of bull put spread strategy is that the loss is limited if the price falls instead of rise. Now let's analyze the chart. This is the chart of Nvidia Corporation. The stock is in uptrend, so we can enter a bull put spread strategy. First of all, we will draw its trend line by joining two initial points. This is the trend line. Here we can see the stock is trading below the trend line and trying to cross above it. We can easily see here that $190 is acting as a strong support level. So we will buy a put of $190 and sell a 197.5 put. So we can buy a put of $190 at price 1.79 and sell a put at price 4.75. The net premium received is 4.75 minus 1.79 is equal to $3 per share approximately. So the maximum gain in this trade is $3 per share. The lot size is 100. So our maximum gain in this trade is 3 into 100 is equal to $300. If on expiration date the stock rises above $197.5 price, we will receive the net premium that is the maximum possible gain. And if stock falls down below $190, then our maximum loss is 197.5 minus 190, that is 7.5, minus the premium received is $3, that is $4.5 per share. So our maximum possible profit in this strategy is $300 and our maximum possible loss in this strategy is $450. But chances are very low. So the benefit of this strategy is downside risk is limited. Thanks for watching. I'll see you in the next lecture.
Welcome back. In our last lecture, I adopted the bull put strategy in Nvidia Corporation, and we were here. The date was 22nd of December 2017. While initiating a bull put spread, I suggest to buy the put option of 190 level because this was acting as a strong support level, and I sold the put option of 197 level. The strategy should be adopted in a bullish environment, and this was a ring pound movement, so I adopted this strategy. At this candle we were here, this was the hammer candle and the hammer candle was at support level, so I was bullish for the stock, and the expiration date was 5th of January. This is 8th of January, and on 5th of January stock closed at $215. So in a bullish move, it was a profit of $296 with bull put strategy, and now as prices are moving above this level, the sold put level, so we are in profit, and this trade was also a successful trade. Thanks for watching. I'll see you in the next lecture. Welcome back to our next lecture. In this lecture, we will analyze the chart of Jet Airways and see what is the trend of the stock. See, this is the daily chart of the stock, and you can see the stock is moving in a sideways range, but within this sideways range on daily chart, this was the downtrend, then this was uptrend. Now stock is moving in a downtrend, but as you can see, this was a very sharp down move in the prices, and currently RSI is in oversold range. And if we see on hourly time frame, you can see RSI is giving a positive divergence and stock is still below this downtrend line, but as RSI is giving a positive divergence and prices are very near to this downtrend line, so I'm expecting that prices will consolidate here at this level or prices will move in upside, but I'm expecting that prices will not breach this level in downside for this expiry. So here we can make a bull put spread because my view is moderately bullish for the stock, and we can sell the put option of this strike. The low of this candle is 118.50, so we can sell the strike of 120. And if we see the options chain, this is 6th of May and the expiration date is 30th May, so we have approximately 25 days. We can sell the put option of 120 strike that is trading at 26.45 rupees, and for hedging we can buy the put option of 100 strike that is trading at 18 rupees. So in this spread we will receive a credit of 8.45 rupees per share. And if we see the lot size of Jet Airways, the lot size is 2200. So in this trade currently we are getting 2200 multiply 8.45, approximately 18,600 rupees. And in this trade our maximum risk can be 11.55 multiplied 2200, it will be approximately 25,000. So in this trade our maximum gain can be 18,500 rupees and our maximum loss can be 22,000. But as with the help of technical analysis, here we are getting a clue that stock will move in upside or consolidate here at this level. So we can sell here the put option of this strike. Welcome back everyone, this is 27th of May and we were analyzing the chart of Jet Airways. See, in Jet Airways there was a sharp downfall in the prices and stock is already in downtrend. If we see the daily chart, you can see stock is in downtrend and this is the downtrend line for the stock. But this was a support level. After breaching this support level, there was a sharp downfall in the prices. But on RSI, I was getting a positive divergence on early chart and prices were already trading very far from this trend line. That's why my view was slightly bullish in this stock and I entered in a bull put spread because this level was an important level and it was acting as a support level. So my view was that prices will consolidate here or prices can go in upside because there was a signal from RSI. RSI was giving a positive divergence. So I entered in a bull put spread here. I sold 120 strike at 26.45 rupees and I bought 100 strike at 18 rupees. So if we see the options chain of Jet Airways, the expiration date is 30th of May and today it is 27th of May. So if we see the prices of our put options, 120 strike is trading at 4.55 rupees and 100 strike is trading at 1.75 rupees. So in this trade, if we calculate our profit from the sold put option is 21.9 rupees per share and our loss from the bought put option is 16.25 rupees per share. So in this trade our profit from the spread is 5.65 rupees per share and the lot size of Jet Airways is 2200. So if we multiply this profit from the lot size, our profit is 12,430 rupees. So you can see that stock was in downtrend and it was trading in a narrow range between these two levels. Still we are getting profit of 12,430 rupees in this stock because here we adopted the bull put strategy. That is a very good strategy if we have a moderately bullish view. And in this stock this was a very sharp downfall and after this downfall if we apply the Bollinger Band, see on daily chart, when this candle was outside the Bollinger Band, it means momentum was high, selling pressure was high and after this candle there was a sharp downfall. But here at this level there was a buying pressure in the stock because you can see this candle is similar to the hammer candle. That's why my view was bullish. And when we are moderately bullish for the stock, if we expect that prices will not fall below a level, then we can enter in a bull put spread. And I was expecting that this level will act as an important level, important support level. And you can see prices are taking support here. Then they are moving in a sideways range between these two levels. So here our profit in this trade is 12,430 rupees. Still I am expecting that prices will move in this range because Bollinger Band is going sideways and we can make more profit in this stock. So here we can wait in this trade and wait for the expiration day so that we can get our maximum profit in this stock. As Bollinger Band is going sideways, I'm expecting that prices will not breach this level in downside. So I'm suggesting to wait in this stock and we will close our trade on the expiration day. Welcome back everyone, this is 30th of May and today is the expiration date for the Jet Airways. In Jet Airways, you can see the stock is moving in a sideways channel and I suggested to wait in this stock because prices were trading very far from this strike. I have sold this put option, so I was expecting that prices will not breach this level in downside till the expiration date. So I suggested to wait in this stock till the expiration date, and today is the expiration date, so we will see the options chain and we will see the prices of our put options. In Jet Airways, I sold 120 strike that was trading at 26.45 rupees. And now it is trading at 0.20 rupees. And for hedging, I bought 100 strike that was trading at 18 rupees and now you can see 100 strike is trading worthless. So here I am buying back this 120 strike at 0.20 rupee, and if we calculate our profit in this stock, our profit from the sold put is 26.45 minus 0.20 is equal to 26.25 rupees per share, and the 100 strike that was the bought strike is trading worthless. So our profit in this trade is we will decrease the price of our bought put option minus 18 rupees is equal to 8.25 rupees. So this is our profit for one share and the lot size of Jet Airways is 2200. So we will multiply this profit from the lot size and our net profit in this trade is 18,150 rupees, and that is the maximum gain in this trade. So in Jet Airways, you can see this level was a support level. If we see the chart on weekly time frame, this level was a support level because at this level prices are taking support here and here also, and this level is the all-time low for the stock. That's why I was expecting that this level will act as a very strong level, and when prices breached this first level and prices were taking support at this second support level, and on hourly chart it was a positive divergence by RSI, so my view was moderately bullish in this stock and I entered in a bull put spread here because I was expecting a consolidation here, and you can see prices are moving in this range and currently trading at 151.30 rupees. So in Jet Airways, this was a very sharp fall in the prices and currently prices are trading within these two levels. So if we get a breakout of this level in upside, we can expect an up move in the prices up to this downtrend line because prices are in downtrend, and in downtrend we can expect an up move only up to the extent of downtrend line. And if prices breach this level, that is the all-time low of the stock, then we can see a further down move in the prices, but currently prices are range bound and I'm expecting a breakout in upside and prices may touch the level of this trend line. So in this stock, my trade was successful even when there was a range bound movement in the stock and prices were trading in a range. We got a profit of approximately 18,000 rupees in a single lot. Thanks for watching the lecture. Welcome back everyone, this is 23rd of May and we will analyze the chart of Reliance Industry. In Reliance Industry, I have bought the call option when it was rising, but this was the trend line for the stock. When it was a breakout of this trend line, stock made a very sharp decline, and when at the end of this decline, I was getting a positive divergence in RSI and also the highest open interest was in 1280 strike. I bought the put option of Reliance Industries of strike 1280 and my price was 61.95 rupees. Now you can see it is trading at 5.75 rupees. For hedging, I bought the put option of 1240 strike at 42.30 rupees. But now it is trading at 2.30 rupees. So in this trade, my profit from the sold put option is 56.2 rupees per share and my loss from the bought put option is 40 rupees per share. So my total profit in this trade is 16.2 rupees per share, and the lot size of Reliance Industries is 500. So my net profit in this trade is 8,100 rupees. My maximum profit in this trade was 9,825 rupees, and now I am getting 8,100 rupees. That is approximately 82% of the maximum gain. That's why I am closing my trade here. But I am still bullish for the stock. This black line is the strong support level for the prices, and as long as RSI is above this trend line, I am bullish for the stock. Here, as you can see, RSI is giving a negative divergence. That's why stock may consolidate here and may retrace up to this support level. If prices breach this support level in downside, then we can see a further down move in the stock. But I'm expecting that prices will take rest on this support level, and then we can see a further up move in the prices. So in Reliance Industries, I traded 2 times. I bought the call option of Reliance Industries when it was in uptrend, and I entered in a bull put spread when I was expecting a up move in the prices at the end of this down move. And now I'm getting approximately 83% of my maximum gain, so I'm closing my trade here. Thanks for watching. I'll see you in the next lecture. Welcome back everyone. In the previous lecture, I have bought the call option of Reliance Industries, and you can see now Reliance Industries is trading at 1250 level. It was a very sharp fall in the prices, and I exited from my position here because RSI was giving a negative divergence. And after that point, there was a sharp reversal because on daily chart, this was 127% level above the prices, and the highest open interest was in 1400 strike. That's why my view was moderately bullish up to only 1400 price. Now RSI is giving a positive divergence and it was a sharp fall, so I'm expecting that prices will go in upside. And if we see the options chain, the expiration date is 30th of May. In 1400 strike, there was highest open interest. That's why I exited from my call option. So this level acted as a strong resistance level for the prices, and there was a sharp fall in Reliance Industries after touching this resistance level, this 1400 strike. And now in put side, the highest open interest is in 1280 strike, and the second highest open interest is in 2 strikes, 1240 and 1260. So we can buy these strikes and we can sell 1280 strike, that is trading at 61.95 rupees. So here we can enter in a bull put spread because I'm expecting an up move in the prices. So here we can sell 1280 strike, and for hedging we can buy 1240 strike, that is trading at 42.30 rupees, and 1280 strike is trading at 61.95 rupees. Welcome back everyone, this is 23rd of May and you will analyze the chart of Reliance Industry. In Reliance Industry, I have bought the call option when it was rising, but this was the trend line for the stock. When it was a breakout of this trend line, stock made a very sharp decline, and when at the end of this decline, I was getting a positive divergence in RSI, and also the highest open interest was in 1280 strike. I bought the put option of Reliance Industries of strike 1280. And my price was 61.95 rupees. Now you can see it is trading at 5.75 rupees. For hedging, I bought the put option of 1240 strike at 42.30 rupees, but now it is trading at 2.30 rupees. So in this trade, my profit from the sold put option is 56.2 rupees per share, and my loss from the bought put option is 40 rupees per share. So my total profit in this trade is 16.2 rupees per share, and the lot size of Reliance Industries is 500. So my net profit in this trade is 8,100 rupees. My maximum profit in this trade was 9,825 rupees, and now I am getting 8,100 rupees. That is approximately 82% of the maximum gain. That's why I am closing my trade here. But I am still bullish for the stock. This black line is the strong support level for the prices, and as long as RSI is above this trend line, I am bullish for the stock. Here, as you can see, RSI is giving a negative divergence. That's why stock may consolidate here and may retrace up to this support level. If prices breach this support level in downside, then we can see a further down move in the stock, but I'm expecting that prices will take rest on this support level and then we can see a further up move in the prices. So in Reliance Industries, I traded 2 times. I bought the call option of Reliance Industries when it was in uptrend, and I entered in a bull put spread when I was expecting a up move in the prices at the end of this down move. And now I'm getting approximately 83% of my maximum gain, so I'm closing my trade here. Thanks for watching. I'll see you in the next lecture.
Welcome to our next strategy, that is bear call spread strategy. Bear call spread strategy is executed by selling one call option with lower strike price and buying one call option with higher strike price. We can adopt the strategy in a bearish environment when we expect a decline in price of the underlying stock. The call with a higher strike price will always be purchased at a price lower than the premium received from writing the call with lower strike price. So, the trade is always at a credit. The maximum gain is limited to net premium received, and the maximum loss for this spread will generally occur as the price rises above the highest strike price on expiration date, and it is highest strike price minus lower strike price minus net premium received. Let's take an example to understand the strategy. Suppose ABC stock is trading at $52 in February and you are bearish about the price and expecting a fall in prices on expiration date. So you can enter a bear call spread position by buying a February 55 call for $1 and selling a February 50 call for $3 at the same time. So you get a net credit of $2 per share for entering the trade. As the lot size is 100, so your net credit will be $200. On expiry, if the price drops to $49, both options will expire worthless and you will keep the entire credit of $200 as profit. But if the stock closes at $57 on expiration date, both call will expire in the money, with January 55 call having $200 intrinsic value and the January 50 call sold having $700 its intrinsic value. The spread would have a value of 700 minus 200 is equal to $500. Since you have to buy back the spread, you will have a net loss of $300 after deducting the $200 credit that you earned while entering the trade. So the maximum profit in this spread will be net premium received, that is $200, and the net loss is difference between the strike price minus net premium received, that is of $300. But as I told earlier, with the help of technical analysis, one can surely make money in this strategy if we take a chart of stock having a short-term downtrend. Now let's analyze the chart. This is the chart of Tata Motor and this is the daily chart of Tata Motor. We can clearly see that the stock is in downtrend and it is moving in this range. We just draw the trend line, upper trend line for the stock. This is the downtrend line. Also we draw the support line for the stock. This is the range of the stock. Now we will analyze the current position of this stock. See, the stock is currently trading at 370.40 rupees and we expect the stock will touch this support line, this downtrend line, and bearish move in the prices. So we can enter a bear call spread here by purchasing one call option at price 380 because this is the upper resistance level for this current position of this stock and this is the level 362 level. So we will sell a call option of this 360 level because this is a support level for this current position of this stock for the few days. This is 19th of February and the expiry is on 22nd February. It is the 4-day spread. We expect a fall up to this level. This is 357 level, this low of this candle, this green candle. So we can make spread here by purchasing a call option of 380 level and by selling a call option of 360 level. Now let's see the option prices. This is Tata Motor 22nd February 2018. This is the 360 call and the expiration date is 22nd February 2018. We are selling this call, so we will see the bid price of this call. This is 12.35 rupees and this is 380 call of Tata Motors. The expiration date is 22 of February. So we are purchasing this call. So we will see the ask rate. The ask rate for this call is 1.95 rupees. So we will take two prices here. The selling price is 12. But now the prices has changed. The bid price is 12.80 and the ask price for this call is 380 call is 2 rupees. So we will take two prices, 12.75 and 2 rupees. So the net premium received in this trade is 12.75 minus 2, that is of 10.75 rupees per share. As the lot size is 1500, the net premium received is 10.75 multiplied 1500 is equal to 16,125 rupees. So the maximum gain in this spread is net premium received, that is 16,000 rupees approximately. And maximum loss can be higher strike price minus lower strike price minus net premium received, that is 380 minus 360 minus 10.75, that is 20 minus 10.75 is equal to 9.25 rupees per share. As the lot size is 1500, so the maximum loss can be of 13,875 rupees. If on expiration the stock price closes at 360 or below, both the options will expire worthless and we will keep the entire credit of 16,125 rupees as profit. On the other hand, if on expiry the stock rallies above 380, say 390 level, both calls will expire in the money with bought 380 call having intrinsic value of 10 rupees and the sold 360 call having intrinsic value of 30 rupees. The spread would then have a net value of 30 minus 10 is equal to 20 rupees per share. Since we have to buy back the spread of 20 rupees, this means that we will have a net loss of 9.25 rupees per share after deducting 10.75 rupees credit we earned while taking the trade. So our maximum loss can be 9.25 rupees per share, means 13,875 rupees if stock rises above 380 level. So we can earn profit with this strategy even when we are moderate bullish about the prices. So this is also a very good strategy to be adopted in a bearish environment. Thanks for watching the lecture.
Welcome to our next lecture. In this lecture, we will analyze the chart of Facebook Incorporation. This is the daily chart of Facebook and you can see Facebook made a very sharp up move from December 2018 and now you can see here prices are resisting this black line and this black line is the very strong Fibonacci level, 261% level of Fibonacci extension tool. See, there are three swings in this up move. This was first swing, this is second swing and this is the third swing, that is the current swing. So I applied Fibonacci to the previous swing because when we apply Fibonacci as an extension tool, we apply it to the previous swing and this is the 261% level and currently prices are resisting this level and as this was a very sharp up move, so I'm expecting a retracement in the prices and I'm expecting that prices will not breach this level in upside very soon. That's why we can sell the call option of this strike. So we can take the expiration date of 17th of May. Currently Facebook is trading at $190.41. So we can sell the call option of this black line level and this is 196.90. So 197.5 strike is the nearest strike to that level. So we can sell the call option of this strike and the call option of this strike is trading at $1.75. So we can sell this call option for 17th of May. That is the expiration date. But when we sell options, I always suggest to hedge the position because selling options is the riskiest strategy. That's why we can buy the 205 strike call option here at $0.45. Welcome back everyone. In the previous lecture, we have analyzed the chart of Facebook Incorporation. Facebook was resisting this zone. This zone is a very strong resistance zone for the Facebook and you can see prices were not able to breach this zone in upside and currently prices are trading below this zone and today is 16th of May. I have bought the call option of Facebook Incorporation for the expiration date of 17th of May, and tomorrow is the expiration date. So here my trade is successful. You can see prices are trading below this resistance zone for which I have sold the call option of Facebook Incorporation. If we see the options chain of 17th of May, I have sold 197.5 call option that was trading at $1.75, and now it is trading at $0.02. So we can buy back this call option, and I bought the 205 call option. Now this call option is trading worthless. So here in this trade our net profit is $130 per lot, and in this trade our maximum loss was $6.2. So our risk to reward ratio was not good, but as we were getting here strong signals of consolidation, see this level was 261% level of Fibonacci grid, and this lower level is another resistance level. So by joining these two levels, this zone is a strong resistance zone for Facebook Incorporation. Now at this zone there was a shooting star candle, and RSI was giving a negative divergence. Moving average set was also giving a sell signal. So all the signals were bearish signal. That's why I sold the call option of Facebook Incorporation, because I was expecting a consolidation in the prices after this sharp up move from this support zone to this resistance zone.
Hello everyone, now we will analyze the chart of TCS and see which strategy can be adopted in this stock. TCS is in uptrend. You can see this is the uptrend line for the stock, and the stock is going in upward direction, but you can see stock is trading very near to the resistance level. This is the resistance level, all-time high, and my view is bullish for the stock, but up to this resistance level. So on hourly chart, you can see the stock is in uptrend. Moving average set is giving us a buying signal, but RSI is giving us a negative divergence. That's why momentum is slowing here. Prices are going in upward direction. So prices may go in upward direction up to the resistance line in this channel, but I am moderately bullish for the stock. And if we see the options chain of TCS, we will take the expiration date of next month because we are buying the call option. The current price of stock is 2172 rupees and the resistance level is 2280 rupees. So we will buy the ATM call option of strike 2180. We can sell the 2280 strike and we can buy 2180 strike, that is trading at 65 rupees. So here we can make the bull call spread by buying 2180 call option at 65 rupees and we will sell 2280 call option at 23 rupees.
Welcome back everyone, this is 3rd of May and you can see there was a sharp retracement in the prices of TCS. We have sold the call option of TCS and you can see on daily chart prices are trading near the all-time high and near this level. This level is the strong resistance level because this is 1.618% Fibonacci extension level on weekly chart. See, this is 1.618 level, and that's why this level is very important level, and after touching this level there was a sharp retracement in the prices. I'm expecting a consolidation near this level, and on hourly chart, see, there was a gap down opening today and you can see at the top of this up move there was a doji candle near this resistance level. That's why it was giving us the bearish signal. We will see the options chain. The expiration is 30th of May. We have sold the call option of 2250 strike that was trading at 45.20 rupees and now
it is trading at 27.15 rupees. Now we will buy the call option. So we will see the ask price and it is 27.15 rupees. For hedging, we have bought the call option of 2350 strike, that is trading at 9.65 rupees now. But if we see the chart, there was a gap down opening. RSI is going in oversold region. That's why I am expecting a consolidation below this resistance level. So here I'm suggesting to wait in the stock because our expiration date is 20th of May and this is 3rd of May. So we will wait for our trade to get the maximum profit. Okay, now this is 27th of May and we were analyzing the chart of TCS. I was expecting a down move in the prices as prices were trading here near this black line and this level is an important resistance level for the prices. So I was expecting a down move in the prices. I entered in a bear call spread here and on hourly chart there was a doji candle that was giving us a signal of indecision between bulls and buyers and it was also a resistance level and RSI was also giving negative divergence. So you can see now stock is trading at 2044 rupees and if we see the options chain of the stock, the expiration date is 30th of May and this is 27th of May. So I have sold the call option of 2250 strike at 44.20 rupees and now it is trading at 1.20 rupees. So here we will buy this call option because we have sold this call option. We will see the ask price and it is 1.20 rupees. And we have bought 2350 strike at 17.85 rupees. So if we see the price of 2350 strike, it is trading at 0.50 rupees. We have bought this call option. Now we will sell this call option. So we will see the bid price. It is 0.50 rupees. So in this trade, our profit from the sold call is 44 rupees and our loss from the bought call is 17.35 rupees. So in this trade, our profit is 44 minus 17.35 is equal to 26.65 rupees per share. This is the profit for one share and the lot size of TCS is 250. So if we multiply this with the lot size, our profit from this trade is 6,662 rupees. So in this trade, our maximum profit was approximately 6,800 and now we are getting approximately 6,700, that is the 98% profit of our maximum gain. So as you can see, both the call options are trading worthless. It is trading only at 1.20 rupees and this call option is trading at 0.50 rupees. So here we can close our trade because we are getting approximately 95% of our maximum gain. Now in TCS, you can see this zone is an important zone. You can see this was a gap down opening here between these two levels and now prices are resisting this level. Here also prices are resisting this level and now here prices are taking support at this level and here also prices are taking support 2 times on this zone. So this zone is a very important zone for TCS. So I'm expecting that prices will consolidate here and prices can take support here. And we can also see a pullback in the stock. But as on hourly chart, here we are not getting any positive divergence. So we should not buy the call option because I'm expecting a consolidation here. But in my trade, as I'm getting approximately 98% profit, so here I'm closing my trade. Thanks for watching. I'll see you in the next lecture. Okay, now in ONGC, when stock was trading above the previous high and it was taking support on this trend line, so my view was bullish about the stock and this was the previous high level. At this level, this was a gap up opening, so my view was bullish in this stock. At the gap up opening, I bought 1000 shares of ONGC and now it is trading at 178.30 rupees. So here I am closing my trade because RSI is giving a negative divergence and RSI is in oversold range and we are also getting a hanging man candle. So my view is bearish about the stock, and if you see on daily chart, See, this was the internal trend line for the stock, and stock is now trading above this trend line. So as long as prices are above this trend line, this red line, my view is bullish about the stock on daily chart. But on hourly chart, as we are getting a negative divergence, so we can expect a retracement in the prices. So here we can enter in a bear call spread. So if we see the options chain, the highest open interest in call side is in 180 strike. So this level will act as strong resistance level for the prices, and currently prices are trading at 178 rupees. So here in this stock, as we are getting a negative divergence, so 180 level will act as strong resistance level for the prices, and we can sell 179 call option here, that is trading at 3.25 rupees. And for hedging, we can buy 185 strike, that is trading at 1.40 rupees. So here we can enter in a bear call spread, because if we draw the parallel channel for the stock is trading in this parallel channel and currently trading at the resistance level. So I'm expecting a retracement in the prices, because this was a very sharp up move in the prices. So here we can enter in a bear call spread, and I'm closing my trade here, in which I bought the 1000 shares of ONGC. Welcome back everyone, this is 30th of May and today is the expiration date. In ONGC stock, I have traded 2 times, and this was the position when I entered in a bear call spread in ONGC. Here we were getting a negative divergence, and this was a hanging man candle at the resistance level of this channel, because the stock is trading in a parallel channel. You can see the stock is trading in this channel and prices were trading near this resistance level of the channel, and the move was very sharp. At the high of this up move, there was a negative divergence on RSI. That's why my view was bearish in the stock and I entered in a bear call spread. So in ONGC, I have sold 179 call that was trading at 3.25 rupees. So if we see the price of 179 call option, it is trading at 0.10 rupees. And for hedging, I bought 185 call option at 1.40 rupees. If we see the price of this call option, this is trading at 0.05 rupees. So both the call options are trading worthless. It is a very low price. So here I am closing my trade. If we calculate our profit from the sold call is 3.25 minus 0.110 is equal to 3.15, and our loss from the bought call is 1.40 minus 0.05 is equal to 1.35 rupees per share. So our profit in this trade is 3.15 minus 1.35 is equal to 1.8 rupees per share. The lot size for ONGC is 3750, so we will multiply this profit from the lot size. So in this trade, our net profit is 6750 rupees. So as in this trade, I am getting approximately the maximum gain, and this is the expiration date. So here I am buying back the sold call option, and I'm closing my trade here with a profit of 6750 rupees in this stock. Now as you can see, in options chain, the highest open interest was in 170 strike, and in call side the highest open interest was in 180 strike. So this was a move from 180 strike to 170 strike, and both the levels were the support and resistance level with the options chain, and this was the level with the chart also, because prices were resisting this level, this upper level of the channel, and currently it is very near to this red line, that is the support line for this channel. So I'm expecting that prices will take support on this red line, and this blue line is the trend line, internal trend line. So if prices hold these two levels, we can again see an up move in the prices, and this is the channel in which the stock is trading. Then my view is bullish up to this blue line, but prices should not breach this blue line in downside. Thanks for watching. I'll see you in the next lecture. Let's analyze the chart of ICICI Bank. You can see the stock is in uptrend and moving in a parallel channel. This is the parallel channel for the stock, and currently the stock is trading exactly at the resistance level, and it is also the all-time high level. The stock is trading at all-time high, and all-time high is the strong resistance level. So I always expect a retracement when a stock is touching the all-time high level second time. And you can see RSI is also giving a negative divergence. That's why I'm expecting a little consolidation here or a retracement in the prices, and we can enter in a bear call spread here. We can sell the call option of this strike. This is 408 strike, and also we can hedge our position by buying one call option of higher strike. So if we see the options chain of ICICI Bank, we will take the next month's expiry. Because this is 24th of April, we will select the expiration date as 30th of May. Currently the stock is trading at 398 rupees, so we can sell 400 strike at 16.75 rupees, and we will also hedge our position. We can buy 420 strike, that is trading at 9.05 rupees, and our total investment in this trade will be approximately 10,000 rupees because the lot size of ICICI Bank is 1375. So here we can buy 420 strike at 9.05 rupees, and we can sell 400 strike at 16.75 rupees. If prices breach this black line in upside, then we can exit from our trade, but I'm expecting a retracement in the prices because RSI is giving a negative divergence.
Welcome to our next lecture. Bear put spread strategy is a great strategy to make profit from a price decline of the underlying stock. It consists of one long put with a high strike price and one short put with a lower strike price with the same expiration date. The spread is established for the net debit because the price of long put is always greater than the sold put. The maximum profit is limited if the price falls below the lower strike price and is equal to difference between the strike price minus net cost of the spread. And maximum loss is limited if the stock price rises above the higher strike price and is equal to the cost of the trade. But if we execute the strategy when the underlying stock is in downtrend, we will never incur a loss. If the stock price closes below the lower strike price of sold put, both options expire in the money, but the long put will have higher intrinsic value than sold put, so we get the maximum profit. And if the stock price rises above the long put, then we suffer a maximum loss equal to debit taken when entering the trade. Suppose stock ABC is trading at $50. You are bearish about the stock price as it is in downtrend. So you enter a bear put spread by buying a January 52 put for $3 and selling a 45 put for $1. So the cost of trade is $2 for entering the position. Maximum gain is equal to difference between the strike price minus net debit is equal to 52 minus 45 is equal to 7 minus 2 is equal to $5 per share. And maximum loss is net debit, that is of $2 per share. Lot size is 100. Multiplying by 100 we get maximum profit can be $500 if price declines, and maximum loss can be $200 if price rises. If on expiry the price of stock drops, both puts expire in the money with 52 long put having $800 intrinsic value and the 45 sold put having $100 intrinsic value. The spread would then have a net value of $700 deducting the cost of trade when entering the position. So your net profit is $500, that is also a maximum gain. And if stock had rallied to $54 instead, both options expire worthless and you lose the entire debit of $200, and this is also a maximum loss. But we will make our position only when we are sure about the downtrend of this stock, so we will definitely get profit. If we see on this chart, the stock is in uptrend but currently it is in short-term downtrend. So if we zoom in the chart, we can clearly see that the stock is in downtrend, a short-term downtrend, and it is trading near its resistance line. This is the resistance line for the short-term downtrend and this is the support line for the short-term downtrend, and we are expecting a decline up to the level of this support line. It is near its resistance level, so we can adopt the strategy when stock will touch this resistance line. it is near its resistance line, but it is not touching this line, so we will not adopt this strategy right here, but we will execute the strategy when stock will touch this line by buying one put of $45 and selling another put of, the support line is near about $36, so we can buy a put option of $45 and we can sell a put option of $36 to execute this strategy. This is another example in which the stock is in downtrend and it is moving in downtrend since 2016. The stock is moving in a channel. We see the range is very wide and the stock is moving in a parallel channel having a resistance line, having a support line. So we can execute the strategy every time when stock touches its resistance line. These are the level where we could adopt the strategy, and now after touching its resistance line the stock is moving in between this range. So we will not adopt this strategy here because the stock is in between the range and it may touch the support line, but we are not very sure about the prices here because we are getting a positive divergence on RSI. So we should adopt this strategy only when we are very sure about the decline of the prices. So we could adopt the strategy only when the stock is near its resistance line. So if the stock is in downtrend, we can surely make money by executing the strategy. Thanks for watching the lecture.
Bear put spread strategy should be adopted in a bearish environment. In our last lecture, I was analyzing a stock that was Yelp Incorporation, and the stock was moving in a bearish channel and we were here. I suggested to make an entry in bear put spread when stock will touch this resistance line of this channel. But in this stock, it was not a situation to adopt this strategy because prices are above 50 level. See, RSI is taking support this 50 level line and also prices are struggling at this resistance level. If we draw the trend line for this uptrend, this up move, see prices are above this trend line, so it was not a situation to adopt that spread, and now prices are crossing down this trend line. So I'm expecting a down move in the stock, but as prices are above this channel, so we should not adopt this strategy.
Hello everyone and welcome to our next strategy. Callback spread strategy is an interesting and great strategy when you are expecting a big move in already volatile stock. It is executed by selling a call at a lower strike price and buying twice number of calls option at higher strike price. Ideally, this trade is initiated for a minimal debit or possibly a small credit. This way, if the stock heads south, you won't suffer much either way. On the other hand, if stock takes off, the profit potential will be unlimited because you have more long calls than short calls. The maximum gain can be unlimited when stock rises and maximum loss would occur when the stock closes right at the high strike price, and it will be higher strike price minus lower strike price minus the net credit received. Neutral or sideways markets are flat out horrible for this strategy. So use this strategy only when the stock is at the starting of its short-term uptrend. Let's take an example. Suppose ABC stock is trading at $53 in December. We execute a 2:1 callback spread by selling a January 50 call for $300 and buying two January 55 call for $100 each. The net premium received to enter the trade is $100. Maximum gain is unlimited and maximum loss is 55 minus 50 multiply 100 minus net premium received is equal to 500 minus 100 is equal to $400. Now if ABC stock is trading at $55, both the long calls will expire worthless while the short call expire in the money with $500 in intrinsic value. If the stock dropped below $50, that is lower strike price, both the options expire worthless and you keep the net premium received to execute the trade. So your net profit in this case is $100. If the stock rallies and is trading at $62 on expiration date, all the options will expire in the money. the short call is worth $1,200 and needs to be bought back to close the position, and the two long calls bought is now $7 each. So their combined value is $1,400. By squaring off the position on both calls, you received a premium of $200. Since you had also received a premium of $100 while executing the trade, your net profit is $300 in this case. Beyond 62, though, there will be no limit to the gains possible. For example, at $70, each long call will be worth $1,500 each, and the short put is only worth $2,000, resulting a profit of $3,000 minus $2,000 is equal to $1,000 plus $100 which we received while trading the strategy. So our net profit in this case will be 1000 plus 100 is equal to $1,100. But the maximum loss occurs when stock trades at higher strike price, say at $55. In that case, intrinsic value of two long calls would be 0, whereas intrinsic value of one short call would be $500. So to square off the position, you will have to pay $500. Since you had received a premium of $100 while executed the trade, your net loss would be $400. So we will always take help of technical analysis and execute the strategy when we get a clear signal of upmove of this stock price. This is the chart of LRCX and we can easily see that the stock is in strong uptrend. After a sharp retracement to the extent of the trend line, now it is trying to make a up move because we are getting a positive divergence on RSI. So we can execute a callback spread strategy here by selling one lot of January 180 call at price $7.40 and buying two lot of January 187.5 call at price $3.30. Let me zoom in the chart. Now see here we are getting a positive divergence on RSI, so we expect that the prices will rise in upward direction, and also this is the support level at $180. This is the support level. We will mark it. See, this is the support level. So we will sell one lot of 180 call here. The stock is trading at $186 and it will move in upward direction, so we will buy two lot of 187.5 call here. Now we will see the prices of the call. The buying price of 180 call is, this is 180 call, selling price this bid price, so it is $7.40 and buying price is ask rate is $3.30. By doing this, we are received a net premium of 7.40 minus 6.60 is equal to $0.80 per share. The maximum gain can be unlimited and the maximum loss is higher strike price minus lower strike price, that is 187.5 minus 180 is equal to 7.5 minus net premium received, that is 0.80. It means 7.50 minus 0.80 is equal to $6.7 per share. Now if on expiration date stock dropped below $180, both the options will expire worthless and we keep the net premium received to execute the trade, that is $0.8 per share. If the lot size is 100, in this case we will receive a premium of $80. And if on expiration date the stock rallies to $200, all the options will expire in the money. The long call will have an intrinsic value of $12.5 each, having a total profit of $25, and the short call is only worth $20, resulting a profit of $5 plus the premium received, that is $0.8. It means our net profit in this case will be 5 plus 0.8 is equal to $5.80 per share. As the lot size is 100, our net profit will be $580 in this strategy. So it is a great strategy because we can get profit in upside as well as in downside. Thanks for watching the lecture.
In our last lecture, I adopted the callback spread strategy. The strategy should be adopted when we expect a bullish move, a very sharp bullish move, and in LRCX I was expecting a sharp up move because the stock was in uptrend and this was a range bound movement. We were here at this candle on 22nd of December, and I sold one call option of 180 strike and I bought two call option of 187.5. Welcome again to our next lecture. In this lecture, we will know the best condition when we can apply callback spread strategy. This is the daily chart of Invesco, and we can see that the Invesco is in bull trend and trading in between these two lines in parallel channel, and that is going to upward. So Invesco is trading in a bullish parallel channel and currently it is resting on its trend line, that is also a support line, and also touching the lower band of this Bollinger Band, and we can see Bollinger Band is sloping up, so we can expect a up move up to this upper Bollinger Band. So if we shift the hourly time frame chart, we can see that the stock was in downtrend in retracement phase, and this was the trend line of this stock. Now the prices broke this trend line and going in upward direction. Now just see here, this blue line is referring the inverted head and shoulder pattern. You can see that this is the left shoulder, this is the head, and this is the right shoulder. So the pattern is the reversal pattern, this is a bullish pattern. So this candle is breaking above this resistance line of this reversal pattern. So I am expecting a big up move here, and the target should be the height from this low, and it is approximately here at $177. So either we can make a bull put spread here, or we can initiate a callback spread strategy here, because this is the best condition when we get a reversal pattern, any bullish reversal pattern, then we can employ a callback spread strategy, because in this scenario a big up move is expected. So if we see the prices of the call option, currently the stock is trading at 172.80. So here we can make a bull put spread by selling a put option of 173 at price. We are selling the put option, so the bid price of this option is 3.36, and we will buy a put option of 170, and the ask rate of this put option is 2.38. So in this strategy, our maximum gain, our spread will be $0.98. The lot size is 100, so our maximum spread will be $98, and our maximum loss can be $2.02. It means $202 if stock remain below 173 level. So it is 2:1 risk reward ratio trade, but as we are getting here a inverted head and shoulder pattern, that is a reversal pattern, so I will suggest to make a callback spread here in this scenario, and for this we will see the call strikes. As we are getting here a reversal pattern, we will make it a debit spread. So we will buy two call option of 173 level, and the ask price of 173 call option is 3.43, and we will sell a call option of 170 level, and the bid price of 170 call is 5.33. Here we pay $6.86 for buying two call option, and we are getting $5.33 for selling one call option. So our net debit is $1.53 in this case, and our maximum loss can be 1.53 if stock falls below 170 level on expiry. But as I am expecting a big move at least up to $177, so in this case we can adopt this strategy. Here we need not to stay logged in this strategy till expiry, because here we are taking the benefit of these long call option. So we will exit from the trade before the expiry when we get a risk reward ratio that is 1:2. So here our risk is $1.53. So when we get a $3 reward in this strategy, we will exit from the trade. Let's see what will happen next. So this is 13th of July today, and in our last lecture on 1st of July, we employed callback spread strategy on Invesco, and we were here on that day. The stock was trading at 172.5 level, and I was bullish about the stock because we were getting an inverted head and shoulder pattern, and that is a bullish reversal pattern. So our strike was 173 and 170. We just bought 2 call option of 173 level and sold 1 call option of 170 level. Today the stock is trading at 179.46 level, and in pre-market we can see the price is $179.37. So at this point we were getting a bullish signal when moving averages were in upward direction and 10 period moving average was above the 20 period moving average. Here the stock crossed the resistance line of this reversal pattern, and also RSI was giving us a bullish signal because it is going in upward direction. And see, at this point RSI was touching the support line but didn't cross down this support line, and at this point the prices were forming a symmetrical triangle pattern that was a continuation pattern. Then we get a breakout from this pattern and the stock is currently trading at $179.37. So if we see the prices of our strikes, these are call option prices and the expiry is 27th of July. Our strikes were 170 and 173. 173 call option is currently trading at 6.90. We bought this call option, so now we will sell this call at 6.90, and 170 call option is trading at 9.97. So our loss from sold call is $4.64 because we sold our call option at $5.33 and now we have to buy it at $9.97. And our profit amount from our bought call option is $6.96. So our net profit in this trade is $2.32 and the lot size is 100. So our net profit is $232 in just one lot. As our risk was $153, so it is a very good amount of profit with respect to risk to reward ratio. So we can exit here by taking this profit. So when a stock is in uptrend and on early chart we get any bullish reversal pattern, we can adopt a bull call spread strategy because a big move is always expected at the breakout of this pattern. Thanks for watching the lecture.
In this lecture, we will learn about put-back spread strategy. Put-back spread strategy is executed by writing a put of higher strike price and buying twice number of put options of lower strike price. This is a great strategy when we are expecting a big down move in the prices of the underlying stock. The strategy can be used when a stock is in long-term downtrend and touching its trend line, or it should be in short-term downtrend and touching its resistance line. The trade will be initiated for a minimal debit or possibly a small credit. This way, if the stock price rises, we won't suffer much either way. But if the stock price drops, as we hope, the profit potential will be great because we have double long than short puts. The maximum gain can be unlimited when price falls, as we hope, and the maximum loss is short put strike price minus long put strike price minus net credit received. Let's understand the strategy. Suppose stock ABC is trading at $43. You hope that price will make a big down move now and you enter a put back spread by buying 2 ABC 40 put for $2 each and selling 1 ABC 45 put for $5. The net premium received to enter the trade is 5 minus 4 is equal to $1 per share. As the lot size is 100, so the premium received is $100. The maximum gain can be unlimited as stock falls and the maximum loss is 45 minus 40, that is $5, minus net premium received is equal to 5 minus 1 is equal to $4 per share. The lot size is 100, so our maximum loss can be limited to $400. In first situation, if on expiration date the stock had rallied to $45 or higher, all the option will expire worthless and you keep the net premium received to execute the trade of $100. In second situation, if on expiration date the stock is trading at $40, both the long puts will expire worthless while the short put expires in the money with $500 intrinsic value. So to square off the position, you will have to pay $500. Since you had received a premium of $100 while executing the trade, so the net loss would be $400 by deducting the $100 from $500. In third situation, the real money would be made if there is a sharp fall in the price and it trade much below the long put strike price. Suppose the stock is trading at $25 on expiry. Then the two long put would have intrinsic value of $15 each, a total of $300, while the short put would have intrinsic value of $20. By squaring off the position, you receive 30 minus 20 is equal to $10 per share. Since you also received a premium of $1 while executing the trade, your total profit would be 10 plus 1 is equal to $11 per share. Multiplying by 100, your profit in this situation will be $1,100. That is a very good amount with respect to risk-reward ratio. If we adopt the strategy by analyzing a chart that is in short-term downtrend, we will be in third situation and chances of making profit are very high.
Let's analyze the chart now. This is the daily chart of Sun Pharmaceuticals and we can clearly see that the stock is in downtrend. We just draw the downtrend line for the stock. This is the resistance line and we also draw the support line for the stock. So the stock is trading in this range and now we will analyze the current position of the stock. Currently the stock is trading at 566 rupees and it is trading at the level of this downtrend line. If we draw this pullback rally trend line, this is a pullback rally. So if we draw this trend line, we expect a fall up to the extent of this trend line, at least up to the extent of this trend line in just few days. So if we see this upper level, this 590 level is the strong resistance level for the stock. So we will draw a horizontal line for this level. This is the level and this is for 591 level. So we can sell a put option here of 590 level and the stock is currently trading at 565 level. So we will buy two put of 560. If stock will fall beyond this 560 level, we will gain our profit, and if stock closes above 590 level, still we can gain profit. So we can enter here a put back spread by writing a put option of 590 level and by buying two put options of 560 level. Now we will see the option prices. This is Sun Pharma 560 put and the expiration is 22 of February 2018 and today is 19th of February. We are purchasing two put options of 560. So we will see the ask rate. The ask rate for this is 9.90 rupees put options. So we will multiply now it is 9.80. We'll multiply 9.80 by 2. And this is Sun Pharma 590 put of expiration is 22 of February. This 590 put, we are selling this put. So we will see the bid price. Bid price for this put is 28.75. The lot size is 1100 here. We'll take two prices. This is bid price 28.75 now. This is ask rate 10 rupees and 28.95 rupees now.
So the net premium received to enter the trade is 28.95 minus 20 is equal to 8.95 rupees per share. As we are getting 28.95 rupees for selling the put and we are paying 20 rupees for buying two 560 puts. The maximum gain can be unlimited if stock price falls and the maximum loss is limited to high strike price minus lower strike price minus net premium received. That is 590 minus 560 minus 8.95 is equal to 21.05 rupees per share. As the lot size is 1100, so the maximum loss is limited to 23,000 approximately. If on expiration date the stock rises to 590 or above, all the options will expire worthless and we keep the net premium received to execute the trade, that is of 10,000 rupees approximately. And if on expiry the stock remains at 565 level, both the long puts will expire worthless while the short put will expire in the money with $30 intrinsic value. So to square off the position, you will have to pay $30. Since we have received a premium of 8.95 rupees per share while executing the spread, So the net loss would be 21.05 rupees per share, that is of 23,000 rupees approximately. But if stock falls to 520 level as we are hoping, the two long put would have intrinsic value of rupees 40 each, a total of 80, and a short put would have intrinsic value of 70. By squaring of the position, we will receive 10 rupees per share. Since we also received a premium of 8.95 rupees, our total profit will be 10 plus 8.95 is equal to 18.95 rupees per share. As the lot size is 1100, so the total profit will be of 20,845 rupees. So this is a very good strategy to be adopted in a bearish environment, as we can get profit when the stock rises or falls. The best tip to get maximum profit from this strategy is to exit from the trade when you get your target level before expiration if you can. Thanks for watching the lecture.
In the previous lecture, I adopted the put-back spread strategy. The strategy should be adopted in a very bearish environment when we expect a sharp down move in the prices, and the stock was Sun Pharma. The stock was moving in a bearish channel and I was very bearish about the stock. See, this is the channel, bearish channel, and the stock is moving in a bearish channel since February 2016. So here we were here, the stock was touching its resistance line of the channel and I was bearish about the stock, about the prices, because this was a sideways movement, but RSI was giving us a negative divergence. See, the peaks of RSI is giving a negative divergence signal and we were here at this candle. This 590 level was acting as a strong resistance level. So I sold one put option of 590 strike and I bought two put option of 560 strike. We were here. The price was 562 rupees and my trade was for 3 days. The expiration date was 22 of February, and see the move of this big red candle on 21st of February before 1 day of expiration, and it was a move up to 512 rupees. I was bearish up to 520 level because this level is acting as a strong support level, but stock gave a down move up to 512 level. So it was a very sharp down move and the trade was in profit of 21,000 rupees approximately. So it was a very good trade and the move was very sharp. After that move, prices are touching this resistance line again, but they are unable to hold this level and we can see here a sharp down move in the price. So this trade was also successful trade and the profit was 20,845 rupees. Thanks for watching the lecture. When prices fall, everyone seems to be in panic, but who says that we cannot make profit in bear phase? We can also get a good return in downtrend, and this is only possible with options. In bearish strategies, put-back spread is the best strategy if we expect a quick fall in the market. In this strategy, our risk is very small and 90% times we get profit of more than 200%. But do you know what is the best time to execute this strategy? Maybe you are thinking about the head and shoulder patterns. Yes, it can be. But the best entry point for this spread is a sloping down head and shoulder pattern. As we have learned in the previous lecture, in this strategy we sell one put option of higher strike and buy two options of lower strike. Generally the strategy is a credit spread, but when we get a sloping down head and shoulder pattern, we should make a debit spread instead of credit spread, because these patterns are highly reliable and prices fall drastically when neckline is broken downside. These can be found on any time frame chart, whether it is an hourly chart, daily chart or 15 minutes chart. This was sloping down head and shoulder patterns in Nifty 50 that is formed in hourly chart, and it was 2nd of February, which was the best day to execute this strategy because Nifty made a fall of 600 points in just 5 days after the formation of this pattern. Now it is 23rd of May today, and on 18th of May we again get a sloping down head and shoulder pattern on 15-minute chart. Just see here, we were getting a strong negative divergence, a bearish crossover of 50 and 100 period moving average in downside, and when Nifty closed below the neckline, it was a confirmed signal of downfall. The next day, when we got a opening below the neckline on 18th of May, Nifty was at 10,670 level. So the spread could be executed because a crash was expected after that. So the strikes for the strategies were 10,700 and 10,650 because 10,700 is acting as a neckline level and 10,650 level was slightly out of the money options level. I too entered the spread because it was a golden chance to make money, as there was also a negative impact of Karnataka election on the market. I got 105 rupees for selling one 10,700 put and I paid total of 164 rupees for buying two puts. So my total investment was 59 rupees. As the lot size is 75 for Nifty, the total investment was 4,425 rupees only. And today Nifty hit the 50% Fibonacci level at 10,445 level of Nifty. So I just exit from my position when my profit was 8,550 rupees because it was a approximate return of 200% in just 5 days. See the calculations of this spread. I sold one put options of 10,700 level at price 105 and I bought two put options of 10,650 level at 82 rupees each. So my total investment was 59 rupees. As the lot size is 75, so my total investment was 4,425 rupees. At the level of 10,445, the profit from bought put was 286 rupees and loss from sold put was 172 rupees. The total profit is 114 rupees as the lot size is 75, so my total profit is 8,550 rupees in this spread. As the investment was 4,425 rupees, so profit in percentage is 193%, approximately 200%. On daily chart, today Nifty closed below 50% Fibonacci level and below its 100-day moving average, and tomorrow it may touch the 61.8% Fibonacci level, that is 10,326 level. But I exit from my trade because RSI is giving a positive divergence on hourly chart. So I don't want to take any risk on my profits. Well, it was a very attractive return of 200% in just 5 days.
Hello everyone, our next strategy is short triangle strategy. This strategy is executed by selling one call option of higher strike price and selling one put option of lower strike price. This strategy makes profit when market remains stagnant with little change in price and when the underlying stock is in sideways movement or have a parallel channel range. The maximum gain is the net premium received that we get by selling the call and put options, and the maximum loss can be unlimited as market moves in either direction. So, a stop loss should be employed at the levels slightly above the resistance level or slightly below the support level. Suppose ABC stock is trading at $55 and it is trading in a range having resistance level of $65 and support level of $45. So you execute a short triangle strategy by selling a January 65 call for $1 and a January 45 put for $1. If the lot size is 100, the net credit received to enter the trade is $200, which is also your maximum profit. If on expiration date stock rallies above 65, say at $68, the 45 put will expire worthless, but the January call expires in the money and has an intrinsic value of $300. Subtracting the initial credit of $200, your loss will be $100. And if the stock falls below 45, say to $42, the sold call will expire worthless, but the January sold put expires in the money having value of $300. Subtracting the initial credit of $200, the maximum loss is $100. But if on expiry the stock is trading in between the level 65 and 45, you will keep the entire initial credit of $200 taken to enter the trade as your profit. If we employ a stop loss above the resistance level or below the support level, we can make the strategy less risky and definitely make profit. Let's analyze the chart now. This is the daily chart of IFCI, and as we can see, the chart is moving in a range in a sideways movement, and the range is between 35 and 20 rupees. Let me zoom in the chart and see the levels. You see, currently the stock is trading at 29.10 rupees. The resistance level is 35 rupees and the support level is 20 rupees, 19.97, that is 20 rupees. So we can sell a January 35 call here, and also we can sell a January 20 put here to execute our strategy. Let's see the prices of the option. This is IFCI January 35 call and this is IFCI January 20 put. We are selling call and put, so we will see bid price. The price of 35 call is 0.35 and the price of 20 put is 0.05. So the net premium received in this trade is 0.35 plus 0.05 is equal to 0.40. If we see the lot size, the lot quantity is 22,000, so we will multiply the prices by 22,000. By multiplying the spread, that is 0.40 to 22,000, we will get our maximum profit in this trade can be 8,800, that is approximately 9,000 rupees. If on expiration date stock closes between these two lines, this resistance and support line, if stock closes in between this range, our maximum profit will be 9,000 rupees. And if on expiry stock is above the resistance line or this support line, we could incur a loss. So we should employ a stick stop loss at 35 level or 20 level so that we can minimize our risk. But as the stock is moving in this range since 2015, so we are expecting to close the prices in between this range. Thanks for watching the lecture. See you in the next strategy.
Welcome back. In our previous lecture, I adopted the short strangle strategy in IFCI, and IFCI was in range bound movement and the levels of the range was 35 rupees and 19 rupees. We were here at this candle, the date was 4th of January, and I was expecting a up move in the prices up to this resistance level 35 rupees, and RSI was also trading in overbought range and it was giving us a negative divergence. So I adopted here a short strangle strategy, and in that strategy our maximum gain was 9,000 rupees approximately. I suggested to employ a stop loss at 35.5 level, slightly above this resistance level, and at 19.5 level because our sold put strike was 20 rupees and the trade was in profit. The expiration date was 25th of January and this red candle is on 25th of January. The prices are here at 31 rupees. So it was in between this range and now it is a sharp down move, and I am expecting this down move up to this support level because RSI is going in an oversold range. So I am expecting a down move up to this level.
Welcome to our next strategy, that is collar strategy. Collar strategy is used to protect an existing stock position. We can execute the strategy by combining the call and protective put. The strategy works like a bull spread. We purchase a protective put and sell a covered call with the same expiration date. It is a great strategy when we use it to earn premium by selling calls and wish to protect our portfolio from an unexpected sharp drop in the prices. Maximum profit is limited to strike price of the short call minus purchase price of stock plus net premium received. and the maximum loss is limited to purchase price of stock minus strike price of long put minus net premium received. Suppose you are holding 100 shares of ABC company. It is currently trading at $33. You can execute a collar strategy by selling a January 35 call for $2 and purchasing a January 30 put for $1. You are paying $3,300 for 100 shares of ABC and another $100 for purchasing put, but receive $200 for selling call. Your total cost of trade will be $3,200 and net premium received in the trade is 2 minus 1 is equal to $1 per share. Maximum gain is limited to 35 minus 33 plus net premium received is equal to 2 plus 1 is equal to $3 per share. And maximum loss is limited to 3 minus 1 is equal to $2 per share. If on expiration date the stock had rallied to $38, the call is assigned and you will sell your holding for $3,500. Since our cost of trade was $32, so our net profit will be $300. And if stock price goes down to $28, you are able to sell your holding at $30 because of the 30 put. Our net cost was $3,200, so our maximum loss will be limited to $200 instead of $400. And if stock remains stable at $33 at expiry, you will still have a gain of $100, that is the net premium received. Let us analyze the chart. This is the daily chart of Facebook Incorporation. Here the stock made a cup and handle pattern and now it is in uptrend, and this is the uptrend line. We also draw a resistance line to know the range of the stock. Now if we analyze the current position of this stock, the stock is trading near its resistance line. This is the resistance line and the stock is trading at this level, currently trading at $187.87. This was our last potential buying point because this red candle is touching this trend line and the next candle is bullish candle. Suppose we purchase 100 shares of FB at $177 and now it is trading at $187.87. So we are gaining a profit of $10.87 currently. Now we are expecting another $2 rise in price because this blue line is the resistance line and prices may touch this blue line. So we are expecting a $2 rise and we want to sell the stocks at that level. So we will sell a call of 190. By doing this, we are agreed to sell the stock at $190 at expiry. But we also fear that stock may fall and we will lose our present profit. So we will buy a 185 put. By doing this, we have saved our profit up to the level of $800. In this way, we adopt here the collar strategy by selling a 190 call and purchasing a 185 put. If we see the option prices for expiration date 19th of January 2018, this is 190 call. These are the call price. These are the put prices. So this is 190 call and we will see the bid price because we are selling the call. So the bid price for selling 190 call is 1.12 and we are buying a 185 put. So we will see the ask price of put. This is 185 put and the asking price of 185 put is $0.98. Let's make some calculations now. The premium received in this trade is 1.12 minus $0.98, that is $0.14 per share. If the lot size is 100, so the net premium received is equal to $14 in this trade. Our maximum gain will be 190 minus 187.87 plus net premium received and is equal to 2.13 plus 0.14 is equal to $2.27 per share. And our already profit was of $10. So our maximum gain will be $12.27 per share is equal to $1,227 if the stock closes above 190 on expiration date. And our maximum loss will be limited to 187.87 minus 185 minus net premium received is equal to 2.87 minus 0.14 is equal to $2.73 per share. Deducting this to already made profit of $10, we get $7.27 per share. It means if on expiry stock falls below $185, we have saved our profit up to $727. And if every stock remains steady on expiration, we will gain another $14 profit in addition to $1,000 profit, as we will get the whole premium to enter the strategy. So this is a very good strategy to adopt if we are already making profit in our portfolio. Welcome to our next strategy, that is collar strategy. Collar strategy is used to protect an existing stock position. We can execute the strategy by combining the call and protective put. The strategy works like a bull spread. We purchase a protective put and sell a covered call with the same expiration date. It is a great strategy when we use it to earn premium by selling calls and wish to protect our portfolio from an unexpected sharp drop in the prices. Maximum profit is limited to strike price of the short call minus purchase price of stock plus net premium received. And the maximum loss is limited to purchase price of stock minus strike price of long put minus net premium received. Suppose you are holding 100 shares of ABC company. It is currently trading at $33. You can execute a collar strategy by selling a January 35 call for $2 and purchasing a January 30 put for $1. You are paying $3,300 for 100 shares of ABC and another $100 for purchasing put, but receive $200 for selling call. Your total cost of trade will be $3,200 and net premium received in the trade is 2 minus 1 is equal to $1 per share. Maximum gain is limited to 35 minus 33 plus net premium received is equal to 2 plus 1 is equal to $3 per share. And maximum loss is limited to 3 minus 1 is equal to $2 per share. If on expiration date the stock had rallied to $38, the call is assigned and you will sell your holding for $3,500. Since our cost of trade was $32, so our net profit will be $300. And if stock price goes down to $28, you are able to sell your holding at $30 because of the 30 put. Our net cost was $3,200, so our maximum loss will be limited to $200 instead of $400. And if stock remains stable at $33 at expiry, you will still have a gain of $100, that is the net premium received. Let us analyze the chart. This is the daily chart of Facebook Incorporation. Here the stock made a cup and handle pattern and now it is in uptrend, and this is the uptrend line. We also draw a resistance line to know the range of the stock. Now if we analyze the current position of this stock, the stock is trading near its resistance line. This is the resistance line and the stock is trading at this level, currently trading at $187.87. This was our last potential buying point because this red candle is touching this trend line and the next candle is bullish candle. Suppose we purchase 100 shares of FB at $177 and now it is trading at $187.87. So we are gaining a profit of $10.87 currently. Now we are expecting another $2 rise in price because this blue line is the resistance line and prices may touch this blue line. So we are expecting a $2 rise and we want to sell the stocks at that level. So we will sell a call of 190. By doing this, we are agreed to sell the stock at $190 at expiry. But we also fear that stock may fall and we will lose our present profit. So we will buy a 185 put. By doing this, we have saved our profit up to the level of $800. In this way, we adopt here the collar strategy by selling a 190 call and purchasing a 185 put. If we see the option prices for expiration date 19th of January 2018, this is 190 call. These are the call price. These are the put prices. So this is 190 call and we will see the bid price because we are selling the call. So the bid price for selling 190 call is 1.12 and we are buying a 185 put. So we will see the ask price of put. This is 185 put and the asking price of 185 put is $0.98. Let's make some calculations now. The premium received in this trade is 1.12 minus $0.98, that is $0.14 per share. If the lot size is 100, so the net premium received is equal to $14 in this trade. Our maximum gain will be 190 minus 187.87 plus net premium received and is equal to 2.13 plus 0.14 is equal to $2.27 per share. And our already profit was of $10. So our maximum gain will be $12.27 per share is equal to $1,227 if the stock closes above 190 on expiration date. And our maximum loss will be limited to 187.87 minus 185 minus net premium received is equal to 2.87 minus 0.14 is equal to $2.73 per share. Deducting this to already made profit of $10, we get $7.27 per share. It means if on expiry stock falls below $185, we have saved our profit up to $727. And if every stock remains steady on expiration, we will gain another $14 profit in addition to $1,000 profit as we will get the whole premium to enter the strategy. So this is a very good strategy to adopt if we are already making profit in our portfolio. Collar strategy can also be executed by taking fresh position in stock and when we are bullish about the prices. The strike price of the put option should be same of the purchase price of the stock. The price of the put will always be higher than the sold call price and maximum gain is limited to strike price of short call minus purchase price of stock minus net premium paid. Maximum loss is limited to purchase price of stock minus strike price of long put plus net premium paid. This is the daily chart of Microsoft Corporation and the stock is in uptrend and is respecting is 50 DMA. If we see the current position of this stock, currently it is trading at $94.06 and it is an uptrend. After touching its 50 DMA, the stock is now moving in uptrend and RSI is also above 50 level. So we expect a rise in the prices. But if we set the chart on hourly time frame, we can see that the stock is above its 50 DMA, but also it is getting a negative divergence in the prices. Here RSI is giving a negative divergence, so we also expect a fall in the prices. So we will execute here a collar strategy by selling a 96 call option and by buying a 94 put option. The current price of this stock is $94, so we will buy a put option of 94 level and as the resistance level is $96, this is the resistance level, let me mark it. This is the resistance level, so we expect a rise in the prices up to this level and we also expect a fall, so we will hedge our position by taking a put option and we will sell a call option of 96 level. Let's see the option prices. We will take the expiration of 9th March. We are selling the 96 call, so 96 call option selling price bid price is $0.56 and we are buying a 94 put, so 94 put ask price is $1.32. So we'll take two prices, 1.32 and 0.56. So the purchase price of 100 shares of Microsoft is equal to 94.06 multiply 100 is equal to $9,406 and net premium paid for the options is 1.32 minus 0.56 multiply 100 is equal to $76. So our maximum gain here is strike price of short call minus purchase price of stock minus net premium paid. Strike price of short call is 96, purchase price of stock is 94.06 and net premium paid is 0.76. So our maximum gain is 96 minus 94.06 multiply 100 minus $76 is equal to $118, and our maximum loss can be 94.06 minus 94 multiply 100 plus net premium paid, that is 6 plus 76 is equal to $82. So in this strategy, our maximum gain is $118 and our maximum loss can be $82 if stock falls below 94 level. But if stock reaches at $96, as we hope, our maximum gain can be $118, and I would recommend to exit from the trade when stock reaches at 96 level before expiry. Thanks for watching the lecture. See you in the next strategy. Hello everyone, welcome to our next strategy, that is long call butterfly spread strategy. The long call butterfly spread is a three-leg strategy that can be used in a neutral forecast. When the stock is moving in a sideways range and when we expect the price to change very little by expiration date, we can execute the long butterfly spread strategy. The spread consists of three legs with a total of 4 options: one long call with a lower strike price, two short call with a middle strike price, and one long call of a high strike price. The expiration date should be same for the call options, and the middle strike short call should be halfway between the lower and the higher strikes. The long call butterfly is a strategy that takes advantage of the time premium erosion of the option contracts, and the risk is limited in this strategy. Maximum gain is received when price remains unchanged at expiry and is limited to middle strike price minus lower strike price minus net debit. And maximum loss is limited to net debit, that is the net premium paid. The middle strike makes the body of the butterfly and the lower and high strikes makes the wings of the butterfly. Suppose ABC stock is moving in a range and currently trading at $40. You enter a long butterfly spread by purchasing March ABC 30 call for $10, writing 2 ABC 40 call for $4 each, and purchasing another 50 call for $1. The net debit paid to enter the trade is 10 plus 1 minus 8 is equal to $3 per share, because we paid a premium of $11 for buying 2 calls and receive a premium of $8 for selling 2 calls. Maximum loss in this trade can be net debit, that is of $3 per share, and maximum gain is 40 minus 30 minus 3 is equal to $7 per share. If on expiration date stock is still trading at $40, the sold 40 calls and purchased 50 call expire worthless, while 30 long calls still has an intrinsic value of $10. Subtracting the initial debit of $3, the resulting profit will be $7 per share, which is also the maximum gain. On expiration, if stock remains steady at the middle price, we get the maximum profit, and profit decreases when it moves towards the wings. Maximum loss results when the stock is trading below 30 or above 50. At 30, all the options expire worthless, and at 50, any profit from the 30 long call will be neutralized by the loss from the 2 short calls. In both situations, you can suffer loss limited to the initial debit to enter the trade, that is of $3 per share. The strategy should be executed when the stock is moving in a sideways trend or it is making a chart pattern. I personally don't trade this strategy, but if anyone is trading this strategy, I would recommend to exit with a profit of 25%. Let's analyze a chart and see how to take advantage of this strategy when prices are ranging. This is the daily chart of Tesla Incorporation. As we can see here, the stock is moving in sideways range. The upper resistance level of this range is $387 and the lower support is 310 level. Currently the stock is trading at 352 level and approximately in between the range, so we can adopt a long call butterfly spread here. We can also execute the long put butterfly strategy. Both the strategies are same, but we use put options instead of call option in long put butterfly spread. Here we are using call options in this example, so we will execute the long call butterfly spread. So for the execution of this strategy, we will sell 2 call option of 352.5 level, buy 1 call option of 320 level and buy another call option of 385 level. The middle strike of 352.5 act as the body of the butterfly and higher strike of 385 and lower strike of 320 act as the wings of the butterfly. Let's see the option prices. This is 26th of February, so we will take an expiry of 9th March 2018. The bid price of 352.5 call option is 8.85 and we are buying 320 call. So the purchase price, the ask price of 320 call is $33.90 and the purchase price of 385 call is 1.21. We are purchasing this call, so we will see the ask rate. The ask rate for this call 385 call is 1.21. So we will take three prices 33.90, 8.85 and 1.21. We will make our maximum gain if price closes at this middle strike price or near about this at expiry, and we will make our maximum loss if stock closes above 385 level or below 320 level on expiration date. Here we are getting premium of $17.70 per share for selling two 352.5 calls, and we will pay a total of $35.11 for buying two higher and lower strike calls. The lot size is 100, so net premium paid for the trade is 35.11 minus 17.70 is equal to $17.41 per share. Multiplying with 100, the net premium paid is $1,741. So the maximum gain in this trade can be 352.5 minus 320 multiply 100 minus net premium paid is equal to $1,509. And our maximum loss can be net premium paid, that is $1,741. If on expiry stock closes at the middle price, we will get our maximum gain of $1,509, and if on expiration date stock closes above the higher strike price or below lower strike price, our maximum loss can be $1,741. But again, I would recommend to exit from the trade if anyone is getting 25% profit, because the chances of closing at middle strike price on expiration always are very rare. Thanks for watching the lecture. In this lecture, we will learn about long straddle strategy. Long straddle strategy can be executed by buying one call option and one put option at same strike price. The strategy should be employed in a volatile market environment when the price of underlying stock is either expected to fall or rise substantially in a short period of time. And the strategy should be adopted prior to an important announcement, quarterly result, or a big political or economic news. The strategy is considered to be profitable when market moves in either direction. The maximum gain is unlimited as market moves in either direction, and maximum loss is limited to net premium paid. Suppose stock A is trading at $47 in January 2018 and there will be a big news next day about the stock. So you enter a long straddle by buying a January 46 call for $2 and a January 46 put for $1.5. The net debit taken to enter the trade is $3.5. As the lot size is 100, the net premium paid is $350, which is your maximum possible loss. If on expiration date the stock is trading at $57 by the impact of news, the 46 put will expire worthless, but the 46 call expire in the money having an intrinsic value of $11. Subtracting the initial debit of $3.5, your profit comes to $7.5 per share, or a total sum of $750 for executing the long straddle strategy. In the same way, if stock is trading at $35 after the impact of news, the call expires worthless, but the 46 put expire in the money having an intrinsic value of $11. Subtracting the initial debit, the profit comes to $750. On the other hand, if the stock is still trading at $46 on expiry, both the 46 put and 46 call expire worthless, and you suffer a maximum loss of $350, that is your net premium paid to enter the trade. The best tip to make maximum profit from this strategy is to cut your both the positions whenever you get a near about 200% of your premium paid in profit, because in most cases the news impact is short-lived and if you don't cover your trade you suffer loss most of the time. In this chart of Infosys, see the impact of news when Infosys indicated its 13,000 crore rupees share buyback offer to open on 30th November 2017. And after this news, the stock made a up move of 5.5% the next day, and then it made a fall of 15% in next 3 days. In the second example, this is the early chart of Nifty. Before Gujarat polls result, the Nifty made a fall of 190 points in just half an hour and then recovered from there to the same level in next hour by giving a up move of 348 points. In both the examples, the call and puts gave a return of 300% and it was only the impact of news. So if someone entered the long straddle strategy, he could have made a profit of 300% here. And now a much awaited union budget is here and it is likely to present on 1st February 2018.
So we can execute a long straddle strategy here. Currently Nifty is trading at 10,700 level. So we can buy a February 10,700 call and February 10,700 put simultaneously, because we expect a pre-budget rally in Nifty before the event. The points to remember here are, if you are expecting a straddle in anticipation of a news event, you should exit quickly if there is no big move in the price. You can sell the profitable side after a price move and keep the unprofitable side in expectation of price retracement on other side. For example, if stock rises before or after a news announcement, you can book your profit by selling profitable calls. The puts at that point won't be worth much, but will increase again if price retraces downward. For this, you can draw a trend line for the up move of prices and exit from the calls option when trend line is broken downward. Thanks for watching the lecture. We'll see you in the next strategy.
Welcome back. Long straddle strategy should be adopted before any important event. We were here, the level was 10,700 in Nifty 50 and a much awaited pre-budget event was awaited here. So I was expecting a high volatility in the prices and see there was a sharp up move in the prices. This was the channel.
Welcome back everyone, this is 1st of February and the budget was announced today. So it was a very good opportunity to trade the long straddle strategy here because this was a very big event, and on 16th of January, before 15 days, I entered in a long straddle strategy in which we buy one call option and we buy one put option of the same strike, because due to any big news, we can see a huge volatility in the prices before the news. That's why we can adopt the long straddle strategy. And on 16th of Jan, I entered in the strategy because on 1st of February, budget was supposed to be announced. And you can see in this chart, this is the daily chart of Nifty 50. This was the all-time high level and prices breached the level here. Prices were trading at 12,350 level, but it was a broadening triangle pattern formation on the chart of Nifty 50. And RSI was giving a negative divergence, so it was a multiple divergence in the chart of Nifty 50 and prices were trading near the upper resistance level of this broadening triangle pattern. That's why I was expecting a downfall in the prices, and this was the options chain of 6th February. So on that day, when I was watching the options chain, there was no seller of the current put strike. So here I bought 12,200 strike that was trading at 136.65 rupees, and I also bought 12,400 call that was trading at 180.50 rupees. Though in long straddle strategy, we should buy the current strikes for call option and for put option, but as there was no seller of the current strike, there was no seller of 12,300 strike in put side. That's why I bought the put option of 100 points below the current strike, and I bought the call option of 100 points above the current strike. So I bought 12,200 put at 136.65 rupees and 12,400 call option at 180.50 rupees. So my purchase price was 317.15 rupees, and you can see today is 1st of February, and after the announcement of budget there was a sharp fall in Nifty 50 today, and currently Nifty is trading at 11,661 rupees. So there were three reasons of bearish sentiments. First was in the chart pattern, after this uptrend prices were moving in a broadening triangle pattern, and second was RSI was giving a negative divergence. It was a multiple divergence in RSI. And third was there was no strike available in put side. There was no put option of both these two strikes near the current level. That's why sentiments were bearish for Nifty 50, and I was expecting a sharp downfall in the Nifty. And if we see the options chain of Nifty 50, the closing level of Nifty 50 is 11,661 rupees, and the expiration date is 6th of February, and currently you can see my call option is trading at 3.30 rupees and my put option of 12,200 strike is trading at 569.70 rupees. So it was a very decent profit in my trade, though I didn't hold my trade till the closing of the session because it was a very sharp fall in Nifty 50, and I covered my position when Nifty was trading near 11,700 level, because if we apply Fibonacci to this swing, 11,741 level was 38.2% level. That's why when Nifty was trading near this level, I covered my position here, and it was more than 50% profit in my trade in long straddle strategy. Now on Monday, if we get a gap down opening in Nifty 50, then we can see a further down move in Nifty 50, and then we can see a sharp pullback in the prices. And for this chart, these Fibonacci levels are the important support levels. So you can see these levels. If Nifty takes support either of these levels, then we can buy the call option of Nifty 50, because we can expect a pullback in the prices as there was a sharp fall, and after a sharp fall we can see a sharp pullback in the prices. Then we can see a consolidation after a sharp pullback. So on Monday, we will wait for the prices to take support on either of these two levels. Then we will buy the call option of Nifty 50.
Derivative market has become very popular in recent years in the manner to mitigate and control risk in stock market. A derivative is a contract in which its value is derived from the value of something else, and the something else can be anything from an agriculture commodity, interest rate, foreign currency or financial instrument, and it is called the underlying asset. An option is a type of derivative contract between a buyer and a seller. The buyer is purchasing the right to either buy or sell a certain asset at or before a specific date in the future at a price agreed today. The option buyer is not obligated to buy or sell the shares, but if he is making any profit in the contract, only then he will complete the trade. But the seller of the option is always obligated to buy or sell the underlying asset, whether he is making a profit or loss. For example, I have 100 shares of ABC company and you bought a call option of 100 shares. It means by doing this, you are purchasing the right to buy 100 shares of that company from me at a certain price, say $70. But you are not obligated to buy the shares. If the price of share rises up to $80 on expiration date of contract, you have the right to receive your profit amount from me, that is of $10 per share. And the total amount of profit is $1,000 because the number of shares are 100. But if the price falls to $60, you are not obligated to suffer a loss of $1,000. And from my side as a seller, if the price rises to $80, I will be obligated to give you $1,000. But if stock falls to $60, you will not complete your trade and I will receive the premium amount that you gave me at the time of execution of trade. Also, I am having my shares with me. In this way, there is a great possibility of making big profits in option trading if we buy a contract. But it doesn't mean that we shouldn't sell the option. Selling options is very beneficial when we sell them at right place, and also there are different strategies in which we make a combinations of selling options to make profits. That we will see in the upcoming lectures.
Now let's take practical example. Currently Facebook is moving in an uptrend and is trading at $164.62. Now if your view is bullish for the stock and if you want to purchase 100 shares of Facebook, you will have to pay 164 multiply 100 is equal to $16,462. But if we see the options price of 165 call of Facebook Incorporation, see this is the option chain of Facebook, and if we take the expiration of 8th March, the current price of stock is 164.62 and the nearest strike is 165 strike. So if our view is bullish, we will see the price of call option. These are call option in the left side and in the right side these are put options. We will learn about the options chain and all these terms like expiration date and strike price later in the course, but currently just focus on this price. 165 call option price is $2.63 and it is the price for one share. It means if we want to buy call option of Facebook Incorporation, we have to pay only $263 for 100 shares. Now see the difference. When we are buying 100 shares of Facebook, we will pay $16,462, but if we buy one contract of call option, we will pay only $263. Now, if Facebook rises to $170 in the next few days, we will gain $500 because currently the stock is trading near $165. So, by investing $16,462, a profit of $500 will be only 3% return. But by investing $263, a profit of $500 will be 100% return. But in the next few days, if stock price falls to $160 from here, our net loss will be only $263. If we buy the call option of Facebook, that is the cost of call option contract. Whereas if we buy shares at $164.62, our virtual loss will be approximately $500. It means with option trading, when we buy option, if we are in profit, we have the right to realize the profit amount from the seller. But if we are in loss, we are not obligated to suffer that loss and let the options contract lapse. So this was a bullish scenario, but if we are bearish about the price movement of any stock, we can buy the put option of that stock. For example, this is 20th of February and CVS Health Corporation is trading at $64.22. Currently, the stock is moving in a sideways range, but as this was a gap down opening and this candle is trading near the lower band of this Bollinger Band, you can see Bollinger Band is expanding, so my view is bearish about the stock. So in a bearish scenario, we should buy the put option. But as Bollinger Band is moving in a sideways range, if there is a sharp fall in the prices because Bollinger Band is expanding and this was a gap down opening, then we can make good profit in put option. But if there is a sideways movement in the stock, we can lose our money in buying the put option. So we will take the next month expiry. This is 20th of February. We will see the expiration date of 15th March. So this is 15th March. Expiration date is 15th March and currently the stock is trading at $64.22. So the nearest strike are $64.5 and $64. 64 put option strike is trading at $1.46. So if we buy 64 put option, we will pay $146.
So if on this expiration date stock closes below $64, then this strike will be in the money and we will make profit in this put option. So with option trading, we can make money in bearish scenario also, and if there is a fall in the prices, we can buy put option to make profit in downtrend also. Thanks for watching. I'll see you in the next lecture.
Welcome back everyone. In this lecture, we will learn about features of options. There are 5 key features of an option contract: type of option, underlying share or security, strike or exercise